Good morning, everyone. First of all, welcome everyone to this one-day seminar organized by WNFICL on Concurrent Audit. Welcome to all CA members and CA students. Before we actually begin, I request everyone to kindly stand for the ICA. Thank you, everyone. Before taking much time, I think let's just begin with the program. I request Ketan Sayya, sir, to have the chairman of the USC, to kindly arrange the gathering and then introduce Abhijit sir as the first session. Over to you, Ketan, sir.
Good morning, all of you. Hope all of you had a breakfast. Bank audit, a topic which is very close to my heart. Day by day, the bank audits have become challenging, and we have various type of bank audit. The one including concurrent, which we have today whole day session. My compliment to our Vikasa team for having this program organized jointly for student and members. Of course, due to long weekend, the overall attendance is less, but I think it will be more focused if we have sort of small classroom. And I wish make it interactive. All the speakers are the expert in the subject. All three of them have experience of more than 3 decades in this line of bank audit, and they all are very expert. Talking about Abhijit, a very dear friend. I mean, an awesome personality. I just saw, I regularly follow his tweet and LinkedIn post, but I just saw his, profile. He's so modest not to give even the profile. He said that, सब लोग जानते हैं क्या profile देने का. So I was, trying and asking him, अपना profile for the new benefit of the new member, but he's so modest. But I know him for almost 25 to 30 years, and we've, traveled together a lot of time. He advises Reserve Bank of India on a lot of things. He is a regular contributor to the institute in various capacities, as writer, a speaker, and across all the branches of WFC, across throughout India. He is the speaker, is a regular faculty on the topic of auditing, on the topic of bank audit. He has been doing a very large cooperative banks for years, and he is very well known for his mastery into the certain areas in the bank audit. Based on his expertise and experience, I requested him. Of course, he's also got a very busy schedule, but I had that privilege of catching him whenever I want. So requested him that, be here on 13th, and he readily agreed. So I'm really, really thankful to you, Abhijit, for accepting my invitation and being here as a speaker. So I was, looking at his profile. He says, enjoying life by staying happy continuously with an attitude of gratitude to de-risk and bloom. This is what I just read. So amazing. And I keep continuously reading his post, not only about, professional life, but the kind of, post which he writes. I think he's a very good writer. And of course, as I said, he's a regular speaker on the various topics. And requested him not only these today, but in future also we will request him to be here for on the help of or the support of West India Regional Council. Coming to the bank audit, yes, as I said, day by day it is becoming difficult. Wherever, anywhere, any problem, first thing government is not asking about, who was the officer involved, who was the employee involved in the bank in any problem. But the first question each regulator is asking is, who is the statutory auditor, who is the concurrent auditor. Look at the type of frauds which are happening. And yes, we are responsible. I'm not trying to run away from our responsibility, but basic responsibility is always of the management for the preparation of books of account, for following the regulations, rules which Reserve Bank of India or other regulators have been giving in case of cooperative bank, the cooperative commissionerate and all those departments. One day, huge money got transferred. This was almost 20 years back, Union Bank of India, Jhaveri Bazaar branch. And the magnitude of amount was, huge, some 700, 800 crore rupees. Post that, government, for whatever reason, this checking was done, and government, asked whether this branch was under audit. Yes, that branch was continuously under concurrent audit, under statutory audit, under revenue audit, whatever audit you name in bank, all the audits were carried out. The money which got transferred by way of hawala transactions. Documentation, not even 10% of documentation was available. Almost 20 years after this incident, one more incident happened. Bank of Baroda, Ashok Vihar branch, New Delhi. The amount is more than 10 times of that amount. Modus operandi, huge advances given to the companies in Hong Kong and all those places for export. For import, no import happened. If you see the number of accounts, almost 30, 40, 50 accounts. Many of them, the KYC was not done. Many of them did not even add IEC, one of the basic conditions for export import. Again, Ashok Vihar, BOB, continuously under concurrent audit. So a lot of time, it raises our eyebrow also that what auditor is doing. Many a time we ignore forex area. हम सिर्फ फोकस करते हैं एडवांसेस, बैलेंस शीट, and we don't look at the other areas. We feel KYC ठीक है, अभी क्या है, कहीं एक आधा पैन कार्ड नहीं लिया, आधार कार्ड नहीं लिया, तो क्या फर्क पड़ेगा? And then it leads to such serious problems. In one of the account of Mulund private sector bank, HDFC bank, 1 crore rupees got transferred from Mulund HDFC to some other few accounts. Later on, it was found those accounts wherever those money was transferred, whatever modest it was, some online fraud. But the account where it was transferred into various states, Jharkhand, Uttarakhand, Uttar Pradesh, and almost all accounts had no KYC. Those accounts where the money was transferred. And within half an hour, that money was transferred and withdrawn. From one of the small places, it was withdrawn and withdrawn into almost 70, 80, 90 accounts. The cash withdrawal had happened into huge, 90, 100 accounts, either 2 lakh, either 3 lakh, either 1 lakh, either 4 lakh. And that kind of withdrawal and no other transactions. So when these type of transactions are happening, online frauds are happening, and I can, narrate n number of such transactions. whether it is, frauds in housing loan, frauds in, other advances, or fraud in, non-advances area. If we, try and discuss, the whole day is required just to discuss on the, frauds in bank audit. But what do we do? Of course, we have, worthy speaker, all three of them, as I said. But one thing which I must say before I close my opening remark is the documentation. Your working paper is the only thing which will save you, nothing else. Right from audit planning working paper to what you have sampled, what you have selected, what you have verified, who are the person involved, what audit techniques you have used, what tools you have used. See, it may be impossible to do the audit, in few days, but you need to have, your technique of doing audit, of analysis of financial statement, advances, look at the documentation. So those areas needs to be seen very, very carefully. One of the audit which we did in 2016-17, we saw the previous auditor was given by the RBI a show cause, saying that XYZ account was NPA, but you did not classify that as NPA and it was classified as standard. And in June, when under section 35, the inspection was carried out, RBI identified it as an NPA, and they wrote to DC of ICAI saying that the auditors have not performed their duty. And not only this, again, there are a lot of cases which have happened in Mumbai and around Mumbai where Reserve Bank of India has given a show cause to the auditors. So, मैं आप लोगों को डरा नहीं रहा हूँ. These are the facts of the life which have happened in Mumbai. So, at whatever level you are involved in the bank audit, please understand that the risk is much higher than a normal audit. In normal audit, you know the customer, you know everybody, and here there will be rotation of staff. You don't know the people who will all be, handling the job. Somewhere in greed, somewhere in need, or whatever you say, they indulge into wrong deed, and they end up messing the accounts of the bank, finance of the bank, and ultimately, if it is not seen by the auditors are also blamed. So, be it a small procedure like exchange of key, are they noting or not? Canara Bank Ghatkopar branch, one fraud happened. No procedure was followed. मैं आज छुट्टी पे जा रहा हूँ, मैंने रुदेश को चाबी दे दी. रुदेश भी छुट्टी पे जा रहा था, उसने अभिजीत को चाबी दे दी. तीनों का कोई भी ट्रांजैक्शन का नोटिंग नहीं. अल्टीमेटली एक चाय वाले को चाबी मिली, उसने डुप्लीकेट चाबियां बना ली. उसने स्टाफ को बोला 50% तेरा, 50% मेरा. हालांकि वो 50% भी दिया नहीं स्टाफ को. In the night he came, opened all the whatever locker he had to open, took the money and went. Of course, he was caught in few days. As we say, Mumbai police, the second smart in the world. They immediately caught, maybe on 9th day or 10th day, that guy was caught from his native place. But point is not that. Point is that concurrent auditor, were they reporting this? There is a procedure. If I go on leave, I will have noting in register. I will to whom these keys are to be given. Once in a while, 3 महीना 4 महीना 6 महीने में एक बार वो एरिया कवर करो. देखो तो सही हो रहा है या नहीं हो रहा है. Are they following due procedure which banks have prescribed or not? So as I said, we keep focusing only on advances or at the most balance sheet. कई लोग ट्रायल बैलेंस तक नहीं देखते हैं. ट्रस्ट मी, 1 महीना ट्रायल बैलेंस निकालिए और मैनेजर के साथ बैठिए एंड आस्किंग. My experience is 50% चीजें तो उन्हें ही नहीं पता ट्रायल बैलेंस में कहां से आ रही है. His answer is I don't know. So if you don't know, I will also say in my report that no one knows in the branch what are these items are being posted in branch trial balance. At least somewhere I will put a disclaimer in concurrent audit. So with this opening remark, I once again thank Abhijit and request all of you to carry it with a loud round of applause for having agreed for this seminar. Before Abhijit starts talk, I'll request our regional council member and student committee chairman Rudesh to give him well deserved memento as a mark of our respect towards him. Good morning. I think I'm speaking in this
auditorium, maybe after a long time. And maybe for the first time, I'm not prepared for this topic because I didn't want to give a speech. This is a subject which I've been doing for the past 25 years. So I just wanted to share my experiences and maybe have a conversation. And since this is a compact audience, I think at any point of time, any questions, any issues, I can take that up. I've been given about 2 hours, so I'll speak for about 90 minutes and maybe take up any questions at the end. Still, at any point of time, if you want any clarifications, I'll be free to answer that. So let's start on the topic right away. Concurrent audit. How many of you are aware of Harshad Mehta? And what do you think is his biggest contribution? So everybody knows Harshad Mehta may be synonymous with the 1992 scam which happened. But probably he is also the reason why all of us are here and discussing this topic. Because concurrent audit was instituted immediately after this scam, the so-called scam which happened. So we are celebrating 30 years of concurrent audit, 1992 to be precise when this happened. And one of the first point which I need to address to cover the topic is overview of concurrent audit. So why and when this happened? So it's 1992, 3 decades to be precise. Possibly this is the reason why we are here. Possibly that is the reason why I've got some great speaking opportunities to speak on this topic over the years, write something for bank audits or whatever. So he's helped made a lot of careers in banking. So earlier, prior to 1992, prior to what concurrent audit was, branches were audited in a frequency of 12 months, 18 months, 24 months. So there was no concurrent audit in place. There was an annual audit for bigger branches. There was a 1.5-year audit for mid-sized branches or a 2-year audit cycle for very small branches or small branches. So concurrent audit came in place only after this, where it was felt after this fraud that one of the reasons why the fraud happened was because the checks and balances by external independent firms or by external people not connected with the transaction, that's the maker checker, was happening after a long period of time. So the expert committee thought that the time gap between the conduct of the transaction and its checking by auditors should be reduced. And they use the word, the checking has to be, I even can spell that out correctly, despite using that word so many times. They have used the word, it should be contemporaneous, which means it means almost simultaneous. So as a maker and a checker is doing, the auditor is an independent super checker. Now maybe for SWIFT transactions, you have a 6i principle inbuilt. So maybe for a SWIFT transaction, it will be the 8i who will be looking at it. But in all other cases, a concurrent auditor, as per the 1992 circular, still not modified till date, the transactions have to be checked independently as close to the conduct of the transaction as possible. So that's one. The second part which came in is that 50% of the banking business has to be under concurrent audit. So when you take 50% of banking business, if you take the top advances, if you take investments, if you take FX, if you take remittances, if you take maybe your export transactions, the bills of entry, the A1, A2 forms, or the XOS statement, maybe now the transactions on the IDP PMS and the ADPMS portals, they would easily cover the KYC, the new accounts open, where 100% transaction checking is mandated. The balance checks about 50%, so which all banks cover that. Now, in spirit, you call it concurrent audit, but there are banks which do audits on a quarterly cycle. There are banks which do audits on a 6-monthly cycle. So bigger branches may be under a monthly cycle, and say mid-sized branches quarterly, maybe smaller branches half yearly. Strictly speaking, just not in the concurrent audit spirit, because concurrent audit mandates checking as close to the transaction as possible. And even in a monthly concurrent audit, I really don't think there is a voucher check or somebody checks it immediately. So in spirit, if you ask me whether concurrent audit is happening in banks, yes, by definition, by article, yes, concurrent auditors are appointed, but whether checks are happening as close to the transaction, so whether you are picking up the vouchers the next day and checking it, or you are checking the vouchers end of day, maybe no. Time to introspect whether you are really doing a concurrent audit. So that's one part. The second part, which Ethan talked about, is of frauds. Concurrent audit primarily was instituted because frauds had taken place. And this is hearsay, documented hearsay, is bankers' receipts were used at that time. And because it was a manual clearing of transactions, what Harshad Mehta used to do is that when he used to purchase securities from the bank used to issue him what was known as a banker's receipt, which was a receipt that he's purchased it. Obviously, he had not paid for it. By the time the securities were transferred in his name and he made the payment, there was a time gap. So what he used to do is he used to take the banker's receipt, and on the strength of the banker's receipt, even take money on that strength. And that money he used to invest in the stock market. So basically what he was doing is, like, it's another common practice what businessmen do. When they purchase stocks on credit, it's technically they have not paid, but the stock is, let's say, in their godown or is in their custody. So against this unpaid stock, showing that creditors are nil, which is actually a type of fraud, which is commonplace because stock statements are all manipulated, most of them, or some of them, or few of them. I would stand corrected if I say all of them. Somebody would object. So you are drawing funds against unpaid stocks. So at one side of the balance sheet, you have stocks, accounting entry. One side of the balance sheet, you have creditors. So technically, why do you need the money for? And if you're borrowing money from the bank in the same stock which you have not paid, you have excess funds at your disposal. And banks follow a debt equity ratio of 3:1, and maybe the first method of lending, current assets minus current liabilities, 75% of what you can lend. So technically, I'm taking money and using it for whatever purposes I can. So Harshad Mehta used that money in the stock market. So classic case of demand and supply, when something is being chased, the prices go up. And he used to pump in, he used to buy more stock investments, have more bankers' receipts, have more aid, and this used to go on. And suddenly when somebody realized that he's being funded against something which he doesn't own, And then when that source of supply was cut down and he was asked to pay or not given further funds, the entire cycle was cut there. When you knew this was something of a scam, people panicked, the share prices collapsed. And technically, he was left with shares which he had bought initially, which had gone up maybe 10x times. I think the classic stock which had gone up in those times was ACC, favorite script of his. It had shot up maybe from 500 rupees to 8,000 rupees. And then when it again comes back to its normal price, you can imagine the money which was there, and suddenly you have a scam of, I don't know what zeros you add, and then it becomes a public, yeah, you add any zero and you inflate the number. But yes, so there was a fraud which happened. The regulator realized that one of the reasons why the fraud was happened is because there were no independent checks happening. So they said independent checks had to be instituted. To institute a system of concurrent audit. And that's how concurrent audit is. The precursor is of a fraud. So concurrent audit, primarily the spirit behind that is to not detect frauds, but be a deterrent to frauds. Now, is concurrent audit really in spirit doing that? So first, whether you are checking the transaction as close to the conduct of the transaction, that's one. And the second is, are you looking at transactions in a particular manner that you would be in a position to either deter or detect frauds? Maybe again, time to introspect whether we really possess that knowledge to actually find out frauds. So that's something we really need to have a background before we go into conduct of concurrent audit. Now, in any audit, for example, concurrent audit is no exception. What is of utmost importance is the knowledge of business. And do we understand banking first? What banks do? So maybe somebody has taken up a banking assignment and somebody has just sent maybe the article assistants to do a concurrent audit. But are they really aware of what they are supposed to do? So it just boils down to what we are doing, why we are doing this, and how we should do this. So the what, you're doing a concurrent audit. Why? It's much beyond that. You have got an assignment and that's why you got to do. It's good to see a lot of articles. So it's not that, yes, if you are wanting to do your CA course, one of the requirement is that you do an articleship for 3 years under a CA firm. You got to spend some 35 hours every week. Correct me for that number. And in that, you got to do whatever your principal tells you. And if maybe go to a bank and do an audit, so be it. We go there. Maybe the senior will explain you. Whether the senior really knows what he's supposed to do, that's another issue. So we had revenue audits when I started we never had concurrent audits. Concurrent audits came in 1992. I started my journey much earlier. So my first day, and we had a revenue audit of some bank. And the fees was 2,000 rupees. Clearly remember. And I was the first week article. First week and a week article. Not knowing anything, my senior said, just go, your senior will guide you. So the first principle he gave me, day one, 2,000 रुपया fee है, 8,000 रुपये का revenue leakage निकालना है 4 times. I don't know from where he got 4 times, but he says you should give value for X. I said maybe 10,000 will be better. So let's look at a 5 figure, 10,000 Within first 1 hour, we got it. We were told you go in for a week, Monday to Friday, Saturday issue the report. At that time, banks were working on Saturdays for a limited time. So we finished it in the first 1 hour by luck. So then enjoy. Whatever you do, anything over that is bonus. So the key lesson there was you got to add value, which stands even today. Maybe if X amount is your fee, then you add value at least 5x that time. Now, what is value? Value will change. Now, value is, in case of a revenue audit, it was very clear you detect revenue leakage, whether positive, negative, which will enable the bank. In a concurrent audit, you clearly have been given a scope. So are you actually doing justice to the scope? Now the scope again. The scope is a scope. The scope is given because that's the minimum you are expected to do. Because the scope always has one mandatory warning. Like you'll see in every cigarette pack. Earlier it was very small. Cigarette smoking is injurious to health. Now it's slightly bigger, much bigger. So maybe if you invest in a mutual fund, they are subject to market risks. So please take proper care and attention when you do it. So in a concurrent audit, at the end, is any other matters which you feel necessary, or maybe the bank when it gives it is any other matter which we would add in terms of changing regulations. So the regulations keep on changing practically every month. There might be 4 or 5 new circulars which come up. So the WRC newsletter which is there has started since maybe last 2 years, which are the new circulars which are coming in they give a gist. So the scope keeps on increasing. The concurrent audit came in 1992. The initial circular is there. Please have a look. But anyway, the circular gets modified by the fact because the bank gives you a checklist. And at times the checklist can go into 800 points also. So anything and everything under the sun is under concurrent audit. And this was modified by a circular in 2002 issued by RBI on risk-based internal audit in banks. And by the 2002 circular, which again RBI woke up in 2021 for cooperative banks and said that you should implement risk-based internal audit by 31st March 2022. And that 2002 circular was actually confusing in the sense it talked of risk-based internal audit, but it referred to concurrent audit in almost every second para. So whether it was meant for concurrent audit or concurrent audit is like an internal audit was not very clear, but the spirit which they wanted to inculcate why that circular was that concurrent audit, which was supposed to be transaction audit as per the knee-jerk reaction to the Harshad Mehta scam, over a period of time will still be a transaction audit, but that transaction audit is supposed to not be the end in itself. The transaction audit will lead to why the thing happened. So if there is a transaction failure, why was the transaction a failure? So what is the process gap? What is the risk involved? And what you should do to rectify the process. So straight away, your concurrent audit became a risk-based process audit. So that's the classical, I always keep on repeating the cow fell in the ditch theory of internal audit. If a cow falls in the ditch, the first thing you do is to get the cow out of the ditch. The second thing you do is to find out why she fell in the ditch. And the third thing is you institute all mechanisms to ensure that the cow does not fall in the ditch again. So concurrent audit from 1992 to 2002, if a transaction is a failure, please point out that this transaction has failed, your duty is over. Post 2002, the duty of a concurrent auditor is to not only point out that failure, but also point out why the transaction failed. So what is the process gap? So what I call the GVT, the gap, the vulnerability or the threat, which is the real root cause. So root cause analysis or RC, as we talked about, the why. If you've heard of Simon Sinek, he is a multi-millionaire just because of the why principle, why it happened. So the 5 W's and 1 H, which we commonly use in the concurrent audit or any audit, why, when, where, which, what, and 1 H is how. So why did it happen? And what should be done to ensure it does not happen again? So this is what happened. Now, initially, what happened was the observation. In a risk-based audit, that doesn't become the observation. The observation is why it happened. The gap is the real risk. The gap is the real observation. And the transaction failure which has happened is the impact. So there is a shift in the way you conduct an audit, especially a concurrent audit post 2002, highlighted very specifically that it has to be mandated by 31(3)22, a risk-based internal audit, in which the key area is that you do not spend the same time in each and every area which you do. Areas which are of higher risk, you spend more time. So you spend disproportionate time in areas where the risk is higher. So maybe where the volume at risk or the exposure at risk is higher, you spend the max time. So maybe the 80-20 rule, the 90-10 rule, or maybe something which I believe as articles, all of us have been masters at doing it. So if certain area is not important, you don't read it for the exam, you just skip it. So technically, or you will just glance through it. So the same principle, spend more time in areas where you think the questions will come and they are more important and maybe you can score. So spend disproportionate time on areas which need attention. So then that tantamounts to identifying areas which are at key risk. And that tantamounts to doing what we call it as a risk profiling of the branch before you actually conduct the audit. So how do you do a risk profiling? So you're given a branch. Ideally, in a branch, it's basically when you're talking of a bank branch concurrent audit. Let's go to the bank concurrent audit a bit later, but in a bank branch concurrent audit, the main areas will be your advances and deposits. So if it is advances will be secured, unsecured. And advances you'll have maybe say 100 crores are the advances, and there are 100 parties with total of 100 crores. You'll have 10 parties where the total of that advances is 60 or 70 crores. So 10% of the advances in number account for 70% of the advances in value. So no rocket science, spend more time on these advances. But then if you are going into the account of these 10 advances, then you will find that these 10 advances are blue chip companies, or have ample security, or have ample network, or have very strong guarantors, or have very strong product profile. Then though you may be checking those advances, the focus may not be on those advances. But if you have some advances of about 50 lakhs or 1 crore which are weak, maybe SMA 2 or SMA 1, or maybe where the loan to value ratio may not be much, they may be having a declining trend of profits or sales or other documentation issues, then the focus has to be on those areas where the risk is higher, where the bank could be at a loss or there would be an impact. So it's basically becoming what is a risk-based process audit. So when we do a concurrent audit, two things we need to know, which I stated right at the start and I repeat. One is conducting the audit as close to the passing of the transaction. And the second, keeping in mind that the main reason why concurrent audit was instituted was to have a mechanism to deter fraud. So somewhere we need to have that fraud principle in mind. And again, fraud is a type of risk. So again, by the overriding circular in 2002 of risk-based internal audit, we need to know what risks are. And everybody knows risks and everybody doesn't know risks. Each one has his own theory, his own funda, his own logic about what risks are. And each will have his own dialogue also. So take calculated risks. I don't know. Is there a calculation for risk, or do you know what is the exact calculation? Is there a formula? Or whenever there is a risk, there is a reward. So what is the reward and what is the risk? So are you very clear on what risk is? So risk, by a very simple definition, is what can go wrong. So in the course of a banking business, banks undertake a lot of activity. So I would say simply, just noting a very few activities which a bank does to just illustrate what I'm talking about as risks. So bank accepts money from the public as deposits. So they could be saving account, current account, or a fixed deposit. And they primarily, as intermediaries, lend it to people who need it. So there is a one class who has savings, who would invest to get a rate of interest, maybe 5%, 6%, max 7% now. And they would lend it to people who need it. Lowest starting from 8%, 8.5% for housing loans, to will go with their PLR plus whatever, based on the risks, again, risk-based pricing. So the chances that the money which comes in, it could be a laundered money, not an official money. Let's not go very officially into what is official and unofficial, but there's a possibility of a money laundering risk at the stage of receipt itself. At the stage of lending, you may have the credit risk that the person to whom you have lent the money will not repay it or repay it on time. If it doesn't repay it on time, you have your own calculations of an NPA and the bank will be subject to a provisioning. and may not make as much profits as possible. If it's a listed bank, if the profits are down or the NPAs are high, the share prices may fall down. Another risk. And the final risk is that I may not receive the money, so there is a loss. So my net worth gets eroded to that extent. Then there is a regulatory risk, there are n number of laws, regulations. If I am not complied with them, I have penalties charged by the regulator, which I keep on reading. This bank has been issued this penalty AO. And maybe as recent as maybe delicensing of Rupee Cooperative Bank, you may have a case where the bank may also be delicensed. And then another risk that depositors in such case with deposits over 5 lakhs which are not covered by DICBC will not get their money. So various risks, again operational risk. When a cash is being deposited by a customer, the cash may not be legal currency, fake notes. So again, that's a risk that has no value. Or maybe while receiving, I may have received less cash, given out excess cash. Again, that's an issue. Online cyber fraud, we've heard many which have happened. So currently, cyber security risks, loss of data, stealing of data. So disruptions happening. So the BCP DRs or the IT risks. Then maybe you have fires or various other accidents. So other types of risks. So risks abound. The point is, are you aware of what those risks are? And a basic, whenever there is a risk, there is a control. So your risks minus your controls are your gaps or the vulnerabilities or the threats. That's what, as a concurrent auditor, we need to attack. What is the GVT, the gaps, vulnerabilities, threats? And when I'm talking about risk is that which is inherent in any transaction I undertake, which is known as the gross risk or the inherent risk. So if I receive money, there's a possibility I may have received tainted cash, I may have received less cash. If I give out money, I may have given excess cash. If I have taken deposits, it may be by some laundered money. Like he said, some 1 crore was deposited and 100 people withdrew 1 lakh, 2 lakhs. And again, the classic money laundering is receipt, then the layering, then the integration stage. So I'll be flooded with risks. The point is, am I aware of the risks? So that's where knowledge of business, knowledge of banking risks. But primarily, it's not my duty. I think the biggest risk as an auditor, what we face, my experience is we don't think. And one of the biggest risks is the risk of cut pasting. That's universal. I think the moment we stop that practice of cut pasting things, I think 50% of our problems will be solved automatically. The audit report very clearly gives management responsibilities, gives auditors responsibilities. And we clearly state we have conducted our audit in accordance with the standards of auditing. Maybe after we have completed our CA exams, most of the professionals would never have read it. In fact, when I was asked to speak on that, I read it. And I came to know there are hundreds of things which I should have done, which I never did. So one is, do we really know what we are supposed to know? Ignorance of anything is not an excuse. Assumptions are the mother of all goof-ups. And being aware of what you are not aware of is the biggest de-risker. And I always say, whenever there is a risk, you need to de-risk. Every risk needs to be de-risked. So knowing what risks are, And primarily, we have always stated, because it's a cut paste, we don't focus on that. It's the management's responsibility. So is the management aware of the risks? So the first thing when you go into the branch is just ask the manager what the risks are. So he'll say there are no risks. I've never seen any manager who will say there are risks. Recently, yes, there are managers who are also coming up with the risk because they don't want to take responsibility. They want to, good. As we said, concurrent auditor is there. The first person who will be fired is the concurrent auditor. If there is a fraud, nobody will ask what the branch manager was doing. They'll ask what the auditor was doing. तो auditor ने काम ही नहीं किया. ऐसी है, auditor कोई काम ही नहीं करते. Now whatever. So if the management responsibility is very clearly written, is the management aware of its responsibility and what is the management doing to discharge that responsibility? And obtaining a management representation letter is no substitute because that's something which we give it to them and they blindly sign. Has a management ever drafted a management representation letter? 99% of the time I have never seen any management actually drafting an MRL and reading what it is. He'll go through it and he'll sign. But when he actually goes to draft, I am dead sure he will not even put 50% of the points which are written there because he's dead sure he's not doing it. So that's what I'm saying. It's the cut paste thing. So whatever was there in the previous audit report is what is being followed. So there was one audit which I used to do where on investment it was on rate scanning. And there was one question, is rate scanning done? Answer was yes. So maybe when there was an audit which was happening for 3 years, I think it's good there is a cooling period. So maybe when we came in, initially our team did the work. So maybe post a certain months when I was reviewing it, I saw this again, rate scanning done. Yes, I said, just show me any rate scan reports. There are no such reports. No, the team could not produce any reports. As I said, documentation, have a backup for everything. Then when we discussed with the management, it was found out that rate scanning was never done. And right since inception, when maybe whoever concurrent auditors were there, they were always writing yes. So whoever there continued the tradition. So customs and traditions are good to follow, but at times one needs to really look into whether they are actually done or not. Now suddenly, how can we say no? If you have a history of saying yes, the embarrassing point is how do you suddenly say no, it's not done. And the management, you are the ones who for last 4 months or whatever years you have been saying yes, and suddenly you are saying no. What has changed? And nothing has changed except the fact that I was never auditing then, I am auditing now. By looking at the source documents, somewhere you'll have to draw, cut the line and report, be factual. I mean, constantly telling in concurrent audits, in any audits, be factual. And yes, no, not applicable, are a strict no. Maybe we have been harping on it in the LFR. As the LFR is a questionnaire where the questions are longer than the answers. The same applies to a concurrent audit report where the questions are at least of 100 words or more. And 99% of the time, the answer is in one word, yes, no, not applicable. So it's high time we've put an end to the cut pasting exercise, which we do. If we stop that, 50% of the problems are over. And the second, simple questions in English. I say if somebody is a 10th pass, he can easily do a concurrent audit. I can, out of your experience, I'm not boasting, but I've said that I can take anybody who is a literate, who can read and write, and can guide him to do a concurrent audit if he can understand what is written. And if you can read out what the question is very clear. The questions are so basic. They clearly lead you to what needs to be checked and what needs to be reported. So what you did, how you did, and to what extent you did, because you're not doing 100%. If you have checked the process, what did you actually check, how you checked? So please write what you did. Be as elaborate as you can as possible. And since we CAs are all a stickler for numbers, so technically if it's by sheer experience and by actual counting to just to be on the actual numerical side as an accountant, because we all know numbers and love numbers. So the answer has to be, at least if the question is in one sentence, your answer at least has to be in 3 sentences minimum. Everybody likes the power of 3. That's the universal A. And just do a check. What's the number of sentences in the long form audit report or in your concurrent audit report? And what are your answers to that? Now, if a particular area is not applicable, it's fine. You just leave it because they are not conducting that transaction. So something like BRs. We still love Harshad Mehta so much that even after 30 years and BRs were completely stopped by banks to be issued, that question still is there. So that fear or that sight is so deep that those questions still continue to be asked, and maybe the generation Y or whatever you call the new millennials may not even have known what a BR is, what it looks like, and what it is, what it ever was. They still will keep on answering no, not applicable. And we would also do the same. The same happens to maybe the Ghosh Jilani committee questions which are asked. So whether microfilming is done, maybe people may not even know what a microfilming is, or whether it's not applicable, whether it is no, because it's not done. So it's no, but we still say yes, or we still not applicable. So one is, do we actually read the questions? So basics, audit is absolutely basic. And I believe if we just do the basics, then most of us may not even speak. So one is, we don't need the questions. And we answer what is not what is asked. We answer what we want to answer. I don't know why. So again, I studied NLP in depth. NLP is why some people do what they do. I've never been, over the last maybe 33 years of my practice, having gone through at least maybe more than 500 articles. And I've studied most of them in depth. And each one is a unique specimen. He does what he wants. Why? Because each one of us is wired differently, thinks different. But universally, if in any question in the concurrent audit report, if it is part A, B, C, I'll either answer A, leave B and C. I'll answer B, leaving A and C. I'll answer C, leaving A and B. And I'll try all permutations and combinations. But very rarely will I answer all A, B, C in the same sequence in which it is asked. And if I have to answer, what did I check? Well, there'll be 100-point checklist for each question. Have I checked everything? No. So what I checked, let me write what I checked. Then how I checked. And to what extent, whether I've covered 10 samples, 20 samples, 100%. So please be specific. Don't accept responsibility more than what you have done. Why should you do that? Are you being paid for that? So we have something called an absolute assurance, a reasonable assurance, and a limited assurance. Be very clear of what absolute assurance is, what reasonable assurance is, and what limited assurance is. And most of our times, the problem is that we give an absolute assurance when we have not even done work which warrants a limited assurance to be given. So just go with the fact of that we need to give a limited assurance, and what needs to be done at the minimum that we satisfy the limited assurance. So based on whatever we have checked or the information and explanations which have been given to us, nothing has come to our knowledge which causes us to believe that so and so, whatever is the question, the answer. That's the limited assurance. Or a reasonable assurance at best, based on the explanations and informations which have been given us by the management for so and so, we state that so and so, whatever. That's at worst that we can do. But if we are stating, yes, we verified the same and this is in order. Standard answer for almost all concurrent audit report. That's the worst thing which we can do, is because we are taking complete responsibility and accountability for things which we have not done. And why are we giving that 101% assurance? We have not done even 10% of the checks. So there is no responsibility on us to do 100% unless in the areas where it is specifically mandated by our scope, or in areas where it is specifically mandated by RBI that these transactions have to be checked 100%. So please understand the risk. The risk is the inherent or a gross risk that any transactions can fail. Then you have the controls. And risks minus controls will give you the gaps, vulnerabilities, or threats, which is what we call the residual risks. And audit is all about finding whether the residual risks are within what we call your risk tolerance. So two concepts which you need to know very clearly is the risk appetite. Risk appetite is the maximum risk which anyone can take. And risk appetite has to be within your inherent or your gross risk. So if I don't have an appetite for giving an unsecured loan, I will not do that transaction. So I will avoid. But if still I'm supposed to do it, I may do it, but with a lot of disclaimers and controls. So the residual risk has to be within my risk tolerance. I should have a capacity to digest the loss which will happen. That's my tolerance. I cannot exceed my tolerance levels. So the risk appetite and risk tolerance is something which each organization should know, and it should be clearly spelled out in their risk policy. So first is, when I do a concurrent audit, do I have the risk policy of the bank? If no, that's my first state disclaimer, I would say. If it was an audit report, I would have not qualified it. I would have disclaimed it. Is there a fraud policy? Yes, fraud policy may be there. But is the fraud policy available with the branch? Is the risk policy available with the branch? Have there been any risk or anti-fraud trainings? Are the people actually aware of the risks they face or the frauds that they can encounter? Are there any anti-fraud or anti-risk controls in place? Who's monitoring that? So like if it's a credit, you have a mechanism of early warning signals. There are 45 signals which have been given by RBI in the 7th May 2015 circular, which the banks need to monitor on an automated basis, EWS. If EWS is not closed within maybe 6 months, it moves to a RFA. So is the EWS RFA cycle happening? So one is, are we aware of what circulars are there? So one is the internal policies of the bank, which we all need to know. And the second is all the Reserve Bank of India circulars, which keep on being issued practically every month. At least there'll be 5 or 6 circulars which may impact our concurrent audit. So are we on top of that? So first is knowledge of business. It's not KYC, it's KYCB. Know your client's business. That's the first. So if you're looking at an SA 315. So SA 315 talks about understanding the risk of an organization, knowing the entity as well as the environment in which it operates, internal as well as external. And SA 330 talks of auditors' responsibility or the responses to those assessed risks. And SA 240 talks of fraud and error. SQC 1 talks of quality control, which I should have. So one is a reading of what standards of auditing are applicable so that I conduct my audit, have the necessary documentation. SA 230 may be an overarching essay on documentation, but there'll be a lot of audits which need other essays like SA 320 on materiality, SA 540 on evidence, all the essays on work which have been done by any other auditor, though this may be strictly applicable to audits of historical financial information or statutory audits, the spirit is applicable even to any audits. So one is understanding what the client does. So let us take the KYC. The KYC is much beyond just obtaining the proof of address and proof of identity. It's much more beyond just looking at the photographs and just putting it off whether it's there, whether the address is there. It's actually finding whether there is any beneficial owner or not, whether there are money mules which are operating. And KYC is actually to be taken in a spirit to prevent money laundering. And you have KYC is KYC AML. What is the AML policy? What is the client acceptance policy? What is the risk management policy? What is the transaction monitoring policy? Are there policies laid down? And who's ensuring that these policies are being adhered to? It's my duty to check, yes, but my duty to check comes after it's somebody's duty to adhere to this. And that's the bank management's responsibility, which is what I state at the top of each and every audit report. And which I should ideally discuss with the branch head at the start that this is your responsibility. Please let me know how you're discharging that responsibility. So the first day of any concurrent audit goes with obtaining the trial balance, as Ketan said, finding out what are the volumes, what is the exposure, and then having the organization chart to know who are actually working in the branch and what are the roles and responsibilities. And the org chart will actually let you know 3 key controls. One is your maker checker. The second is the segregation of duties. And the third is job allocations, along with maybe mandatory leaves, if is what you can check from the org chart. So the org chart plus the trial balance is your starting point for any audit. And then with the discussions with the branch head in arriving at a risk profile which the branch has, and document the risk profile on day 1. and share a copy of the risk profile, what you have prepared after discussion with the branch head on day 2. And when you are sharing it with the branch head, please obtain his acknowledgement that the understanding which you have on the risk profile of the branch is the same as what he has. Maybe over a period of time when you conduct the audit, you will find that that risk profile may not be right and you will need to amend it, which you should, and you should put it on record. But the risk profiling of the branch which you do on day 1, which is accepted and acknowledged by him, and your check subsequently 1 month, 2 months down the line will really tell you how the branch manager really understands or knows about risks or the branch. And if it doesn't understand, then your work becomes much higher. So the risk-based internal audit, if the people whose work you are checking don't understand what they are doing, and your risk becomes much higher. And your role is much higher than just saying, please forgive them because they don't know what they are doing. It's our role is not to forgive. Our role is strictly to audit. And saying, God, we trust, but still we audit. So, yes, I will spiritually forgive them for they don't know what they are doing, but it's still my duty to point out those errors and give solutions or point out why these errors are happening. And a lot of times the errors may happen not because of the fact that these guys don't know what they should do, but it could be for various other reasons where they may have some issues at home and they would have carried those issues in the workplace, and maybe they are not in the mental frame to do something and they may have missed out, or they may have been completely demotivated because of the fact they may not have been promoted or what's it. Or the fact is they might have some grievance against somebody in the organization, and to set scores right, they would have deliberately done some things wrong. So at times an operational issue is actually an HR issue. Because if people are paid for what they are doing and they've been in that area for years, then ideally they should know what they should do. And if something is going wrong, then why it is going wrong is what we need to see. Then what are my controls? So risk is always there. The key is controls. And controls have 2 components. One is the design of the control, and the next is the operating effectiveness. So is the control there? There means it is actually there. And is it operating effectively? So you may have a control just for the sake of having a control, but if the control is not operating effectively, then it's as good as not having a control at all. So have we actually tested controls independently of the transactions we do? So look at it. And what are the controls? Are the controls manual or are they automated? What is the percentage of automation? Gradually, I believe RBI will soon have another circular asking you to automate all the key controls. NP automation is already there. Inter-office account they're always harping on. So key areas already are under scrutiny. It's high time everything will be under automation. So what is the manual controls? What are these controls in operation? And if these are in operation, is the oversight slightly higher by the management or maybe even by audit. So let's say if you have a team of a first year article, a third year article, and a chartered accountant, then based on the volume and value at risk, the CA, supposedly that the CA is a knowledgeable person. I mean, no, but is he actually checking areas which are at higher risk? So the first year article, are you giving him absolutely routine areas like maybe cash checks or whatever? Maybe the third year article, it could be anybody in any composition, but yes, is the division of work that the higher the risk, it is checked by a more senior qualified resource. That's what you need to document and prove in a risk-based audit, whether you have done a risk-based audit. So you've identified risks, which maybe the management has to identify for you. And one thing which all banks have been doing is when they have a checklist. In the checklist itself, they have demarcated areas as high, medium, low. Again, I firmly believe, and I always put it on record, that you cannot classify risks on a gross basis. Or risk will always have to be assessed on a residual risk. So you may have something written as a high risk, but if the controls are automated and controls are very strong, then the residual risk does not become low, it becomes very low. And there may be something where you may have written as a medium risk, but if the risk control is just not there, then that medium risk ideally becomes a high risk because the impact would be much more if there is a loss. So the risk always has to be categorized on a residual risk level based on the impact. And the risks where the probability of occurrence, so risk is a function of probability and impact. So where the probability of occurrence is the least, where you are least expected something will hit you, and if it hits you, you're basically being unprepared. There is no control, either a design. So forget the operating effectiveness, and that's where the impact would be much higher. And that's where you need to be worried of. So something like a pandemic, nobody knew this would happen. Again, when it happened in some part of China, nobody who knew, or nobody knew that it would happen in India. Again, it would happen so soon and it will be so disastrous. So one is acceptance of reality. So once we accepted, yes, there is a pandemic, it's for real. That's where we woke up, we had the vaccines, we encountered it, but maybe we could have been more proactive. So that's where your controls have to be proactive and preventive. They have to stop the risk from actually impacting or hitting you. So are we looking at controls which are preventive, proactive, and automated? If we do that and we point out that these are the manual controls, these are the detective controls, these are the reactive controls, again, now it's for the management to basically institute proactive, preventive, and automated control, because they are the best possible types of control. So clearly identify risks. Your risks could be your credit risk when you lend money, the chance that it will not be paid or paid on time. The money laundering or the KYC AML risk that you might have money which would not be from legitimate proceeds of business. So it could be tainted money, whatever you call it. So you have all the regulations of CRS, FATCA, and whatsoever to prevent it. Then you have operational risks, because banking is all about operations. Operation risks will be there in each and every activity or sub activity which you do. Then you will have n number of regulations. So the legal risk, the compliance risk, the taxation risk, you need to calculate TDS, you need to pay GST if it's not done correctly or not done on time, and you need to submit various returns to RBI on time. So whether that's submitted on time. Then your technology risks, your cyber security risks, your foreign exchange risk, your market risk, interest rate fluctuation risk, your reputation risks. You'll have n number of risks. So the risk needs to be identified, then map your controls. What are the controls in place? So your maker checker, segregation of duties, your job rotations, your reconciliations, your physical verifications, your balance confirmations, your vouching, the vouchers, the ratifications, the authorizations, the appraisals, the obtaining of various documents and records. These are all controls which you are doing to mitigate something from going wrong. So is that happening in the manner and the way that is documented? So whether there are policies and procedures in place. And then it's all boils down to the systems and processes in place. What is the MIS you are looking at? So one, please obtain a list of all MIS reports which the bank generates, and what is the frequency of the generation of those MIS. So something which is daily, weekly, quarterly, monthly, half yearly, fortnightly. And two reports which are of key importance for any concurrent auditor. One is the exception report, because the exception report actually states down what are the key exceptions which would be there in each area we audit, and what are the parameters which are laid down for those exception report. Because the key is not the exception report, the key is the parameter which goes into framing those exception reports. So if the parameters are not laid down, nothing will come out in the exception. If the parameters are poorly laid down, nothing will come out. So whether the parameters itself are robust, so you can compare those parameters with those parameters laid by any other bank and then check. And the second report is the alerts which are generated. Well, the alerts which are generated actually lay the foundation for classification of a transaction as suspicious or not. And that's something, the STR which is filed is a key area which is looked by all regulators and by all internal inspectors as far as money laundering is concerned. So STR, CTR, obviously if it's over a particular threshold, it will be automatically reported, but STR. And your exception reports are key reports which need to be checked. Certain areas which need to be seriously looked into is if it's the submission of regulatory returns, especially RBI returns, whether they are automated. If they are manual, what is the robustness of the internal checks? So you need to check not just the timeliness of filing, but even the accuracy of compilation of those RBI reports. Then your inter-office accounts and reconciliations, especially suspense accounts. So I really didn't understand, I've never understood why a suspense account should ideally be created, or you should have some account called a suspense account in the first place. There should be nothing suspense about that. It's not a Hindi picture movie that you need to get some eyeballs or some collections or some targets. And the more the number of entries, the better it is. I think these are all transactions in the nature of receivables and payables, which in most banks get wrongly classified under the head suspense. So one needs to be very clear on what exactly is the entries which are passed, because the unfortunate part of automated entries is nobody actually knows what entries are passed and why they are passed. It's the system which is passing the entries, and why it is being passed, nobody knows. So the basic principles of debit credit, if you ask most of the bankers, they would not know, because it's automatically passed by the system. So why it's happening in a suspense account and why it's moved from a suspense account and what frequency it gets closed, It's because it's happening in an automated mode, except for very few people at the central office accounting team, nobody would really know, especially at the branch level, because these are automated entries. So inter-branch recon, the entries which are being passed through sundry assets, sundry liabilities, or sundry receivables, sundry payables, or whatever name you call that, please have a look at the source of entries. And please get those authenticated, or please get to know what is the bank manager's understanding of those entries. So have an oversight on the bank functioning. And the last is the topic of frauds. Because concurrent audit came into being because of a fraud. And if Ketan is back, so he was the first one who started with that these were the frauds which he has seen happening, and concurrent auditors having failed to detect frauds. And there is a report which comes out every year and which is presented by the Institute of Fraud Examiners, that's a certified fraud at the CFEs. The ACFE report to the nations, that's what is the report. So it comes out every year. You please read out the report. So it surveys a lot of organizations, and based on those organizations, it comes out with its report. And you will have RBI also having a master circular on frauds. And a lot of things which RBI stated in their report, master circular as frauds, are happening commonplace in banks across. Not even RBI or not even we as chartered accountants have got a consensus on them as what should be fraud and what should be labeled as fraud. Because if they were strictly to be labeled as frauds, practically every third or fourth transaction in a banking could be fraud, especially stock statement submission, where there is a lesser GP, or every instance where a stock auditor goes and finds out that the stock is much lower than what is stated in the stock statement submitted, or stocks are stated at market value whereas it should be actually at cost, or there's a wide variation between the stocks as presented by the audited financial statement as per the stock statement submitted to the bank. And there are cases where you will not have stock statement submitted. Some right businessmen will not submit the stock statement on 31st March and will give it on 29th or 30th March, so that it doesn't need to be tallied with the 31st March audited financials. But maybe Caro 22 will stop all that, because there'll be a direct question of that. So one needs to really see what frauds are as per RBI. What is the mechanism in place in the branch to detect, prevent, and report frauds? And whether we really are in a capacity to find out frauds. Whether we really have such deep understanding of the systems and processes, and we really do that audit in depth so that we can find. The ACFE report to the nations clearly states that frauds happen because of the fact that there are weak or poor internal controls. The person who commits a fraud is one who has a very deep understanding of the systems and processes and knows what the weaknesses are. So ideally, the fraudster should have swapped places with the auditor, or the auditor should have the mindset of a fraudster so as to be able to prevent frauds. And now you have the faceless fraudster who's not even in front, maybe sitting somewhere remotely and operating. Like you've seen in various Hindi movies, somewhere at the click of a button, you can get all monies transferred, all accounts zeroized immediately. Maybe this have happened in a few cases with some banks. But that's slowly for real. What's the cyber security insurance which banks are having? What is the professional indemnity insurance which bankers have taken? So frauds mostly are detected by whistleblowers. Most of the big frauds have been detected by whistleblowers. Otherwise, all the frauds have been detected long after the fraud has been committed. And in most of the fraud, the recovery is very poor. That's what the reports officially state. And most of the frauds have been committed by people who are in the system for n number of years. It's not that somebody who's joined recently has committed a fraud. So one is, what are the anti-fraud trainings? What are the anti-fraud surveys? What is there a fraud register? Is there a fraud policy? Is there anything which is done to prevent, mitigate frauds? If it's not there, please state so. Because it's not our responsibility to detect fraud, it's primarily the management's responsibility to prevent frauds from happening. And if they have not created a culture or structure where frauds cannot be prevented, then that should be the first area which we should highlight or disclaim. I think we should not feel shy of stating things factually. So the most important things about audit, before I am open to any questions, is first, concurrent audit has to be done as close to the conduct of the transaction, especially for transactions which are of higher volume or which are of risk. The risks which have to be identified by the bank manager. If the risks have not been identified, there is no formal risk register, a risk universe or a risk library, as you call it, for identification of risks in a structured manner. Please qualify that in your concurrent audit report that there is no such formal identification of risk. The second is the risk profiling of the branch. Please do it after obtaining the organization structure and the trial balance and decisions with the branch head. Possibly on day one, share it with him on day two, and keep on updating that during the course of your audit. That will also give you an understanding of how deep the knowledge of the branch head is. If he is knowledgeable, there are controls in place. Maybe the work to that extent would be less. If these guys just don't know what they are supposed to do, then your work clearly increases and you are at risk. The branch is also definitely at risk, but you are also at risk because if you don't fail to point it out and something wrong happens, then you would be the first one to be blamed. So always, concurrent audit, as I say, is a table tennis or a lawn tennis game where the ball always has to be put on the other side of the net. The burden of proof or the onus has to be shifted on the branch head. Pardon any bankers who are there. But yes, I'm speaking as an auditor, not as a banker. If I was speaking for a banker, I would have told him 10 other things to do to put the auditor on that side. But as an auditor, I need to always shift the burden or onus of proof on the bank, because primarily he's the management and it's primarily the management responsibility. So is he aware of his responsibility? So please make him aware. And if he's not doing that, our biggest key is we can always qualify or disclaim. That's our biggest weapon. So that's where I think the key session is all about reporting, which is at the end, because finally reports happen at the end. But I would put a strict disclaimer here that the reports have to be at the start. If at the day one, if you found out something is not there, don't even wait for the last day. Issue it on day one itself or day zero itself, whenever you notice it. Please don't cut paste. Please read what you are writing. So cut pasting is the biggest cause of all goof ups which happen in audits. 50%, if you stop cut pasting, 50% of our efficiency will definitely be increased. Please read the questions. Again, very basic, but I've seen most of the articles whom I have encountered with not reading the questions. And it's in simple, plain English. So maybe I've been very strict even telling them that if you really don't know, go back to your 6th standard Wren and Martin and read that. Auditors at times, I feel, need to do that. It's 7th standard. I clearly remember in my exam, we used to have answer in one sentence, and concurrent audit questions are all about that. The questions would have run into thousands. That's why in one question, they have combined 3 or 4 questions. So that's what A, B, C, D. We either answer A or we answer D or any combination of combinations we do, but we don't answer A, B, C, D in strict order. And what we did, how we did, and to what extent we did, because we don't do 100%. So whatever percent we do, 10%, 20%, whatever. Please state we did 20%. What is the basis of the sampling we took, or exactly state what transactions we checked. And this is what we checked there. And this is what were our findings. And don't give an absolute assurance. You're not supposed to give absolute assurance. I feel somewhere I should say the institute should actually penalize members who are giving absolute assurance, because then only they can. I think you should note that first. Absolute assurance we can't give. So somebody who's giving an absolute assurance when he's strictly told not to give absolute assurance and he gives that, then maybe we should have some negative marking or penalty. I strongly feel, because why are we taking more responsibility when we are not supposed to take it? Our guidance note on certification very clearly says we have to give a limited or a reasonable assurance. We still are giving absolute assurance when we have not even checked it, and we are meeting our own funeral. So that's it. And frauds, again, it's not my duty to find frauds. It's primarily the management's duty. And if they have not instituted a culture or a structure in place to prevent frauds, then please do so. So if there is a fraud which is happening or which has happened, and if the concurrent auditor is found guilty and is maybe put in Arthur Road jail or PR jail or with jail, you'll also have the branch manager for a company. If you have written this line that there's no culture or structure of frauds which has been created. So give all disclaimers as you can regarding frauds or risks, especially if the bank does not have a system of automated controls, preventive, proactive controls. All controls which are manual, which are detective and reactive, are outdated and need to be replaced immediately. Technically, we have all replaced all manual gears in our cars by automated gears. Same is the level of automated controls in banking. I think high time this has to be clearly stated. And please also read, if you have not read, as something which the institute has made recommendatory for 1 year till the next June, is the audit quality maturity model. An audit quality maturity model is clearly a spin-off from your SQC1. So please read SQC1 before you commence any audit, be it of a bank or any other organization. Yeah, thank you. Any questions? I'll take. Well within my time, 12 o'clock. So.
Can they read out? Please feel free to ask relating to certification or relating to the concurrent audit. Yeah.
My name is Pratima. Currently, I'm on the concurrent audit of national banks. So on a daily basis, we come across problems like whenever we encounter some problem, means some bank staff is not doing something, and we tell them, "Ma'am, this has to be done," or "Sir, this has to be done." So they say, "Ma'am, time card hai, customer have not filled something." So we tell them, "Should we send them to fill?" So we have also came to know that, observe that they are not reluctant in telling customer. In that case, what we should do?
So what you have observed is factual, right? Have you reported in your report?
I am an article.
So what? See, one new.
So the point is one risk which I will tell is an article calls himself an article. He's an auditor. I really don't know. There's another, this is my personal view. I think we call them article clerks. Maybe in the British time when the clerk system was there, somewhere this is deeply entrenched into I've told this to all my articles. So I think we should get out of the clerical mode. Be factual. If your senior doesn't write, force him to write. Technically, or you give your qualification in writing to the partner that this is what it is, it has to be put in. If he doesn't write it, this is his funeral, right? It's not your funeral. If you're telling your senior, your senior is fine, but you should tell the signing partner that he's at risk. So be factual. Ideally, then, in your case, when I said a risk-based process audit, what you are saying is not the issue. This is the impact that the forms are unfilled. And it's not because of the reluctance. What they have is the issue is that it's not a banking practice that the customer fills up the form. It's always, I've seen the case where the customer just signs and leaves the form in blank. It's a culture passed over generations. So somewhere, everywhere it needs to have a mindset change. Maybe the bank manager or somebody can guide him on how the form is to be filled up, but the form has to be filled up by the customer himself. So that's one. The second, the point that there is no time is a universal problem in almost all banks. They are really short of staff in most of the banks. But again, this is reality and they'll have to evolve around that. Or they'll have to improve their structure and design of work that they need to spend lesser time on doing something which they are currently spending much more time. So this is an issue which you need to highlight. Again, I've seen cases where bank employees and managers have deliberately done things wrong or deliberately left things incomplete so that mistakes will happen because they have been writing to their senior management that they need extra staff and they have not been provided, and this have told them that if their staff is not provided, their controls are weak, there'll be a breakdown, transactions may go wrong, and they would highlight these transactions as what auditors is pointing as a reason to get more staff. So again, at times they will not be bothered by what you write because that's what they want to serve some other purpose. But as far as an auditor is concerned, he should do his duty, he should report everything and anything. So you are safe. Your duty is pointed out to your senior, ensure that this is incorporated in the report. If it is not, you write it to your partner. Put things in writing. Don't just oral communication. There's no communication called oral communication. Put things in writing. You are safe. If the partner still doesn't want to listen to you or wants to override you, that's his risk call. Simple. Yeah, thanks.
So regarding RBI certification, well, the RBI when we are issuing RBI certifications, so for government, for example, I'm giving certification for such government business transaction. So RBI still doesn't have fixed format for all the kinds of certification yet. So in that case, now if the concerned person of RBI is satisfied with the wordings, he'll sign it, or else he'll return it and he'll tell that change this so and so words and sign it. So sometimes the word doesn't even make sense.
So this is a universal problem. Not that it's applicable only to you, it's applicable to me also. So wherever there is a fixed format, where whoever is to receive that certificate is insisting that it should be in that format and no other format, then we have signed that format, but we have issued a covering letter very clearly stating what we have done, how we have done, to what extent we have done, what are the limitations, and we have clearly stated that this certificate which we have issued has to be read clearly with the covering letter. So I'm clear of my responsibility. He wants that, fine, he's taken that, but that's not a standalone certificate I've signed. It has to be read with the covering letter. Now, whether the SST, that's the bank, wants to issue him the covering letter or not, that's their problem.
As far as I'm concerned, I've received that acknowledgement. My due date is on the covering letter. My due date is not on the certificate. So I'm very clear what I'm doing. And this is common. So please issue a covering letter where you write everything. So I always say your duty as an article is to make an uncensored movie of 5 hours, 6 hours, whatever. Finally, to make it crisp, concise is the signing partner's duty. That skill he should have. You write anything and everything. Let the branch manager correct or let him object. Let him show you the evidence that this is wrong. But as far as an article who's working is concerned, he should write everything. He should get all his doubts clear. Simple. There should be no doubt. Unfortunately, a lot of branch managers don't read the report. So at the end, what comes out is a lot of things at the central level. We find that these are not issues at all. That's another part. But you do your duty. You write anything and everything. So there has to be an audit closure process. It's what at a bank level, there has to be a clear audit charter. There has to be a clear audit process. If it's the closure process is not there, if the reports are not discussed with the partner, there is always a discussion certificate which is there. But again, that's a cut pasted exercise. So it's the discussions actually never take place most of the time. So that's what I said. The cut pasting is the major cause of inefficiency. Fine.
Many times we see in CC account, utilization almost in zero. It's more than 100%. It's what type of rates actually?
Utilization is more than 100% or 0%. No, I didn't get it. The utilization of a CC account is 0. So technically there are no transactions happening. So if the transactions are not happening, one, there is something which another, I didn't come into that, diversion, siphoning or willful defaults. The borrower may be operating with some other bank. One, again, there are RBI circulars that you cannot open accounts in a borrower account without the permission of the lending bank. So that you see for any violation. The second is he may not be earning anything. That's the bigger risk. He may not be having any income. And if in a CC account, the credits are lesser than the interest debits or there are no credits at all, it's an NP account. So either way, there is a risk. So luckily, if your credits are just more than the interest which is debited, still there is a risk that the borrower could not be conducting any business. So it's better to do a stock audit or do a visit at the borrower's place, meet him and find out what he's at. So during COVID, we found out actually there was one day where we asked the bank to find out how many borrowers are alive. And in one bank in Bangalore, there were at least 80 borrowers who had died. And the bank was not aware of it. And in almost 60 borrowers, there was no second in command to do that. I think the branch should seriously assess at that time whether that account is a performing asset or not. If it's a security, they'll get to sell the security and get it. But if it's still, it will be a cash flow issue and it will be an NP. Sooner or later, it would have gone into an NP. So it needs more deep diving into what the cause is. So this is just the symptom. You need to know the real root cause. Why the transactions are not there. Fine. Any questions here?
Sir, huge experience of audit. What are the minimum documentation? As we know, we are using a technology like smart audit, ethics. So what are that minimum documentation? Like as you said about trial balance, MS reports. Which are the other reports which any article or any auditor should go to?
So in your standards of auditing, they have used a word experienced audit. So you use the word experience, that's why I'm saying like nobody is an expert. Everybody is learning every day and you get new things to learn because new circulars keep coming up. There can't be any rule that this is adequate documentation. So the institute has also worded it in the standards of auditing in a manner that documentation or something is which a reasonable auditor. So reasonable is something by consensus, somebody with over 15 years of practice. Again, I know 15 years of practice may be sufficient. But ideally, look into something that if you were called to defend it, whether you have enough evidence to prove that you did the work with reasonable due care and diligence, and you are able to justify what you have written. So no documentation, I think it has got nothing to do with technology. It has got nothing to do with ethics. Technology will help you do the work faster. It will be an enabler. But documentation is the real source, root cause, or audit evidence. So please read essay 540. Maybe if you are more voracious reader, please read the Indian Evidence Act. I've done my law. My wife is a lawyer. My father-in-law was a lawyer. My brother is a lawyer. So I've heard hundreds of cases how evidence is led in court of law. So I always think if I were to go wrong, I would have defended myself in a court of law. So maybe over experience, you may get that insight. But at the present moment, see, you have enough yet to defend yourself that you have done work with reasonable due care. I think even if you have some documentation, is you can fight. But it's if you've done something, right? Somebody asks you, what have you done? Show me the work paper. Show me what you checked. So ideally, you should check it, right? If you haven't checked it and just said yes, no as a cut paste, somehow or the other without checking. So the rate scanning, yes, rate scanning is done. 6 years it was never done. Nobody checked it. If you do something like that, what documents you can keep? You'll have to have at least the rate scan reports, some sign. You need to check whether the person who has signed has actually signed it. It's his sign. So basic audit checks of inquiry, verification, confirmation, analytics. What are the audit techniques? I think that's what is in the basic audit inter-CA we have studied, right? You need to do that. And that's what you need to document. Again, have a look at SA 230. It will give you a very broad overview of what documentation which needs to be preserved.
Question on documentation. To what extent a document that we can keep with us till the even after the closure of the assignment for review purpose or something?
So there is a time limit, right? How many years the audit document, the working papers have to be preserved?
No, means what kind of documents we can, because sometimes an officer says that you cannot have sanction note with you and everything. That's
You cannot have a sanction note with you. You have seen, you can refer to that sanction note. You can refer to the serial number. You can refer to that. You need not keep everything with you. Maybe you can keep a photocopy. You can take a photo of it and keep it, or whatever. Ideally, whatever you can actually keep it in your work papers where you can trace it back to that original paper which it was. You can't keep a photocopy or copies of each and every sanction letter for each and every customer. But the fact that there was a sanction letter, the fact that you have seen it, and the fact that you have identified it by a particular reference letter or something is good enough. Thanks. Ethan?
Yes, sir.
Fine, yeah, exactly.
I hope you had a great learning session in last 1.5 to 2 hours. In fact, I was not so fortunate like you to, sit here and patiently listen since I had some other duties on my head of institute. Though in the beginning, Abhijit said that he is come unprepared, but I'm sure you will all agree with me. He actually doesn't need anything to be, prepared. और अगर हम आपको सब नींद में से उठा के भी बोलेंगे कि 2 घंटा बोलना है तो आप 2 घंटा नहीं 4 घंटा भी बोल सकते हो बैंक ऑडिट पर. The kind of, as I said in my opening remark, kind of expertise and knowledge all three speakers have. I think we as an institute are blessed to have such a resources and such a intelligent faculty on bank audits. So just to update you, in 2006-7, when T.N. Manoharan was president of the institute in fact went to government and pleaded before government to remove this word clerk. And now formally all the articles are told as article assistant. No more it is article clerk, which was there for years. But thanks to T.N. Manoharan sir, this word clerk has been removed from the CA Act officially by the government. Coming about assurance, yes, I fully agree with him. May not be in Mumbai, but yes, across people have been, signing NPA statements as a concurrent auditor. People have been signing balance sheet. People have been signing LFAR. I don't know how many documents they sign in case of branches which are not covered by statutory audit. Do that. I'm not saying that don't do that, but are you following the process of signing, creating whatever documentation, taking management representation later, doing a process of audit, yearly closing? ऐसा नहीं कि मैं monthly audit कर रहा हूँ अभी yearly आप balance sheet पे stamp कर दो, sign कर दो. That's not, because my focus during those months may not be on the financials. And financials, of course, when it is the closing is happening, there are much more different scope than a scope of a concurrent auditor will be there. So, okay, it's a good practice, to get it audited by concurrent auditor. But the question remains whether that process is done, are we paid for that? All those issues are remaining. Somebody said that, she said that, I'm an article, what can I do? In fact, I do tell in my form that everything and anything can be done by only and only article. Unless an article will bring the reports, the points for discussion, a manager or a chartered accountant who is a principal or who is a partner or who is a proprietor will not know the facts. So a lot of time people hold information and they think that मैं क्या करूँ, मैं article हूँ, I am facing this problem. And very aptly he said that how much of that is coming in your report? अरे जगह नहीं है बैठने का, वो भी डाल दो रिपोर्ट. अगर आपके पास टर्मिनल नहीं दे रहे हैं काम करने के लिए, put that also in limitation कि भैया एक महीने में मेरे को 10 दिन टर्मिनल मिलता है, 10 दिन ऑडिट कर. So I'm saying, somewhere you need to be vocal. You have to communicate to the management what's happening, and not only that, once in a 3 months, 6 months, in a year, banks are calling the meeting. Stand up there, tell the senior management, this is the position. I need a good working environment in your branch. I need, some people who are responsible to me for replying my queries. Keep writing mails to them. मैडम दिन में एक मेल जाना चाहिए आपका शाम को मैनेजर को. मैनेजर का भी सिर दुखना चाहिए बोले यार तो रोज शाम को मेरे को एक मेल भेजती है प्रॉब्लम, जेन्युइन प्रॉब्लम. So list out your problem. निकलते वक्त एक मेल शूट कीजिए. Fortunately, unfortunately, last 2-3 years I am not doing any concurrent, but we have a practice of doing at least one concurrent in our office, so that the office team is trained for the banking. So we tell them minimum once in a week एक मेल तो branch management को जाना ही चाहिए with your requirement, with your problems, with your queries, and ask them to give replies in writing. No oral explanation. I don't need any oral explanation. So that my documentation, my replies will be noted on the email, and then I will consider them for putting it in my audit report, monthly audit report I'm making. Somebody said we have fixed format. Most of the fixed format you see, there will be some space for putting the comment. Barring one or two, leave it. Most of them there are space for putting the comment. Even in the concurrent audit report, wherever it is computerized, wherever it is on the portal, if you see there is a miscellaneous section. There are sections where you can write whatever you want to write about your audit process, what data was available, not available to you. You can write everything and anything over there. So at least as an auditor, you are washing your hand, you are covering up properly, you are saving your skin tomorrow. If there is any inquiry, any problem, any fraud, anything is happening, you can say, go and tell the management, look, इधर तो लिखा था, पढ़ते नहीं तो मैं क्या करूं? So, but yes, we need to be vigilant. Gone those days कि हम कर रहे हैं audit, कुछ नहीं हो रहा है. There have been actions by Reserve Bank of India. There have been disciplinary complaints by RBI and institute, probing into that whether the auditor, the chartered accountant is actually doing his professional duty or not. Yes, we are there to help the management. We are part in concurrent audit. We are part of management. We are doing a management. But at the same time, we have to, try and safeguard our interests, try and, protect our firm, our partner who is signing that. So, at whatever level you are, be it article, be it, assistant, be it, any other post you are in your firm and carrying out the concurrent audit, you need to read lot. You need to put it in report. You need to do a verification. There are practical difficulties. वो स्टैट ऑडिट में भी आता है हम 3 दिन जाते हैं फाइल मांगते हैं सुबह से शाम तक फाइल ही नहीं मिलती बट देयर आर वेज ऑफ टैकलिंग एवरी राइट उसका भी यही करते हैं ऑडिट मेमो देते हैं सिग्नेचर लेते हैं लास्ट दिन तक नहीं मिला हम मेरे फाइल में डालेंगे दीस 10 फाइल्स आर नॉट सो एटलीस्ट आई हैव कन्वर्टेड दैट कि डेटा देना मैनेजमेंट का काम है मेरा काम नहीं है इंफॉर्मेशन प्रोवाइडिंग इज टू बी डन बाय द मैनेजमेंट इफ दे आर नॉट प्रोवाइडिंग इंफॉर्मेशन आई हैव ओनली weapon in my hand is my audit report wherein I'll put whatever I want to put. If they don't give information, there is no question of auditing. So with this, once again, we are really, really thankful for an excellent session by Abhijit Sanzgiri. I request all of you to carry it with the loud round of applause. Thank you so much, sir. I request our next speaker, Dhananjay Gokhale, sir, to please come on the dais. Break then. Okay, so we have arranged tea outside. We can break for 5-7 minutes before we start. You can refresh yourself, have a comfort break, have a tea, and please reassemble in 5 minutes. We are as such little late in starting the second session. Already we are late by 10 minutes, but let's have a tea break and refresh ourselves and rejoin in 5 minutes. Good afternoon, friends. We have a second session relating to the advances. And again, one very dear friend, Dhananjay. It's a pleasure to have you, Dhananjay, here to this afternoon on the seminar of Concurrent Audit. Almost, again, more than 2 decades, I've been knowing him, a very sincere and dedicated professional practicing in the area of bank audit. So, to formally introduce Dhananjay, Dhananjay Gokhale is a Bachelor of Commerce from University of Mumbai, a fellow chartered accountant in practice for almost 22 years. He is a founder partner of the firm Dhananjay J. Gokhale and Company Chartered Accountant, specializes in providing of management consultancy, audit and assurance in the banking sector. He has handled variety of the assignments relating to the bank audit, like central statutory audit, branch statutory audit, concurrent audit of branches and head office, inspection audit, stock audit of the borrower's account, credit audit of the borrower's account, staff accountability audit. This is very new for me also. The merger and acquisitions of urban cooperative bank, the rarest opportunity in professional career, system audits, functional testing of bank software. So to his credit, he has a lot of specialized experience. He is a regular speaker on various bank audit seminars, statutory, concurrent across India. He is the most sought speaker. Probably in March, if we want to have dates of Dhananjay, we have to try and book it in the December. Then only we'll be able to get some dates. He is a regular speaker in staff training seminar organized by State Bank of India and large multi-state cooperative bank. He has been a visiting faculty at University of Mumbai. He is a member of the expert panel constituted by AASB since its inception 2011-12, almost for 12 years, last more than 12 years. He is one of the person who is giving expert opinion on various queries which are raised online. So for those who are not aware, Institute keeps a panel of experts somewhere in the March, April, and the members write queries online, and the expert like Dhananjay, they give their opinion. And absolutely, this service is an honorary service for a person like Dhananjay. We are supposed to reply within 12 hours, 24 hours, that kind of timeline. And that time, most of these professionals are busy with bank audit. Still, they take out time and write back for the queries. So, really, really grateful on behalf of the institute to Dhananjay. He is a co-opted member of AASB. He was a co-opted member of AASB in 2018-19 and was nominated to a subgroup member of Banking Insurance Pension Committee of WSC of ICAI in 2018-19 again. He was a convener of the study group formed by the ICAI for the guidance note on bank audit. He has submitted his articles in the ICAI magazine various times. We are fortunate to read his views on the various topics in the CA journal. ICAI guidance note on bank audit for almost 5 years, since 2016. He's a regular contributor and he was a convener of the guidance note group. Friends, let me be very frank. Even if I have some query in bank audit, I seek his support, I seek his help. I call Dhananjay. So we are really fortunate to have Dhananjay here. In fact, again, I took liberty. I first told him that you just cover up verification of advances, and I will have some other speaker for NPA. Later on, whatever come to my mind, and I called him up. I said that in fact, instead of asking him, I straight away asked the office to send him a mail saying that cover verification of advance as well as NPA. So he called me, हमारे भाई एक बोला था अभी दोनों डाल दिए. मैं बोला अभी इतना liberty I have as a friend, and I can take that liberty of telling you that. But yes, in this 2 hours covering up both the topics, it's going to be a challenge. But I'm sure a person like Dhananjay can easily do that. And I have seen him speaking on various topics, including first time maybe 20 years back, I heard him on a system audit. We were together in some branch program. And since then, various time I have heard and have seen, his expertise, capabilities, knowledge, and request all of you to carry it with a loud round of applause. We welcome you, sir. As a token of respect towards him on behalf of WRC, I'll take this privilege of offering a memento to him. So, once again, we welcome to WRC and Vikasa program, jointly held for members as well as students. So, I'll request all the members and students to make it interactive. Take benefit of expert like Dhananjay. Again, he is one of the person to whom, who even advises to the various banks at a senior level. So, we are very happy and fortunate to have him here. Please take the benefit of his knowledge and do ask questions also. Thank you. Thank you very much. That is yours.
Thank you for introduction. And most of the things apply to you also. So I don't have to reiterate that. In fact, it's good to share a dice with him, seeing him in a different capacity. Because usually both of us go together at many seminars together as a speaker, and this is a topic actually which he also takes up. So he's equally competent. I should say that he started speaking much before I started speaking at the Institute's forum, and he's a very close friend of mine. Means I cannot really consider him as RCM or even in other capacity. So thanks for inviting me. And as far as today's topic is concerned, I will try to cover 2 things together. First part will cover about verification of advances, and second part will try to touch upon certain portion of IRAC norms, because IRAC norm itself takes around half day if someone wants to really cover it up. So we'll just have a brief part about IRAC norms and vital areas related to NPA identification, and which are the common discrepancies which are observed across the banking sector with respect to NPA marking. As far as advances is concerned, before we start speaking on advances, let me just add a couple of points in addition to what Abhijit said prior to this session. So as far as concurrent audit is concerned, ideally, whenever you get a concurrent audit assignment, you need to go through the scope of concurrent audit assignment. And as far as advances is concerned, typically every bank expects that you are supposed to cover 100% of that. So it depends upon which branch you are. If you are in a bigger branch, you are fortunate because number of advances will be lesser. If you are in a retail branch, it's the other way around. Let's suppose you are having say 200 loans, retail loans sanctioned in a particular month. You are supposed to go through all the files. Bankers per se don't permit concurrent auditors to do a test checking of advances. That is a kind of a privilege available to the statutory auditors, wherein you can do a test check sampling. In concurrent audit, the scope categorically defines that the advances has to be covered in entirety. Second thing is that as far as today's concurrent audit scenario is concerned, most of the banks are shifting to online concurrent audit reporting. So there are a couple of packages which are available. Now those packages are more from the point of view of the bankers, and I have never seen any software vendor or even the bankers for that matter to take concurrent auditors in confidence before that package gets implemented. So there are many pros and cons of that software. Good part about that software is that anyone can practically do the audit because the entire checklist is available. So someone who understands simple English, if he goes by spirit of that question and if he answers that truthfully, then the job is done. So prior to that, when these packages were not there, typically most of the firms were having checklists for each type of advances. like say for vehicle loan, housing loan, maybe gold loan. So for different type of variety of advances, you need to maintain that checklist. Still, that checklist maintenance in a way is inevitable, because you typically get maximum one system at any branch. So suppose there are 2 or 3 persons who are doing audit simultaneously, there is some part which is still manual, so checklist is not dispensed of as such. But the good part is that suppose in a particular loan or a particular type of loan, suppose 50 checkpoints are there. Those 50 checkpoints appear in that online software. So you need to answer each and every question. Most of the banks are having that answer yes, no, not applicable, and there is additional space for remark column. There are certain softwares which give you additional facility to upload certain files also, wherein the space is not sufficient. So make use of that. But when you are doing a concurrent audit, always keep one thing in mind, that wherever you are having these online audit modules, you are answering everything in black and white. So there is no gray area which is left out. So if you skip a particular point, it is already documented. So inadvertently also, if you give a affirmative confirmation, and if there is no document available in that file, you might get caught at a later stage. So be little vigilant on that. And that makes the entire process of concurrent audit process a little cumbersome, because typically all these softwares are having around 100 plus questions to be answered for individual loan file. So suppose you are having 100 files in a particular month, it's 100 into 100, the questions which you are answering. So it's practically not delegatable to maybe a first year article. Ideally, it should be, first year article should be taken as an assistant with you, and then only the audit can practically get over, so that in the second year you can fill up those questions. Whether you get compensated for that kind of work or not is not today's topic, so I won't touch into that, because otherwise we'll go endlessly by debating on that. So let's not get into that. So I just thought that I will just give a little background about which are the challenges which are there in concurrent audit. And in spite of that, all the CAs are accepting the concurrent audit irrespective of the fees. So I know that it's not an easy question to really address in this forum. But as far as concurrent audit is concerned, it is the audit which is carrying the highest risk at the branch level as compared to statutory audit. Statutory audit, you are giving a practically only assurance about true and fair view about the financials, or you can say about the trial balance of that particular branch. When you are doing a concurrent audit, you are verifying all the acts which are done by all those 10 or 15 employees who are present in the branch. So there is perspective naturally manifold as compared to statutory audit. I intend to cover these points in today's presentation. So we'll start with balance sheet disclosures, then we'll talk a little about types of advances. There are certain commonly used terminologies are there. So I will just try to unfold those terminologies just to have a common understanding about what those terms really mean. They will go through certain, you can say, points related to appraisal process, which is carried out the branch as to how to check about certain points. Then we'll talk about documentation and monitoring of advances, and at the end we'll talk about IRAC norms. The reason why I wanted to start with balance sheet disclosure is that many times in seminars also, the speakers talk about a particular topic. We never pay attention to how those things are disclosed in balance sheet, because ultimately the financials are the one wherein the bank or any entity will disclose the financial information. So there is third schedule of Banking Regulation Act. So it has Form A, which is prescribed for all the banks except for urban cooperative banks, wherein the format is little different, but otherwise contents are almost same. So that Schedule 9 of Form A is related to advances. So in advances, there are multiple subdivisions are there. So the same advances portion gets reclassified into different parts. Like for example, broadly, the advances will get classified into bills purchased and bill discounted. Second one is CCODs and loans repayable on demand, that is typical demand loans. Third one is term loan. So this is the total summation of advances in a particular branch. Then within that, again, there is a subclassification, or I should say a rearrangement of advances. So you have to divide the advance into again 3 parts. One is secured by tangible assets. Second is covered by bank or government guarantees. And third one is unsecured advances. Now beyond that also, again, you have to subdivide or reclassify the advances. That is advances in India. So within that, there are 4 categories. That is priority sector, public sector, banks, and others. Then advances outside India, there is a subclassification. That is the dues which are dues from banks, due from others, and then bill purchase, bill discounted, syndicate loans, and others. So the same advances portfolio gets gets disclosed in a different form. So why I wanted to disclose this information in initial stage itself is whenever you are checking a particular file, you need to know that how to check the master data related to that, because based on master data, all these disclosures are getting percolated at the head office level. So if the master data is incorrect, all this information which is expected as per that format of balance sheet, which is Form A, and in Schedule 9, this advances related part is there, that will go wrong. So wherever you are doing any advance checking, always pay attention to the master data and what is there in the file. Then as far as types of advances are concerned, these are general types of advances. Like if you talk about term loan, typically you will observe personal loans, gold loans, advance against securities, housing loans, consumption loans, or any other form of loans which might be given, like say agricultural loan, industrial loans will be there. If you're talking about working capital finance, typically you will observe cash credit limits and overdraft limits. And there is an innovative, you can say, instrument which is called a WCTL and WCDL. That is working capital term loan, working capital demand loan. Both these terms are used interchangeably in most of the banks. Now, why I'm saying this innovative kind of a product is, many times this product is used by the bank wherever there is a shortfall of DP. So wherever you are not having sufficient DP, and if the balance outstanding is more than your drawing power, that portion is carved out and it is given as a working capital demand loan, wherein it gets repaid over a period of say 3 years, 2 years, or 5 years, depending upon the terms which the bank will sanction. In theoretical sense, what is expected to be there in WCDL and WCTL is gradually, if a particular borrower wants to decrease his exposure to the bank, this is the instrument or this is the product which should be used. But that is the rarest of rare case which is observed. The most common thing is that wherever the drawing power is not there, that portion is carved out and converted into a term loan. Now the challenge over here is whenever you are having the advance, irrespective of type of advance, which is overdrawn or which is excessively drawn, that portion, if you try to accommodate in a different type of facility, it is called as evergreening or accommodation of that advance. So in case if a cash credit or OD limit is getting converted into a WCD or a WCTL, you need to first verify as to whether the sufficient drawing power was available at that particular point or not. If the DP is not available, it means that the bank has accommodated that particular borrower. Now the bankers will play around with this WCDL and CCODs. They will take the secondary security, that is the collateral security of CCOD, and that will be presumed as primary security for a WCDL or a WCTL. So suppose you are having a immovable property which is given as a collateral security, and primary security is a working capital. So this collateral security of CCOD is taken as primary security of WCTL. So the drawing power is created in the sense the security availability is created, and then that advance gets converted into a WCDL or WCTL. Now, as a concurrent auditor or as an auditor, I should say, you need to bring this fact in your report by saying that at a time of conversion, sufficient drawing power was not available. So from primary security, the drawing power is not available. If that gets converted into a different limit, it becomes an accommodation, or you can say that it is a restructured account because you don't have sufficient limits, sufficient drawing power available in that. So wherever you see that there is a WCD and WCTL limits are given, on the date of conversion, just ensure that whether it is within the DP or not. And secondly, when it is getting converted, what kind of primary and collateral security is considered over there. There are certain banks who continue to have the same primary and collateral securities for WCD and WCTL also. But what they do is, once that portion is carved out, then when you are calculating DP for CC limits, the outstanding balance of WCTL is not reduced, which ideally should be reduced because your primary security is same for both type of facilities. So just pay attention to that as to whether it is accommodation or whether it is a pure intention of the borrower to reduce that particular exposure in a gradual manner. Then as far as non-funded exposures are concerned, typical examples are bank guarantees, letter of credits, letter of comforts. Letter of comforts comparatively are reduced now, but again, buyer state has been permitted now, so letter of comforts have already started. Or LOU, you can say letter of undertaking. It's a kind of guarantee only which is provided. Now, as far as certain commonly used terminologies are concerned, we'll just run through certain terminologies which are commonly observed at the branch level. There are different types of loan. So typically, whenever you say that a particular loan is a demand loan, it means that there is a right for that lender to revoke that loan at any point of time. So a typical example is CCOD facilities. wherein if you go through the documentation part of CCOD, there is no time gap which is given by the lender to the borrower. So he can recall the loan at any point of time, that is demand loan. As far as bill purchase and bill discounting facilities are concerned, now both these terminologies are used commonly across the banking sector. Some banks keep on interchanging that. Typically, bill purchase and bill discounting facilities, you can bifurcate that into two parts. One is that clean supply of bills. What it means is that there is no guarantee or counter guarantee which is available. So it's purely on the basis of creditworthiness of the borrower. The lender will lend money against the supply which he has made to maybe his customers. And there is a bill of exchange and everything is there, but there is no guarantee which is provided by external party. So it's purely on the basis of creditworthiness of that particular borrower. Second type is LC/BD, wherein the bill discounting is backed by LC. So LC issuing bank will be the customer of your borrower. So when the borrower is supplying a particular goods or commodities or maybe lending services to that particular customer, the customer banks provides a guarantee in the form of letter of credit to that particular borrower by with certain terms and conditions that on a particular day or maybe after 90 days, 120 days, 60 days, whatever terms of credits are there. So those will be defined in the LC. Based on LC, the bank will discount that LC by way of correspondence, which is done with that LC issuing bank. So they will confirm that the LC is accepted, in the sense the bill discounting is accepted. And on the strength of that LC, the bill discounting facility will be extended. Now the difference between the first one, that is clean bill discounting, and this LC backed bill discounting is that as far as the exposure is concerned, in the first instance, the exposure is taken on the borrower. In the second instance, the exposure is taken on the bank. Now, the most trickiest question over here is when we typically differentiate, lending into two parts like secured and unsecured. In the second variety, that is LC/BD, as per the banking practice, it is always considered as a secured loan. In reality, there is no security which is available because you are taking an exposure on that other bank. Bank has not provided you any tangible security. They are just guaranteeing you that once the goods are supplied, the goods are accepted by the customer. Based on that, the documentation, which the borrower will submit to that bank. Based on that, they agree to pay you after say 60 days or 90 days. So practically, there is no security available. The banking practice is that LC/BD is considered as a secured loan. If you see the bifurcation in loans. Now the challenge over there is, in some rare cases, I will give the actual instance also. Like for example, as you are aware, 2 years back, Punjab and Maharashtra Bank, there were restrictions which were imposed. So there were LCs which were issued by PMC Bank, and those LCs were discounted by other banks. So when there were restrictions which were put in on PMC Bank, so the exposure was on the bank and not on the borrower. So with those banks, suddenly those loans turn into an unsecured portion. Now what really happens is, I'm little deviating from this topic to NPA topic. So let me just let me draw an inference over here. See, in NPA norms, what is defined is, if you are given a secured loan, and suppose your underlying security is reduced below 10% of your ledger outstanding, or if it depletes beyond 50%, either of that. So if it goes below 10%, your loan will immediately be marked as loss asset. Once you say that it is a loss asset, you have to make 100% provision. Otherwise, if it is a depletion of 50%, it will go into doubtful asset category, and then normal IRAC norms will be there. Now, in this particular instance, that so-called secured loan suddenly turns into unsecured loan. So the moment it turns into unsecured loan, there is no substandard DA1, DA2, DA3 categorization which is required. It will simply turn into a loss asset. So it will require the bank, that is the bank which has done LC discounting, to provide for 100%. So I just gave you the inferences. Whenever you are looking at advances, you need to go a little beyond the documentation. You need to analyze as to what kind of impact can be there in case if something goes wrong. Because your right to recovery is with the banker. And then simultaneously, your right to recovery is also with your borrower also. Because the documentations are prepared in such a way that there is a counter guarantee which borrower will also give you. But there is no tangible security which is ever available in case of LC/BD facilities. Because you don't create any charge, you are solely dependent upon that LC issuing bank. So just keep that in mind. See the documentation, satisfy yourself, and then ask a question yourself whether the secured unsecured categorization is correct or not, or whether you can draw some inference from some other circular or BR Act or any other act. Then the next one is about funded credit facilities and non-funded credit facilities. We already talked about that. Funded means wherever the lender is actually parting away with the funds. And non-funded credit facilities are typically in the form of guarantees. That is, one is bank guarantee, second one is LC, that is letter of credit. Then primary and collateral security, the bifurcation is that as far as primary security is concerned, based on value of security, which is given as the primary security, the banks will lend to that particular borrower. So for example, if you are giving a gold loan, and if the bank is having the practice to keep a margin of say 40%, so if the gold is valued at 100 rupees, the maximum permissible lending will be 60 as per the bank's policy. Now, as far as collateral security is concerned, it's a kind of a backup arrangement which is created by the bank. Now, where this primary and collateral will come into picture is whenever you are talking about drawing power and availability of security for sanctioning of loan, and in case of CCOD facilities for continuity of loan, then primary security is relevant. Whenever the loan turns into a NPA category, or whenever we want to see that what kind of security or what quantum of security is available, then you have to consider primary as well as collateral. So I'll give you an example. Suppose you have a CC facility wherein say 30% is a margin which is prescribed. So working capital gap is 100 rupees. So 30% is reduced. So 70 rupees is your drawing power. So if the limit is say 80 rupees and if the DP is 70 rupees, if the account balance is above 70 rupees, it means that the account is overdrawn. So let's presume that account is there wherein you are having a primary security of 100 rupees, but the account balance is 110 rupees. Now the 10 rupees portion may not be unsecured portion in case if there is a collateral security available. So suppose you have 100 rupees of primary security and 50 rupees of collateral security, the total security cover available will be 150 rupees, and accordingly your secured unsecured portion will be bifurcated, and based on that the provision will be done. Then as far as personal guarantee of borrowers and guarantors is concerned, typically this will come in place wherever there is a loan which is sanctioned to a particular institution. In the sense, in case of individuals, naturally personal guarantees are there. But wherever the banks are sanctioning loans to say partnership firms or maybe LLPs or corporates, then what they do is they take personal guarantees of the partners or directors who are regularly who are working directors. So it's a kind of again a fallback arrangement which they make. So the director or partner will sign in two capacities. One in capacity as a partner or director. The second, he will sign the guarantee bond or the guarantee related documents in the capacity as a guarantor, wherein rubber stamp is not used. So he signs as the individual. In other cases, the signing is not required to be done as an individual. Then fixed charge and floating charge, these two terms are always used. So let me just give you a simple example to distinguish between that. So I will again take an example of typical say vehicle loan. So in case of vehicle loan, the charge will be created or the security will be of that of a vehicle, which is a fixed charge. But in case of say CC facility or maybe a OD facility, the charge might be created on say future receivables or maybe toll collection charges, future collection of the toll in a particular toll company. So that is floating charge, wherein the distinguishing factor is simple. In fixed charge, you know the security is not going to change, like say gold, FD, vehicle. So these are fixed charge securities. Floating charge is typically where the security will keep on changing, but there is a charge created. Like for example, a bank might create a charge on all current assets. So the current asset will undergo a change. So it's a floating charge which is created and which will continue to have that charge over there. Then the term margin is used wherever based on bank's credit policy, there are margins which are decided. So depending upon type of security, the margins will vary. So for example, in case of say cash credit limits, typically when the cash credit limit is sanctioned, it is sanctioned at the strength of stocks and book deeds as reduced by trade creditors. So for stocks, typically the banks will keep a lesser margin because the realizability of stock is considered on a higher asset as compared to book deeds. So maybe you can have a 25% margin for stocks and maybe 40% margin for book deeds. But again, it is purely dependent on the bank. RBI has nowhere defined that what should be the margin related to that. So if a bank decides hypothetically to keep a margin of say 5%, it is very much permitted because it is based on bank's policy. And as an auditor, we are not supposed to challenge the bank's policy. So always make it a point that you are referring to the credit policy of the bank. So wherever any query is raised by you, you need to draw inference from credit policy of the bank. If you are looking at advances side, if you are looking at deposit side, still you have to go by the operational manual or deposit related policy which the bank is having, because it entirely depends upon the bank as to what kind of policies they have to define. And right now, frankly speaking, almost all regulations of RBI which they are issuing, all the powers are given to the bank. So they have the discretionary powers related to that. Now, what is not permitted also, let me give you an example. Typically, in case of cash credit limits, there were certain debates which were going on, and they're still going on, since many years, that about how to calculate the drawing power. So typically, as as a CA, as an accountant, all of us know that whenever you want to finance against working capital, it will be always a net working capital gap. It cannot be gross working capital. Let me give you an example. So typically, when the bankers are lending for cash credit, they will see 3 items of balance sheet. One is closing stock, so which will consist of raw material, WIP, and finished goods. Second one is book debts, that is the receivables from your customers, and the third one is trade creditors. And fourth and fifth is if you are given any advance for supply of goods, so advance given to your suppliers or advance received. So in all, there are 5 items. There are certain banks which say that creditors should not be reduced. Now, hypothetically, it might happen that you are having a trade creditor wherein the value of trade creditors is more than stock and book debts. So practically DP is not there, and practically finance is not required because your suppliers are financing you because there are trade creditors which are outstanding more than your stock. So some banks say that that is their policy and they are inbuilt in that policy. But all these banks, when they do a credit appraisal, when they calculate the maximum permissible bank finance, or when they take the CMA data, they go by the same method: stock minus creditors plus book debts reduced by margin. So nowhere any bank is practically doing the credit appraisal purely on the basis of only current assets, that is stock and book debts. Everyone goes on the basis of paid stock. That is paid stock means as reduced by the supplier, that is a trade outstanding. So even if bank is representing you in a different way, always go through the documentation part which the bankers have done. So if you come across an appraisal note which speaks about this methodology wherein stock plus book debt minus creditors is specified, you don't have to really draw any inference beyond that. The trade policy and other things are really irrelevant because the bank is following a practice wherein trade creditors are reduced. Then certain other terms which are used are sole banking, consortium banking, and multiple banking. The basic difference is that in case of sole banking, the customer is banking only with your bank. So there is no credit facility which is available from other bank. And ideally, there should not be any other operational accounts also with the other banks. And now RBI is issuing circulars related to that also. They already issued 2 or 3 circulars related to these banking facilities. The circular speaks about one fact that whenever a facility is available from a particular bank, that particular customer is not supposed to open account with other banks, so that there is no diversion of fund which is practically possible. Earlier, these instances were very common, wherein the bankers were not even aware about whether the parallel banking is going on. But now with the invention of technology, these things are very much possible, wherein the bankers are taking help of the data dump which is available in various forums, like civil data is there. So based on PAN, they match that. I have seen certain private sector banks on their own, they are sending notices to their customers wherever the current account holders are availing certain credit facilities from other banks, by saying that they come to know that there are certain credit facilities which that current account holder has availed from other banks. So there are so many actions also which the bankers have started. Then in consortium agreements or consortium arrangement, typically the borrower will have a joint kind of a lending which is done by multiple banks, that is more than one bank. And there will be a commonly executed agreements. So suppose there are 5 consortium members, all 5 bankers will have a single document in place. One of the banker will be called as lead banker, who will take care of all these, you can say, documentary compliances and monitoring part of that particular advances portfolio. In case of multiple banking, the scenario is little different. More than one bank is involved, and each banker will, or each lender will have their own set of documentation with the borrower. The most challenging part is about the multiple banking, wherein in certain cases it might be location-based multiple banking. So maybe depot A stock will take a loan from say State Bank of India, location B depot is taking a loan from say Union Bank, and in between the inter-branch transfer is not taken care by either of the bankers. So as an auditor, wherever you come across a case wherein there is a multiple banking facilities given, always pay attention to the fact as to how the bank is controlling that particular borrower account, as to what kind of control mechanism they are having. And in case of multiple as well as consortium banking arrangement, there is a mandate from RBI side to do an exchange of information amongst the banker. So it's not only for consortium banking but also for multiple banking, the exchange of information is mandatory. There is one more RBI circular which is issued related to multiple and consortium banking, that wherever the total banking aggregate exposure for a particular borrower is more than 5 crores and where more than one lender is involved, then there is a diligence reporting which is required to be done either by a CA or CS, who will be an external kind of agency. So there is a specific reporting format which is prescribed, which is required to be required to be compliant on a year-on-year basis. So wherever you are doing the audit, wherever you are doing a concurrent audit, verify that whether this diligence certificate requirement is fulfilled or not. There is a specific RBI circular related to that. There are around 20 or 22 questions are there which talks about operations which are there from the borrower side. Then as far as loan syndication is concerned, loan syndication gradually is evolving in banking industry. Just to tell you, simplest form, in loan syndication, the banker acts on behalf of that particular customer, that is the borrower, and he will syndicate different types of loans for him. So I will give you an example. So suppose there is a large corporate is there who wishes to raise maybe 1,000 crore of loan in a different, in different format. Maybe say 500 crore is required to be in bonds, 100 crore is required to be in preference shares. Then out of 400 crores, 100 crores might be in working capital finance and 300 crores is a term loan. So that particular banker will take a mandate from him and he will arrange for all these, lending requirement or borrowing requirement. So he will take care of bond, he will take care of preference shares, he will take care of working capital finance. He will bring bankers together and have a consortium form. So that is loan syndication, and he will get a good fee for that. So he will be kind of a financial expert for that particular borrower, and it's a kind of good earning. It's a earning avenue for the bankers also, because they get brokerage for that. So even 1%, 2% is more than sufficient to have that loan syndication becoming a profitable business. Then there is one more variety, that is interbank participation certificates, which are used amongst the bankers to share the credit assets amongst each other. And there are two types of interbank participation certificate. One is on risk sharing basis, another is non-risk sharing basis. And for both, the rates will be different. So let me give a couple of examples of that, and let me tell you why it is required also. So let me give first example. Like suppose a particular bank is running short of priority sector advance lending. That is, there are targets which are set by RBI, that how much lending should be there in priority sector. And there is another bank which is having surplus of priority sector lending beyond that particular percentage. So the other bank will sell off that portion to the first bank, and first bank can achieve that priority sector lending. So from second bank, that much portion will be reduced for priority sector advances, and it will be combined in the first bank. Now here it can be on the risk sharing or non-risk sharing basis also. Typically, this priority sector lending related participation certificates are always on non-risk sharing basis, because there is no appraisal which is required to be done. But wherever there is a variety of risk sharing basis participation certificate, the bank which is taking over that advances portfolio, they will have a due diligence exercise which is carried out, and then the advances will be taken over. So let me give you examples related to that also. So let's presume that there is a bank which is not having a good portfolio in say vehicle loans, but there is another bank which is having substantial portfolio of vehicle loan, and they want to reduce that particular reliance on vehicle loan. So they want to get out of that business. So they might sell off the entire business or maybe substantial portion of that business to the other bank by way of participation certificate. So the borrower per se will never understand as to whether his loan is sold off to the other bank or not, because the collecting agency will be the same bank. There is no documentation which is carried out, with the customer. It is within two banks. So one bank will take over the portfolio of other bank. Collecting bank will be the same bank. No change will be there as far as borrower is concerned. But only thing is that the risk sharing exercise will be depending upon what kind of terms and conditions both the banks are agreeing with. Naturally, for non-risk sharing, premiums are on the higher side. Risk sharing, naturally, it will be on the lower side. It will be purely negotiated based on quality of loan portfolio, depending upon what kind of due diligence outcome is received to that particular bank which is taking over the portfolio. Now we'll come to the appraisal part. Few important things which one has to go through as far as appraisal portion is concerned. I've just jotted down all the points. I just said that because of online modules, most of the things are readily available to you. All the questionnaires are available. But whenever you are looking at a particular file, your file verification should start from appraisal form, that is the application form, and which is received from that particular borrower. And first thing is that whether the application form which is received whether it is completely filled or not, including the purpose of loan. In many banks, the purpose of loan is generic, in the sense all the loans have the same purpose, like personal reason. Then for business purpose, business purpose is you cannot say that it is for business purpose. It has to be for a concrete purpose, maybe to purchase a fixed asset, or maybe to pay salary which are in arrears, or maybe to pay wage arrears, pay bonus, whatever it is, or to pay creditors. And the reason why I'm insisting on that is, if the application form is giving such kind of generic reasons, that will affect the priority sector categorization. So let me just give you a simple example. Like suppose there is a bank which is having a substantial portfolio of say gold loan. Typically in official area, gold loan is a very common thing. Gold loan per se is not priority sector lending. Priority sector norms are based on what is the end use of that loan. So bank might keep on telling you that it is for agricultural purpose, but if you see the application form, it talks about personal reasons, or maybe to repay the earlier secured loans. Now this is permitted as far as priority sector norms are concerned, but there are specific conditions related to that. So let me come to that point also, since you are talking about gold loans. In gold loans, now in most of the banks, the common practice is that they give bullet loans, in the sense it is repayable after 12 months. So after 12 months, when it is becoming due for payment, and there are again varieties in that also. Some banks are giving due dates for bullet payment for interest payment also. Some banks say that interest should be paid on monthly basis. Either of that. After completion of 12 months, on the same date, new loan is sanctioned and the earlier loan is closed. Sometimes the bankers are not vigilant enough, or maybe the earlier auditors are not vigilant enough. So there might be transfer entry also. If there is a transfer entry, you can simply classify that loan as NPA because it is evergreen. Ideally, the loan has to be closed and then the new loan has to be opened. Suppose you have your earlier auditor who has already pointed out this, then the banker will become a little smarter. So you will start showing cash withdrawal from the new loan and the cash will get deposited in the old loan. So there is no direct connect between that, but the security remains same. Now, in many such cases, in gold loan, the new as well as old loan, in the application form, the purpose might have been mentioned as personal need or repayment of earlier loan. So the purpose cannot be generic, it has to be very specific, and based on that, your master data should be filled in. So always make it a point that when you are doing a appraisal verification, that is advances verification, your each and everything which is mentioned in the sanction note, in the appraisal note, and in the application form, all these three things should sync with each other. And fourthly, it has to be in sync with what is filled up in the master data, because that has a ramification on other classification, that is the balance sheet disclosures which we talked about. Now, typically the documents which one should receive along with application are financial statements in case if it is a business entity. If it is not a business entity, if it is say a salaried person, maybe it might have salary slips or form 16. So to substantiate income, these documents are required. In case of borrowers who are corporates or there are business lendings are there, financial projections will be there either in CMA form or in normal financial projection form. Techno-economic viability study might be there for larger loans. Typically for smaller loans, they don't ask for that. Again, you have to refer to the credit policy as to where it is required and where it is not mandated. Details of associate concern should be there. Primary and collateral security details should be there. Board resolution has to be there. Then valuation of security has to be carried out. So wherever the security is taken and valuation of security is carried out, just go through the valuation report and analyze as to which kind of values are reported over there. There are typically three values which will be there in any valuation report. One is fair value, second one is realizable value, and third one is distressed sale value. Every bank has its own policy about which value should be picked up. The most logical way to pick up the value is that whenever you are doing the loan appraisal or loan sanctioning process, you can always go by realizable value, which is a middle one. You need not have to go with the fair value because fair value will be always on a higher side. Whenever the account will turn into NPA, ideally you should go with a distressed sale value, so that you need to be on a conservative basis. You need not have to go by distressed sale value at the time of sanction of loan, because that is the point. When you are on a positive outlook with the customer, you should not go by distressed sale value. But again, this has to be defined in the loan policy of the bank. If it is not defined, make it as a point for suggestion in your concurrent audit report by saying that there are three values, but your policy doesn't define which value should be picked up. Because the appraisal note has to be based on trade policy. It is rule-based appraisal which banker is supposed to do. So that is one thing which you can adapt. then title clearance certificates are required. In many cases, you will find that title clearance certificates are having certain disclaimers which are given. So there might be subject to, like, as we disclaim in our report, the title clearance report which is given by the advocates also has certain discrepancies. Make it a point to see that how those discrepancies are addressed in the appraisal note. Like suppose, just to give a simplest example or most common example is chain of document is not there. So whenever you are taking the security of a immovable property, earlier sale purchase agreements are supposed to be there with the bank. But it might happen that the chain of document is missing, or maybe one or two documents are missing. So the bank might have taken an indemnity from that particular borrower, that as and when the document will be available, they will submit that. Or he might give an indemnity by saying that he doesn't have that original document. Those are lodged with stamp authority, that is the registering authorities, and they are yet to be received. So in that case, the appraisal note has to mention this fact, that which are discrepancies were specified by in the title clearance report, how the bank is addressing those discrepancies. So the title clearance report need not be clean. If it is clean, there is absolutely no issue. But I have hardly seen any title clearance reports which are really clean. There are always certain ifs and buts which are always mentioned. So make it a point to see that how those ifs and buts are addressed in the appraisal note. Then any other licenses which are required to run a particular industry, whether the bank has taken those on the record or not. And there will be always inherent limitations on our knowledge also, as to which kind of licenses are really required for any industry. So to the extent possible, make it a logical attempt to see that at least basic licenses are there. Like suppose someone is opening a factory, typically pollution control board clearance is required. So the basic licenses are required to be there with that particular bank. As far as statutory returns are concerned, nowadays most of the bankers have started insisting on GST returns. And they take a copy of that, and typically they prepare a summary of that to justify the projections as well as the earlier turnover. If they have taken that, that is the best thing to happen. If not, you can give it as a suggestion. Another most vital point is that even for borrowers, KYC compliance is mandatory. There is no relaxation given from KYC compliance. Even the re-KYC is required for borrowers. Typically, where the bankers are doing an error is, suppose you are having a term loan. The term loan account holder may not have savings and current account with the bank. He can have only a standalone term loan, which is very much permitted. Now, if you look at the KYC norms, typically KYC norms specify the categorization of customers into high risk, low risk, and medium risk. Based on that, you need to do a re-KYC, like 2 years, 3 years, and 7 years. For borrowers, actually, typically the bankers never do a risk categorization. It's not required for borrowers in strict sense. At the same time, re-KYC is required for borrowers. So suppose you are having the CCOD appraisal process, which is an annual exercise. At least on alternate years, the KYC documentation is required to be complied with. But in most of the banks, the KYC documents are not available in the appraisal file. That is the loan file. So verify whether that particular custody ID is available in the system, and what is the KYC date related to that. If it is dating somewhere back in 8 years, 7 years, or 10 years, then you need to be vigilant about that. MSME registration certificates are nowadays most of the bankers are insisting on that, because they can simply classify all those accounts into priority sector lending. So this is the easiest way to do the documentation. So Udyamara is ideally expected to be there on the record. And next one is that you need to verify whether it is the loan which is given by the bank, whether it is in compliance with RBI norms and internal exposure norms of the bank or not. So there will be certain internal exposure norms which every bank has related to industry or related to type of loan. See that what is the system which the bank is following to ensure that there is no exposure norm violation which is taking place. Another vital point is that pre-disbursement inspection, verify whether it is carried out by the bank or not. And of course, post-disbursement inspection is also required. And just go through how the form is filled up, because in many banks, the form will be there. Most of the banks are having a single page inspection report format. So the inspection report might have been simply signed and it is kept in the file. But just go through that particular inspection report, look at the remarks which have been put in or not. If it is a blank inspection report which is found in the file, make it a point to directly report that into your concurrent audit report. I just add one more point about the reporting part. See, many a times you might have observed that the bankers' reactions are very casual. Whenever you say that the documents are partially filled up, or they are not filled up, the first reaction which they give is that you should tell us and we'll just have it filled up. But if you start reporting that into your at least draft report format, you can give them maybe 1 month or 2 month chance to improvise upon that. And from 3rd month onward, you can say that I am going to put up this remark in my report, unless you are complying that before that file is really handed over to me. And then you can insist that my remark will not be removed. The remark will be removed on the next year, next month, whenever the compliance checking part is there. The reason is that many times the bankers become habitual in just somehow disbursing the loan before that target date, because bankers are also given a target. So to fulfill that target, many times the documentation might have been filled up partially. So always ensure that you start reporting on that. Don't keep these things verbally. So initiation can be right from the initial stage. You can start sending emails to them. So that can be stage 1. If they don't improve, start putting that into draft report. And maybe you can remove that for a month whenever they are filling up in front of you. From 3rd or 4th month onward, you need not have to give that leverage to the bankers. You can simply go on reporting that. And you can always deny by saying that I'm not going to remove that because at the time of disbursement, the document was not filled up. So you can put forth your point very strongly by giving 1 or 2 opportunities before him. Then as far as disbursement is concerned, first, as we discussed, documentation is required. Then in case of corporates, ROC charge creation is required to be done. End use is required to be ensured. So to ensure the end use, there are ways and means to do that. One is of course post disbursement inspection. Another is that the original invoices and stamp receipts will be available with the bank. Then promoters' contribution is also required to be ensured by the bank. Typically, the bankers, in case of term loans, if you talk about 25% will be from the promoters and 75% will be from the banker. Now that source of promoters' contribution is also required to be verified. It shouldn't happen that there is a corporate loan and that 25% promoters' contribution is given by the bank itself by giving a personal loan to the director. That is something which is not supposed to be done in banking industry. Then sufficiency of insurance is next one, which you need to verify. And of course, in the insurance policy, the assignment of the policy in the name of the bank has to be there. And it will conclude when the post-disbursement inspection is carried out by the bank officials. Once the disbursement gets over, then the monitoring part will start. Now, monitoring part typically will start based on exception reports which are generated from the system, so that if there is something wrong going on in the account operation, that will get percolated out of that. Then stock audit is another way to do a kind of monitoring on large advances. Then branch inspection will be there. In most of the banks, they define the frequency of branch inspection based on type of advance and based on value of advance. So maybe for a critical account, it might be quarterly inspection, which is prescribed. Maybe for a smaller account, it can be yearly or half-yearly inspection. So go through the internal instructions of the bank and verify whether those instructions are followed by that particular branch or not. And at the time of renewal, again, all these things are always looked into that. But again, distinguishing between CCOD accounts and term loan accounts. For CCOD accounts, typically the limit is only for 1 year. So at every yearly intervals, the bank will go through with all these rituals. For term loan accounts, many times it happens that the bank may not revisit that particular borrower account in terms of verifying whether the business of that particular borrower is running smoothly or not. So if the bank is having a policy related to that, to do a kind of a short review, maybe after 3 years or 5 years for a long tenure term loans, then you can go with that policy. If not, you can give it as a suggestion. It's not a full-fledged renewal exercise which is required to be carried out. It is a kind of assurance kind of exercise which the banker can carry out, just to see that the business of that particular borrower is running the way it was expected at the time of sanction of loan. So many times the account which turns into NPA maybe after 2 years or 3 years, those incidents might get avoided because of this due exercise. As far as checkpoint for the auditors is concerned, first one we already discussed about checking of master data in CBS system related to loans which you are verifying. You are not expected to cover all the loan portfolio which is there in the master data. The loans which are sanctioned, renewed, enhanced in that particular month where you are doing the concurrent audit, you can verify the master data. Then through exception reports, you can pick up the accounts which are wherein the renewal is pending, and accordingly you can put in remark. Short reviews and technical reviews, just go through the process which the bank is following as far as master data changes are concerned, because short reviews and technical reviews are not renewals per se. So the typical CBS typically should have a facility to distinguish between renewals and short reviews, because otherwise the system cannot recognize whether it is a short review or a regular review. And whenever the bankers are extending the date of renewal through short reviews, typically most of the CBS systems are having a different menu. But a branch might use a menu for renewals. So if the renewal menu is used, wherein the date is extended, then these accounts will not get captured for NPA classification. Now let me just correlate that with NPA classification. As far as the NPA classification norms are concerned, if a CCOD account is not regularly renewed within 180 days from the expiry date, that is the original due date, then the account turns into NPA. Now suppose the bank does a short review or technical review, those short and technical reviews are not considered within that 180 days cap. So those are not really considered. So regular renewal is required to be done. Now suppose the bank uses the CBS system and changes that CBS system renewal date as a regular renewal date, it postpones that by say 90 days because of technical reviews. Then your system generated exceptional reports will go wrong. So you need to verify whether that short reviews and technical reviews are categorically captured in the system or not. Then second thing is that many times you will see that there are certain waivers which are given. So maybe charge creation, there is additional period which is given, or maybe personal guarantees drop, or the most common thing is that commitment charges are waived. So you need to verify that wherever the waivers are given, whether the waivers are given by the proper sanctioning authority or not. Just to give an example, if a branch manager wants to give a waiver for commitment charges, he on his own cannot do that. Someone hired to him has to give a waiver for that commitment charges. But many times you will see that the reversal entry of commitment charges is passed in the system on the basis that the branch manager has approved that. So he may not be having that sanctioning authority to waive those charges. So wherever any waivers are given, verify that whether the waivers were given by the appropriate authority or not. Then as far as certain discretionary powers are concerned, typically the banks are having a matrix of delegated powers. Go through the delegated power matrix. So for example, if the branch manager is having the power to allow overdrawing to the extent of 10%, it means that only overdrawing is permitted, change in limit is not permitted. There is a distinguishing factor between sanctioning a TOD or ad hoc limit and overdrawing. Overdrawing means above the limit to what extent the branch manager can sanction or pass the checks, or he can permit the account operation. It doesn't mean that he will be having automatic approving powers for ad hoc limits and TOD limits. That is different from the delegated powers which might be allocated to him. Then another thing is that in some banks you will observe that the field officer has put in some adverse remark and those are overruled by the sanctioning authorities. If that is the case, those are the relevant points for you to put it in the report, unless and until the sanctioning authority has given reasons for that. So it might happen that a field officer has observed certain adversities, but a sanctioning authority has simply overruled that without giving any justification. So make it a point to put in your concurrent audit report. Then sanction letter and appraisal note, both are required to be in sync with each other. So in appraisal note, if there are certain recommendations, same recommendation should reflect in terms and conditions of the sanction letter. And that sanction letter has to be accepted by the borrower. And borrower cannot accept a sanction letter based on subject to non-acceptance of 1, 2, 3 condition. That is something which is not supposed to be done. So if there is a waiver which is required, the borrower can always approach the bank can give the waiver. But the sanction letter cannot be accepted conditionally. If someone accepts the sanction letter conditionally, it means that the sanction letter is not accepted. If the sanction letter is not accepted, it means that the renewal process is not done. And then 180 days wrongs will be there and the account might turn into NPA. It has to be a clear-cut acceptance that the terms are accepted. Then as far as credit rating is concerned, there are two ways to look at that. Certain banks are having a policy wherein there is an internal credit rating system. So they award a rating and based on the rating, there is a basic rate plus that additional basis points which are added based on the rating and the rate of interest is decided. And it can be reset at periodic intervals based on the credit rating appraisal system. There are some banks wherein they rely entirely on credit rating system of external agencies like CRISI, ICRA, and based on that, they have the rate of interest module which is defined based on the credit rating. Then as far as financial projections are concerned, you can correlate that with what was projected and what is achieved and the reasons for non-achievement. Then as far as loan documentation is concerned, In certain banks, they have a practice of legal weighting of loan documents whenever there is exposure beyond a particular limit. So go through the internal policies of the bank. Like suppose the bank is having a policy that above 10 crore loans will be legally weighted. So they have a legal weighting and legal clearance certificate concept. So if that concept is there for you as a concurrent auditor, it comes as a kind of a handy tool, because typically the advocate will go through all the documents which are executed. Secondly, wherever the legal weighting is done, it doesn't mean that you shouldn't look at the documentation part. You can always have your own queries which can be raised, because advocate will be looking at documentation part from legal point or enforceability point of view. You will be looking at that part from financial point of view. So queries you can always raise. Banker cannot tell you that since it is legally weighted and clean report is there, there shouldn't be any queries. That logic doesn't work actually. It is based on your perception about the documentation part. Then as far as stamp duty is concerned, that will be applicable based on state stamp act. So wherever you are doing the audit or wherever the document is executed, to be specific, the stamp duty compliance is required to be made. Then CIBIL report, which is now common and most of the bankers are taking. So verify whether the CIBIL report is taken or not, and whether the CIBIL report is current or not. It shouldn't happen that a CIBIL report is 1 year backdated and that the same report is used by that bank. Confidential report system is there, but typically CR which is used, CR system which is existing or prevalent in the banker is not really effective. And the diligence certificate which I was talking about was because of this factor only, that the bankers don't exchange information with each other. Like there are typical formats of confidential report, that whether the account operation is satisfactory. I have never seen any confidential report which says that it is unsatisfactory. The reason is simple. The banker which is having unsatisfactory account operation, he will always like that account to move out of that bank. So no one will say that he is not performing in my place. He will say that that is satisfactory. And satisfactory is subjective actually. You can't draw any inference out of that. Then as far as NIAC committee recommendations are there, which are used by the banks for rate appraisal, I just made a passing remark of that. There are multiple committee reports are available. Frankly speaking, again, that is my personal view. Don't pay any attention to these committee reports. Those reports are for the bankers to evolve system of rate appraisal. Those reports are not applicable to auditors. All these reports are there for calculation of maximum permissible bank finance and methodology related to that. What we as an auditor need to verify is what is the bank's policy and whether the loan is sanctioned as per the bank policy or not. Suppose the bank policy is different or deviating from NIAC committee report, as an auditor, I cannot challenge that bank. I have to go by credit policy only. So these reports theoretically or as a speaker to speak are good, but as an auditor, those are not really relevant. For me as an auditor, what is relevance is RBI circulars, because these reports are not circular, these are committee reports. So RBI circular and banks internal policies, that is trade policies, loan policies, documentation policies are the relevant ones as far as concurrent audit goes. You can use this committee recommendation to substantiate your point, but that cannot be your starting point as to why NIAC committee is used. You cannot say yes or no about that. That is bank's perception. Committee reports are there to help the bankers. Then one point just to repeat, that always ensure that documentation is complete. It is not partially filled up. Then one question to all of you, since many of you must be doing bank audits at various levels. You must have seen that there are certain fill in the blanks, where the documentation gets filled up. And then the signature which is taken at the right hand side or left hand side of that. Have you seen that? Like suppose the rate of interest or name of the borrower or whatever it is. According to you, whether the signature is really required? It is required. No, it's a question I'm asking you. You must have seen this practice everywhere. That they fill up the fill in the blanks, like rate of interest, fixed plus floating or something of that. It's a very common practice wherein the signatures are taken. Why signatures are required? And suppose it is printed, then no, but signatures are there at the bottom also, but still we take additional signatures, right? So if it is printed, one need not read it. No, but if it is printed also, it one and the same action. not required. Exactly. That's what I was expecting. See, in banking, many things are going by practices. If you cancel that, or if there is an option to cancel a particular, like A and B are there, one is chosen and another is cancelled, then it's fine. Otherwise, it's not required. You can again revisit that. You can verify with the bankers and ask them as to why you are taking the signatures. 99% they will say that it's a banking practice. There is nothing beyond that. Even taking signatures at the end is also a practice section which is followed everywhere. I'm not saying that it is wrong or it is correct, but that's a practice which is followed. Let me tell you another practice before we go to the next slide. You must have seen vouchers which are authenticated by the bankers.
Correct, but there is a risk also. If they have written manually something in hand, and the signature of the borrower is there, and they can cut and they can change, then also the borrower signature is there. So,
but then it is always there, so you can change it also. Yeah.
Signing that means
correct.
Agree to that cut or that.
See, actually, there is a solution for that which bankers don't follow. There is a fair code of practice. We will go to that slide also right now, wherein every document is required to be shared with the borrower, which bankers rarely follow. Once you do that, actually, then all these things become irrelevant because you have shared the document which is filled in. These things are followed by certain banks, but the document is shared in scanned copy format and to that registered email ID. So there is evidence which is created. But otherwise, all these things are little clumsy. In the sense, you take a signature on blank paper. See, practically the signatures are taken when the documents are yet to be filled in. That is the reality. You must have seen that also in many files, like balance confirmation. They will have a bunch of that balance confirmation depending upon what is the tenure of that loan. So every year, one by one can be easily used. So all these are banking practices, but just think beyond banking practices as to whether it is there. Like the signature, that is authentication signature. When the check is passed, there is a officer who passes that, and he signs over there. You can never recognize the signature. Now, typically, the banking practice is that every bank officer or every bank employee, I should say, they have a standard signature. Like a signature card is there. I've never seen any bank wherein that signature card and the actual signature anytime really matches. So that's the banking practice. Some banks are having a practice wherein check is cancelled in the sense that it is sanctioned. It is passed. So all these are practices. You have to just observe and draw inference that those practices are uncommon. In the sense there is no commonality in those practices. But that's how the banking is. I just deviated, but I just thought that I will add certain points related to that. Now, as far as exposure norms are concerned, I will just quickly cover those exposure norms. There is a separate master circular on exposure norms. So the reference point is master circular. So for single borrower and group borrower, 15 and 40% of capital funds is the limit. Capital funds are tier 1 and tier 2 capital. In normal common parlance, it means the net worth of the bank. So overall net worth of the bank is 1,000 crore. So single borrower exposure is 15% of that, and group borrower, that is all related party combined, it is 40% of your capital. And as far as infrastructure loans are concerned, additional 5 and 10% are added. For single borrower, it is 20%, and for group borrower, it can go to the extent of 50%. Practically, no bank goes to the extent of 50%. If it goes, it is a prohibitive thing. What happened with PNC was that they have already crossed all those exposure norms. That's how the bank failed actually, because there was a concentration risk. As far as group borrower definition is concerned, it is nowhere defined in RBI circular. So one has to draw inference based on again what is the banking practice. There can be certain debatable issues as to whether the relative should be counted in that or not. If he is independent, financially independent. A normal thing is that as the auditor, what we can do is all related party disclosures what we give. In financial, we can presume that that is a group, unless and until contrary is proved that management control lies with someone else, ownership control is with someone else, or something of that sort. But otherwise, group borrower concept is required to be understood logically. As far as public sector entities, this concept doesn't apply. So there is no concept to apply group and individual borrower limits for that. LCBD, we already talked about that the LC issuing bank will be the one on whom the exposure is taken, but at times it might happen that a bank can discount its own LCs. So in that case, the exposure will be on the borrower. Like say SBI branch A has issued LC and branch B is discounting that LC, which is very much permitted. But in that case, exposure will not be on SBI because you cannot have exposure on your own. So the exposure will be presumed to be on the borrower. Now, why it is important is when you are calculating single borrower and group borrower exposure limits, LCBDs typically will get excluded because LC will be on exposure on the banker and not on the borrower. Till the time bank is into trouble, like PMC bank. Till that time, exposure will be always on the other party, that is other bank. Then certain exemptions which have been provided for exposure norms, that is accounts which are under rehabilitation. So you cannot exit out of those accounts. So those are naturally excluded. Food credit, which is a central government sponsored program, that is excluded. Central government guaranteed accounts are excluded. Advance against own FDs are excluded. Now, sometimes it might create a tricky scenario. Let's presume that you are having a single borrower exposure cap of say 100 crores. 95 crores are normal loans and 20 crores are say advance against FDs. So in all, the exposure is 115 crores, 95 plus 20. So here actually you should simply exclude that advance against FD because there is no exposure, there is no risk which the bank is taking. The amount is lying with you only. So the account will be within that exposure cap of 95 crores. You don't have to go by 95 plus 20. You have to simply exclude that advance against FDs. Then exposure to NABARD is not calculated. Exposure to NABARD is excluded even from unrated non-seller exposure norms. Then industry-wise exposure norms, practically RBI hasn't defined anything. It is left to the discretion of the banker. So sectorial limits, bank has to define. Real estate limit, bank has to define. Leasing, hire purchase, that 10% limit is given. But otherwise, if you talk about industry-wise exposure norms, it is a bank's own policy which will govern. So you have to go by that. Whatever the bank is saying for their own internal control, that will be the exposure cap. As far as the real estate exposure is concerned, what RBI has advised the bank is to frame comprehensive prudential norms. Policy has to be approved by the board. But as such, all these policies are internal policies. RBI is not intervening in operational part of banks. Always keep one thing in mind, RBI is a regulator. They can regulate the entities, they cannot dictate how to operate a bank. So if you look at any master circular, any master direction, operational part is never given. I will give a couple of examples. So for example, if you're talking about deposits, what RBI has defined is you cannot take deposit which is having a maturity period beyond 10 years. And that's it. And minimum is 7 days. So within 7 days and 10 years, it is the banker's call to decide what should be the criteria and what should be the rate of interest. Saving account, they have defined how to calculate rate of interest. Beyond that, nothing is stated. Rate of interest is at the discretion of the bank. Then bank charges. RBI has defined when bank can take the charges and policies related to that should be disclosed on the bank's website. Beyond that, nothing is stated. RBI is not prohibiting not to charge any bank charges. But let me tell you another issue about that. If you read the RBI circular carefully, there are always certain, not loopholes I should say, there are certain stringent norms which are there. Let me just spell out one norm related to bank charges, which rarely is followed by most of the banks. Let's take an example wherein minimum balance charges are levied. And let's presume that 5,000 rupees is minimum balance, which the bank has defined. And the minimum balance charges are say 100 rupees. Now, by common parlance, what we understand is whenever the account goes below 5,000, bank is permitted to levy 100 rupees on a month-on-month basis or maybe on a quarterly basis, depending upon what kind of rules they are. What RBI circular is stipulating, they say that bank charges should be proportionately taken. So suppose 5,000 rupees is quarterly average balance which is expected, and if the depositor has maintained say 2,500 as a quarterly average balance, and if the charges are 100 rupees per quarter, the banker can take only 50 rupees and not 100 rupees. Now, if this is inbuilt in the system, it is possible. If not, then manual calculation is impossible. So all these things are typically surface whenever the RBI is penalizing the banks. So recently RBI started penalizing the banks based on bank charges. Let me tell you another thing, even though I am little deviating from advances. There is one more reason why RBI has levied penalty in recent times is related to death claims. Now death claim comparatively is you can say risk-free area even for the auditors. Now the reason for penalty is that in case of a current account, proprietorship account, if the death claim is there, then from the date of death till that claim is sanctioned, saving account interest is required to be paid. So usually what happens is if there is a current account death claim, it is considered as a non-interest bearing deposit. So the entire amount is paid. Interest is rarely paid. But RBI circular is specifying differently that for death claim for current account holders, who are proprietors, in the sense individual current account holders, from date of death, and whenever the claim is lodged, maybe 3 years, 5 years, for that 3 years, 5 years period, the saving account interest should be paid. So whenever you are reading RBI circular, always just give a thought that whether it is compliable on the basis of CBS system which the bank is using. Otherwise, all these loopholes will be always there for non-compliances. Then for capital market exposures, typically it is defined wherever the primary security is in the form of equity, convertible bonds, debentures, equity-oriented mutual funds. If the collateral security is taken, it is not considered as capital market exposure. So suppose you are having an immovable property as primary security and collateral is taken as shares, it is not presumed to be considered as capital market exposure. But if the primary is short of that coverage, maybe say 70% is covered by immovable, so 30% portion will be counted for capital market exposure. Then as far as capital market exposures are concerned, there are norms for exposures which RBI has defined. So shareholding in the company, directly or indirectly, 30% cap is specified. Then overall exposure, which RBI has defined, is 40% of own net worth and 20% of own net worth for direct investment. Now let me just distinguish between that. It's 20 and 40. 20% direct exposure means treasury exposure which the bank will take. So suppose a bank is participating in equity shares, that is, they are the equity shareholders of a particular company, or they are holding maybe convertible bonds for a particular company, then in that case 20% cap is there. That is direct investment. Indirect investment is the one which we talked about, that is capital market exposures. So wherever the primary security is in the form of capital market exposure, or if the bank has given loan to stockbrokers, that is the one who is having primary business to deal in share market. So all those exposures are considered as overall exposures. So they will come in 40% cap. So overall, bank should calculate direct investment plus this indirect exposure, and indirect exposure can be in LCBG form also, that is non-funded base also. So together they should not exceed 40% of net worth. Typically, no bank exceeds that because 40% is a huge amount. No one gets into 40% capital market exposure, but these are the prudential caps which RBI has put in. Definition of net worth is given in RBI circular itself. It's a common parlance definition, nothing great about that. That what you need to exclude is accumulated losses naturally will be netted off, revaluation reserves because they are not realized, so those will be excluded, debit balance of P&L account, intangible assets, like suppose if there is a acquisition which the bank has done for other bank, there might be a goodwill which might be there in the balance sheet. Now whenever there is acquisition, merger and acquisition, many times that is put in not as a goodwill but as a cost of acquisition. So either of the terminologies which are used, those will be knocked off. If there is any specific or general provision is made, that is not considered as a part of net worth. So typical example is BDDR provision is not part of your net worth because it is done against a particular asset. But if you are having a contingency reserve fund, that is part of your net worth because there is no underlying specific liability which is arising against that. So that will be part of your main capital, that is net worth. Now, as far as the exposure is concerned, the word exposure is different from balance outstanding. Exposure means the drawable portion also is required to be factored in. So for term loan, presuming that the entire term loan is already disbursed, the balance outstanding has to be taken. But for CCOD, outstanding amount or limit, whichever higher concept is required to be factored in. So whenever you are talking about exposure norms or exposure caps, the exposure is in terms of drawable amounts. Then the challenging factor over here about exposure norms is, suppose you are having an ad hoc limit which is sanctioned, so it will be limit plus that ad hoc limit which should be considered for this exposure cap, and not only limit, not only the balance outstanding which is there in that particular account. As far as financing in equities is concerned, there are certain caps which RBI has put in. As far as physical form is concerned, theoretically RBI is having that because the circular is yet to be updated. But otherwise now in physical form, the securities no more exist, so that cap will not be there. So these are the caps which RBI is putting for exposures. It is not individual, caps in the sense these are not exposure caps per se on overall borrower size, but it is based on financing of equities. And financing of equities is also defined that whenever the advance is given against shares to individuals, so advance against shares is permitted only for individuals, not for corporate firms. The limit will be now 20 lakhs because now we are dealing only with demat securities. Financing for IPOs for individuals, it is permitted only up to 10 lakhs. Others, it is not permitted, it is prohibited. Then as far as financing for ESOPs is concerned, 90% of purchase price or 20 lakh, whichever is lower, that will be the considerable cap. Then there are certain prohibitions which are there. As far as advance against shares to other borrowers, so for NBFCs it is prohibited. It cannot be accepted as a primary security whenever it's given to other than individuals. Then for bridge loans also, it is permitted to be given only for 1 year. So suppose there is a company or if there is a corporate entity which is going for IPO and there is expected equity inflow there, to breach their cap, bridge loans are permitted, but it is only for 1 year and it is not for financing of equities. It's a term loan which is given for a specific period of less than 1 year. This I will just keep in because nowadays advance against securities are comparatively lesser, so you will not find this as a common thing. Advance against mutual fund also same logic extends. Whenever the equity oriented mutual funds are there, same exposure caps are there which are applicable to equity exposures. Debt oriented mutual funds, so it will be dependent upon the bank's policy. So what should be the margin and to what extent the bank can finance that. But RBI per se doesn't have any specific norms as far as debt fund based or debt mutual fund funding is concerned. Only one restriction is that the end use for financing against mutual fund is prohibited to be done for again subscribing to other mutual fund. So that cyclical change shouldn't be established, that you subscribe to one mutual fund, again take a finance and subscribe to another mutual fund. That is something which is prohibited by. Other restriction is advance against own shares is not permitted. So for example, if you're doing the audit of SBI, SBI cannot sanction loan against SBI shares. So that is categorically prohibited. Loan to directors of the bank is again prohibited except certain categories like advance against FDs, LIPs or government securities. Or if the director is an employee, he can avail the employee loans. Or with prior approval of RBI, the loans can be given to the directors. Industry producing or consuming ozone depleting substances, that is prohibited since long actually, it's still continuing. Then exposure to unsecured advances and guarantees. Now here actually the definition of unsecured loan is very vital. So whenever the loan is sanctioned, at the time of sanction of loan, if the underlying security is at least of 10% of sanction limit, then that loan is called a secured loan. All other loans are unsecured loan. And once the loan is categorized or tagged as secured or unsecured, the tagging is at the time of sanction and not subsequently. So subsequent norms are altogether different. The one which we talked about was if the ledger balance is the security is less than 10% of ledger balance. Now that norm is applicable only for secured loan. Unsecured loan naturally it will not apply because there is no security. So these are initial norms. Once the account is tagged as secured or unsecured, the tagging in balance sheet is also based on that, about secured and unsecured. Then as far as gold loan is concerned, I will just quickly cover that. As far as gold loan is concerned, when the gold loan is given, it can be given in the form of term loan OD, but if it is given in the form of bullet term loan, the maximum tenure is 12 months. You cannot go beyond that, and the maximum amount of exposure is capped at 2 lakh. There are ways and means to give this bullet loan kind of loan. In certain banks, they have an interest also which is repayable as a bullet. So after 12 months, the entire interest is paid. Some banks have a policy wherein principal is bullet repayable, but the interest is paid as and when it is debited to the account. So depending upon the bank's sanction terms, the behavior of account should be monitored. Another thing is that LTV is required to be maintained at least at 75%. And the moment you fall below that 75% LTV for bullet loans, the account turns into LP account. So that monitoring exercise is required to be carried out by the bank, and you have to verify how the monitoring exercise is carried out. You are not supposed to verify all the loans. It is beyond your capacity also, and it is not required also. You need to verify what kind of mechanism bank has established to ensure that it is always at 75% or below that. Then fair practice code to lenders, which we talked about. I will not reiterate entire thing. I will let me just tell you a couple of things about this fair practice code for lenders. Most of the banks have adopted that theoretically, but practically they have not even adopted 10% of that. What it really means is there has to be a transparency with the between the borrower and lender. So the borrower should know that what kind of interest will be charged to him, what kind of penal interest will be charged to him, what kind of bank charges will be levied on him, what will be the processing fee, what will be the foreclosure charges, Now in foreclosure charges also RBI has already clarified that whenever it is a non-business loan, that is personal loans are there, foreclosure charges are not permitted. They can simply shift from one bank to another bank. Even if it is there in the agreement, maybe 10 years back the agreement was specifying that still bank cannot recover that. But if it is a business loan, there are foreclosure charges which are permitted. But all these things are required to be communicated with that particular customer. Another thing is that all these things are required to be posted on the website of that bank. Now you go to any website of any bank, you will literally have to search for all those details if you really want to find it out. For example, if you want to find out what are the terms related to vehicle loans. In vehicle loans, they will give all conditions related to eligibility of loan. But that might, that bank website might be silent on foreclosure. They might be silent on penal charges. So all these things are required to be communicated with by the lender to the borrower. Another thing is that loan application also, it has to be dispensed of within a reasonable time. If it is rejected, along with reasons that is required to be communicated back with the applicant. Again, this is the gray area which most of the banks don't follow. They will take the loan application, they will verbally might say that your loan is rejected, other will not process it itself. So that borrower will naturally go to some other bank. But that is something which is not expected in this fair practice code. Yeah.
There is a loan application came and the bank has been.
There has to be a register. The bank has to develop that mechanism. So you have to ask the bank as to what kind of mechanism you are having. If mechanism is not there, your job is simpler. That you can simply say that the records are not maintained. If they are maintaining the record, you have to comment upon how efficiently they are disposing of and what kind of control they are keeping on that. Maybe a serial number or something of that. Some banks have good policy wherein the registers are maintained right from receiving of loan application till that conclusion of that. But there are banks which don't maintain or they have stopped maintaining also. But that is something which is mandated as per fair practice codes.
There is a loan application register or file should be there.
Actually, I will give you a suggestion. To begin with, you can first ask the question whether your bank has adopted fair practice code. So let them first answer yes or no. And then you can go to this particular part. It's available on RBI website. It's readily available. It has the entire checklist. And if you look at that, actually, it's a fairly drafted well. In the sense, it's a fair thing between borrower and lender. There is nothing like, there is no weightage for lender or borrower. It's a fair thing. Only issue is that bankers are not following under various pretexts by saying that sufficient time is not there and other things. But naturally, they are into business, so they have to do that. So, like, as CA, we cannot say that we don't have time, so we won't maintain any documentation. We can't say that. The same rule applies to bankers also.
Revenue leakage also, like item of revenue leakage, they rejected the loan application. There should be some charges. They should take.
It depends upon bank's policy. Some banks have a policy wherein at the time of application itself they collect the processing fee. Some banks collect it 50%. Some banks have a discretion. So it, yeah.
The processing charges has been taken over. But in case of loan rejection, whether the processing charges.
It depends on the bank's policy.
Yeah.
So if the bank says that it has to be collected mandatorily, you don't have an option. If they say that it is optional, then the branch manager has to justify as to why it is not collected. So same way for loan appraisal terms and conditions also, the fair practice code defines certain parameters as to what kind of documentation has to be there and how it has to be communicated with the particular borrower. Now, as far as documentation is concerned, typically the documents which you will come across in any file, I have just made a generic list, not a account specific list. There will be either a loan agreement or hypothecation agreement depending upon the type of loan. For guarantors, there will be deed of guarantee. DP note will be there, that is demand promissory note will be there. Continuing security bond will be there for CCOD account, so that all the securities which are taken as maybe collateral securities and that can be continued. Acknowledgement of debt, that is AODs, typically they will be there on annual basis. The timing might vary from bank to bank. Some banks might take it once in a year, irrespective of timing. Some banks might insist to take only at the March end, but that is something which is bank specific. Important part is that whether AOD is operated or not, so that see, the reason why AOD is important is, suppose there is a documentation defect is there, and if the account turns into NPA, and during the recovery proceeding, sometimes the borrowers might challenge the lender by saying that this was not signed by me, or I haven't availed the loan. So AOD comes into picture. So AOD is acknowledging that you have availed the loan. And secondly, if you haven't objected on that AOD, it means that the defects which are there in the documentation, which might exist, might be ironed out to a certain extent. So it's more of supporting in nature whenever something goes wrong in future. Then supplementary deed might be there wherever there is an enhancement of facility which might be there. Equitable mortgage deed might be there, again depending upon type of loan. General lien and set of letter is always taken, so that practically banker gets right to recover amount from deposits or any other assets which are there with the bank. Counter guarantees will be taken for non-fund based exposure. So whenever the bank is giving bank guarantee or LC to other beneficiary, they will take a counter guarantee from the borrower so that they can recover the money in case non-funded facility gets converted to a funded facility. These are the typical terms which are used: mortgage, pledge, hypothecation, assignment, set off, lien. So we'll just go one by one by taking simple examples, not getting into legalities of that. So as far as mortgage is concerned, there are two types of mortgage: English mortgage and equitable mortgage. Typically, we see equitable mortgage most commonly practiced in most of the banks, because English mortgage is something wherein the ownership practically gets transferred, so it is not that common. Example of mortgage is immovable property, which is taken as a security. So there will be a mortgage deed, that is equitable mortgage deed will be there. Then as far as pledge, hypothecation, assignment is concerned, typically pledge will be taken when the goods are in possession of the bank, like say FDs, gold, that is gold packets, NSCs, or maybe warehouse receipts where the goods are in possession of the bank. Hypothecation is the case wherein goods are not in possession of the bank, but a charge is created, like say stock and book debts, vehicles, plant and machinery. So the possession is still lying with the borrower. So in that case, hypothecation deed will be there. Assignment is only actionable claims like life insurance policies there, that is assigned. So it's only actionable claim wherein the bank creates a charge. Set off, as the name suggests, it's it is having an equal right to set off your obligation. So this is just a simple chart that depending upon type of security, what kind of documentation is required to be created. So suppose you are taking the security as a stock, so you will take it either as hypothecation or pledge depending upon type of security which you are creating. Gold ornaments, it will be pledge. Bank FDs, again pledge. Shares, pledge and assignment might be there. Again, depending upon, like for example, in case of NSCs, KVPs, there is assignment which post office will put in over there. Immovable property, naturally it will be mortgage. General lien and negative lien. General lien and negative lien, the distinguishing is that in negative lien, it's only a kind of a negative assurance which the borrower is giving you, that unless and until debts are paid off, he will not transfer that particular asset. So it's a kind of assurance which is given by him. General lien, lien is that wherein the banker is having a right to retain the goods and securities. So that is the distinguishing factor between general lien and negative lien. So negative lien is more kind of assurance which is given as we give to the stakeholders. Many times we give assurance whenever you are replying to certain certain questions or certain certificates. Just to give an example, suppose someone asks you in a branch that whether all RBI circulars are followed or not. So you give a negative assurance by saying that nothing has come to your notice. Negative lien is something like that. That they are just giving you assurance that unless and until the borrower gives you assurance as a lender that unless and until I pay you off, I will not transfer my particular security or goods. But it's only assurance. You cannot stop him. In the sense, he might transfer also because there is no charge which is created. It's only the negative lien which is created. Again, certain terminologies like pari passu, interest rate, first charge, second charge. First charge, second charge, I am sure that all of you are aware about that. First charge is first right of recovery. Second charge is once first charge holder is squared off, then only the second charge will come into picture. Pari passu is equal rights. So whenever a banker is saying that pari passu charge is created, it means that suppose there is already another lender which is having the charge over a particular asset, And if the new banker is creating a pari passu charge, both bankers are at par. That is, both lenders are at par. Inter se is between or among themselves. So inter se word is used typically in case of consortium agreements, when multiple lenders and lenders are involved with the borrower. So inter se agreements are executed. Now coming to the monitoring of advances part, I will just put in certain bullet points because we discussed already that briefly. Most of the banks are nowadays having centralized monitoring departments which monitor the behavior of accounts. Because those days are gone when check passing and other things were monitored by the bankers. That is not practically possible because check passing is done by CPC. Account is maintained at say branch A. The operation of the accounts will be carried out from branch B. Branch C, that is the CPC, will pass its check. So practically no one can monitor any account from a particular branch. So in most of the banks, they have centralized monitoring departments. They are using various tools like say CAT tools are there, which are ideally supposed to be used by all of us. But most of the times the bankers rarely permit you to first give the data, forget about using the CAT tools. But bankers have already started using the CAT tools to draw inferences, behavioral inferences out of the data dumps which are available. Generation of exceptional report is another way to monitor the account. And naturally, unit inspection and stock audits are the last resort, wherein the actual visits are carried out either by the external agencies or maybe by the internal personnel of the bank. So that's how the accounts monitoring will be typically done. One of the factor or one of the contributor for account advances monitoring is concurrent auditor also, because he's sitting at the branch and he's looking at all the accounts. What is expected from you is typically in case of CCOD accounts, it is expected that on the monthly or quarterly, depending upon frequency of your audit, you are supposed to go through the ledger account operations of each and every CCOD accounts just to see that overall account operations are adequate or not. Adequate in the sense there is no negative element which is involved in that. You are not supposed to verify each and entry related to that. You are only just have to oversee the overall accounts. The last part about IRAC norms, maybe I can cover up in 10 to 15 minutes because the topic is really vast one. I will share my presentation so that you can have it. Let me just briefly cover about the basic norms. First thing is that now master circular is already there, so you don't have to go back and refer to multiple circulars. So you have to just go to 1st April master circular. All earlier circulars have been already incorporated. Before this, any speaker or anyone who wants to refer that also, they have to refer to 3-4 circulars. Now it's combined one, and hopefully till now at least no other additional circular has been issued. So hopefully no changes should be there. And for agriculture advances, you have to refer to October 18 circular, which is related to relief measures for accounts which are affected by natural calamity. Distinguishing part between these two circulars is that in case of agriculture advances which are restructured, the accounts can still retain the class of asset as standard asset itself. So that is by way of October 18 circular. Normal restructuring is by way of April 22 circular. So both are different. So suppose a natural calamity has happened, restructuring of advances has taken place, but if the account which is restructured is not agricultural advance, then the account will turn into NPA. But let me tell you other way around. Suppose there is no natural calamity which has happened. Just to draw inference, like COVID-19 was not declared as a natural calamity. So under COVID-19 circulars, the restructuring was possible with retention of class, that is standard asset continued to be under standard asset category. That benefit was not available for agriculture advances. In fact, COVID-19 circulars categorically stated that this is not applicable to agriculture advances because October 18 circular is already there. But COVID-19 was not declared as natural calamity. So those benefits were not extendable. And natural calamity is something which has to be declared as natural calamity. You cannot draw inference. In the sense, the respective government authorities has to say that there is a natural calamity in a particular area, then only the benefit of these October 18 circulars are available. Now, as far as IRAC norms are concerned, the basic objective as to why this income recognition and asset classification norms are there is from 2 points. One is income recognition and second is provisioning norms. So broadly speaking, when you talk about asset types, one is performing, that is standard asset, another is non-performing asset. So all accounts which are not non-performing, those are standard. So let's look at what is non-performing. So one way to look at that is there are multiple multiple tests which RBI has specified in the circular that when to classify an account as NPA. Like say overdrawing more than 90 days or not paying dues beyond 90 days. So those are normal norms which are there. Those are standard norms. But a very important norm is that whenever there is an account which you as the auditor, if you feel that there is a higher risk which is involved than normal banking risk, you have to classify that account as NPA. Let me give a couple of examples of that. So let's presume that you are having a project loan. Now, project loan is something wherein a loan is given by the bank to start an economic venture or economic activity, like say factory, hotel, hospital. Now, in that case, there is a DCCO which is defined, that is date of commencement of commercial operation. What it means is, suppose today you have sanctioned a loan to build up a hospital, and it is expected that after 3 years the hospital will be operational. So today we are in 2022. So in 2025, the account, in the sense the hospital has to be operational. Or suppose it is a factory, you can say that after 3 years the factory will start a commercial operation. So the DCCO is always predefined. Now, if the operations do not start on that particular date, then that account turns into NPA. The reason is that there is a higher risk now which is involved. Now, what is normal banking risk? Normal banking risk means the risk associated with lending business. I will give you an example of normal risk of lending. So suppose, person A lends money to person B, who is known to him, who is a very close friend of person A. So there is an inherent risk which is always involved that B will never return back money to person A. So that is inherent risk. Bankers are into the business of lending and borrowing, so that inherent risk will always exist. So this is normal banking risk. More than inherent risk or more than normal banking risk is due to certain parameters, like DCCO is not achieved. So if the commercial operation doesn't start, repayment cannot really happen because income generation activity is has not started. So the account will turn into NPA. That is higher risk. Let me give another 2 examples. The one we already discussed earlier. That suppose you are having advance against say immovable property. So 10 crores is my property valuation, and I am maintaining a margin of say 50%. So 5 crores is the advance which is given by me. Later on, maybe after 2 years, the property is again revalued, and now the property valuation is say 4.5 crores. So there is a depletion in valuation beyond 50%. That is, deterioration is beyond 50%, which is an abnormal event. It means that now there is a additional risk which is involved with that particular borrower account. So even if the account is within limit, still that account will be marked as doubtful asset category. You have to consider that as an NPA. Let me give you a third example. If you are having a secured loan and if this underlying security is less than 10% of your ledger balance outstanding, the account will turn into loss asset category. So even if the account is regular in repayment, but security adequacy is not there, it is below 10% of your ledger balance, there is additional risk which is involved. You have to mark that account as NPA. So that is called as higher risk than normal banking risk. So always keep this second factor in your mind. So whenever you foresee that there is an inherent risk which is involved, you can go beyond RBI norms and mark that account as NPA. Like suppose the factory is shut down, or if there is an earthquake and the entire factory is demolished and there is no backup arrangement which is available, you don't have to wait for 90 days. You know that there is no income generation activity which is going to start. You can immediately mark that account as NPA. Or if you foresee that there is no income generation activity, the factory is running at only 10% capacity. Somehow it is managing and repaying the loan, but the loan is repaid out of borrowed funds. Maybe directors are infusing the funds in that company. There is inherent risk. You don't have to wait for overdrawing beyond 90 days. You can still mark that account as NPA. We'll just quickly cover basic norms. So as far as some loans are concerned, if there is a interest or installment which is overdue for a period beyond 90 days, the account will get marked as NPA. Now let me tell you what has changed as compared to last year. Earlier there was a concession which was given in para 2.1.3, wherein if there is a moratorium was granted for principal repayment and only interest was payable on as and when basis, there was an additional period which was given. So in such cases where the only interest repayment was expected, the interest in a particular quarter, if it was not paid in next quarter, then only the account used to turn into NPA. So it was going little beyond 90 days. So that concession has been withdrawn from 31st March 2022. So normal 90 days norms are applicable uniformly. Now what should be called as overdue? What RBI stipulated is every bank has to communicate to the borrower that what is his repayment schedule. So whichever repayment schedule is given, on that date, the borrower is supposed to repay that particular amount. If he doesn't repay on that date, at the end of the day, that account becomes overdue. So just to give an example, 31st, every 31st, that is month end, if there is an installment which is due, if the installment is not paid on that date, the account is overdue. Now, how to calculate that is, in case of term loan, there will be an ideal repayment schedule which will be given. Now, that ideal repayment schedule is based on presumption that exactly on the due date, the borrower will repay that amount. And based on that, ideal DP is calculated. DP in the sense, ideal balance outstanding. So when you want to calculate overdue amount for term loan, you have to compare ledger balance and compare that with ideal DP of that particular date. And the difference, if it is adverse, it means that the account is overdrawn. So whenever the adverse balance is, I will just take an example. Like suppose a ledger balance is 100 rupees, ideal DP is 80 rupees. It means that 20 rupees is overdrawn. Now this 20 overdue amount or overdue amount, you have to consider that as to whether it is outstanding for more than 90 days or not. In the sense overdue more than 90 days or not. So suppose your EMI 6, so it means that 20 by 6, so it is 3 point something. So fourth installment is overdue. So fourth installment is overdue, so naturally it is beyond 90 days. Now if it is say less than 3, so let's presume that 20 rupees is overdue and say 7 rupees is my EMI. So it is 2.9. Now in 2.9 also 90 days norm might be breached. Now let me tell you how it can be breached. Now let me give a little background about that. Almost in last 2 years, most of the banks were calculating this NPA marking and other exercises only at a quarter end. So 90 days was more relevant only for March end for most of the auditors also. Now what RBI expects is at every end of the day, these norms have to be checked. Now let me tell you where the loophole is. Typically, in in normal parlance, what we say is if it is more than 3, you have to mark that account as NPA because 90 days means 3 months. So up to 3 months, it can be still considered standard. So suppose 2.9, it is below 3, so it can be standard. But let me give you a practical example. Let's take example of today's date, 13th August. Now 13th August, let's presume that you observe that say 10th is the due date, and on 13th you are observing that 2.7 installments are overdue. So you start going backwards. Now these 90 days norms will get breached whenever there are 31 days in a month. So suppose August, July, or say if you go backwards, July, June and May. So in all we are having 92 days. So third installment also will cross 90 days. So that's where many times the software might be having a flaw wherein they might be having a logic based on more than 3. So you have to test the software. You have to test that whether the software is behaving the way the RBI is expecting the banks to mark that account as NPA. There are certain softwares wherein the overdue report which is generated, that is a defaulters list. So there is a column that overdue sins. You must have seen that. Overdue sins column is also wrong in certain softwares. I will tell you how it is wrong. So suppose you are having 2.5 installments overdue. So the software, depending upon the acumen of that software developer, will behave based on that. So sometimes the software developer might say that 2.5, it means that if I convert that into number of days, it will be 30 plus 15, so 75 days. So you might go backwards and just put in 75th day, which is wrong because ideally it is third installment. So you have to go backward and see that what is the third installment due date is there. Then you have to calculate 90 days, which might cross that barrier in the third installment itself, wherein it is 31, 30 and 31 concept, that is number of days in the month. So just pay little attention beyond these norms which are specified, because now everything is automated. So you have to verify whether the automation is working or not, and then you can draw the inferences. Then exception to this rule is if there is a moratorium period granted for repayment of principal as well as interest portion, there won't be any amount due. So naturally they will be out of that picture. Bill purchase, same logic. That is, if the discounted if it is overdue beyond 90 days, the account will get marked as NPA. Agriculture advances, 90 days norms are replaced by duration of crop. So if the underlying agriculture loan is given for short duration crop, it will be for 2 crop seasons. It has to be overdue. If it is for long duration crop, it will be 1 crop season. Crop season is defined in RBI circular. It is basically it is from period up to harvesting of the crops. And if it is more than 12 months, it is considered as long duration. If it is up to 12 months, it is considered as short duration crop. In metro cities, these loans are rarely found. But otherwise, whenever you are going for statutory audits in any other area, these loans are not uncommon. For timing, I will just keep this particular portion. We'll go to cash credit accounts. As far as CC accounts are concerned, if an account is considered as out of order due to fulfillment of any of the 3 conditions, then the account will be considered as NPA. Now there are 3 conditions. First condition is if the outstanding balance is continuously beyond your DP or limit, whichever is lower, then if it is more than 90 days, you have to mark that account as NPA. If there are no credits in the account for last 90 days, then you have to mark that account as NPA. If the credits in the accounts are not sufficient to cover the interest which is debited in that particular period, then the account will turn into NPA. First one is fairly simple to understand. Second one is also fairly easy to analyze because there are no credits, so you don't have to really calculate anything. Third one is that suppose today you are doing the calculation of NPA because now at the end of every day you have to do NPA marking. So suppose today is 13th August. So 13th August is 90th day. You have to go backward. And maybe last day, earlier date might be July, June, May. So it might be say 14th May or 15th May, the 90th day. So 15th May till 30th August, you have to take credit summation and you have to compare that with interest debited in that account in that period. So May end interest, June end interest and July end interest, you have to take a summation. If the credit summation is more than this interest, the account is PA. If it is less than that, the account is NPA, and this has to be verified on day, everyday basis. So it can keep on changing. Now the problem over here is once an account is marked as NPA, you can upgrade an account only when all the discrepancies related to that customer are fulfilled. So let me give you an example of that. Suppose due to this last condition, an account is getting marked as NPA. So the easiest way to get out of that is you can deposit certain portion. So your credit summation is more than interest, account is PA. But suppose that particular CC holder is also having a term loan account wherein one installment is overdue. So that one installment overdue also has to be nullified. So at custody level, there should not be any overdue portion, then only the account can be upgraded. So partial recoveries, subsequent recoveries, like if you're doing a balance sheet audit, in April the account has got closed or recoveries have been made in April, the account will get upgraded only in the month of April, not in the month of March. So always pay attention to NPA upgradation, partial recoveries, subsequent recoveries, regulation of one account but keeping that another account overdrawn, that is not permitted. Fortunately, this was a point of debate till last year, or I should say last to last year. But in 21-22 financial year, RBI came out with circulars which are very categorically clarifying all those doubts. In fact, what should be considered 98 days is also clarified by RBI. I don't know who has asked them this question, but even that is clarified. Subsequent recoveries is clarified. Partial recoveries are clarified. Other account discrepancies are also clarified. So, frankly speaking, whatever has been institute as a CA institute or as a auditors, all of us have been saying in black and white in guidance note that is now coming by way of RBI circular. So, if you just want to have academic reading, just compare earlier circulars with the latest circulars, and all these clarifications are now inbuilt in that particular circular. So, ideally, now with the NPA norms, with automation, the ideal way which RBI expected was that there will not be any addition of NPAs in in MOC, in statutory audit, or ideally even the concurrent auditor should not have any account which he has identified as an NPA and which the banker is not able to identify as NPA. But the reality is far away from that, for the simple reason that these conditions are not built in the software. The softwares are not foolproof. So never rely on the software blindly. You test the software on your own. You just visualize which kind of scenarios might exist, and then verify whether the software is behaving the way you want that software to behave or not. Because ultimately the softwares are developed by software engineers who are neither bankers nor CAs. So there is a limitation on what one can develop unless and until everything is told to them. And the way RBI is changing the circulars at almost every quarterly intervals, or I should say monthly intervals, frankly speaking, CBAs are not able to cope up with that. So many times the kind of reporting which RBI is expecting from auditors and bankers, the softwares are not able to generate that kind of reports. The granular data itself is not available, but in RBI circular it is stated that bankers should ensure that the entire granular data for reporting should be made available. So just pay attention to those wordings, quote from those master circular as to what is RBI's expectation and how the bank is not able to fulfill that, so that your reporting will be meaningful. And if the banker is replying you that this is not possible, then you write down that banker is saying that it is not possible, rather than accepting that fact, because that is something which bank has to comply, not we as auditor has to comply. So with this, I will just conclude the session. Sorry, because I couldn't conclude the IRAC part, but I will ensure that the presentation is shared with all of you. And thanks to all of you for patiently hearing. And sorry for extending my session a little. If any queries are there, maybe for 5 minutes we can take up the queries.
Yeah, we can pick up the few questions. If you have anything, please do that.
Yeah, sure.
So I had one query regarding non-fund based limits account. So there is general conception of having to calculate commitment charges. So for that we have to take total of both fund based and non-fund based limits and whatever the unutilized part is that on that portion we charge. So fund based is easy. It's the average method. But how do we calculate for non-fund based?
No, non-fund is the same concept. Like suppose you are having a non-fund based limit of say 10 crore for say LC, and LC is taken for say 2 crores. You have to go by average actually. For how much period LC is like. So if it is 2 crores, then the balance will be commitment charges. Yeah, but it will depend on, see, there you see what you need to do is firstly you need to see the sanction letter, whether it is specifying about commitment charges on non-fund based limits also. Presuming that it is there, then the next thing which you need to verify is that how the bank is calculating commitment charges. If it is manual, comment on that. It is a manual process. It is not supposed to be manual process. So CBS has to calculate. Now, once you say that CBS has to be calculated, CBS should be equipped to capture the data related to non-fund based facility. Nowadays, all CBS are equipped with that. Initially, there was an issue with non-fund based facilities with most of the CBS system, but now that issue has been resolved long back. So they have all the entire data available with it. Many times the issue is that the commitment charges tagging actually it has to be made yes in master data. That is a real issue. If they say no, naturally the commitment charges will not be calculated by CBS system. So you inquire with the bank as to how they are calculating commitment charges. If they say manually, that's a good point for you to put in the room.
Any other question?
Thank you, sir. Thank you.
I think one more excellent delivery from Dhananjay. And as I confessed in the initial remark, definitely it's difficult task to cover both the topic in the given allotted time to him. Also, we started almost 20-30 minutes late. So all in all, I think a very good session. We'll be uploading the recording as well as the PowerPoint presentation of all the speakers on the website of WRC. With this, I request my colleague in council, CA Pinky Kedia, to propose a very well-deserved vote of thanks for this session. Thank you, please.
First of all, thank you, Ketan Bhai, to give me a pleasant task to give a hearty vote of thanks to CA Dhananjay ji. It's my pleasure to hear him on the topic advances. Advances is very vast subject, and how he delivered in less than 2 hours, it's very much commendable. And he covered all the minor aspect of the advances also. Because of time constraint, he can't complete his PPT. But whatever he delivered with minute details and with his practical experience and all the, I appreciate the way he delivered the subject. And I request you all to carry this good round of applause to give him more thanks. कभी जब क्वेश्चन नहीं आते ना तो मेरे दिमाग में 2 चीजें चलती है, या तो सबको खाने की जल्दी है इसलिए क्वेश्चन नहीं पूछ रहे, और या स्पीकर ने इतना अच्छा बताया है कि सबको अच्छे से सब चीज समझ में आ गई है. तो आई थिंक यहाँ दोनों सब चीजें कंटिन्यू हो रही है क्योंकि हम बिफोर द ब्रेक है, तो आई डोंट वांट टू टेक मच टाइम ऑफ योर एंड वी कॉल अ लंच ब्रेक. जितनी जल्दी हो सकता है आप आ जाइए 45 मिनट में, आई थिंक, बिकॉज 1 hour का लिखा हुआ लंच ब्रेक, बट इफ वी कैन डू अर्ली बिकॉज वी आर रनिंग लेट 15 minutes we can cover in our next session. Thank you all.
So let's assemble at 3 o'clock for the next session.
clear the money.
TCS, so TCS takes like people like them.
So that duty test, it has the logical engineer. In that I got the last year.
So you like, do you go to office or you work?
3 days work from office, 2 days from home.
It's office of TCS.
Because
That's it, go there.
execute activities as well, just my second online training. Before this, before the industry. I didn't beat you, but I know you might. Yeah.
I also didn't notice that day. Almost everybody.
We were on the 7th floor, and there was some floor shifting or something. The bar floor was kind of left out. At the end, everyone was playing at the place, on our and stuff. They was proceeded. But after all, they were happy. And like so many interviews.
Good. Great day for the Satyavara. No, not that. 5 years. Hello? I think traditionally. The previous one. Document 21. June 29. Yes. Actually, not at all. धीरे धीरे चेंजिंग
पिछले सेशन में ना मैं नीचे नहीं हो रहा था, मैं यहाँ के नीचे थे। गुड आफ्टरनून। आवाज नहीं आई? गुड आफ्टरनून। हाँ लगे ना खाया हुआ। Now it's time to check the other than advances sector. Okay, in our previous section, we learned how to check the advances, what precaution we have to take care at the time of checking the advances or verify the advances. Now, part is other than advances, which is also equally important in a bank audit. Nowadays, I think in almost all the bank, there is a system of daily voucher checking. We have to send our staff on daily basis to check all the details and all these things. So what the precaution we have to take care, and what the things we should check ourselves, not believe on our staff and all these things. We have our CA Parag to brief us on this matter, and to introduce him, I request Palak. Please, Palak.
Hello everyone, good afternoon. After a nutritious break, after a nutritious lunch, let us continue our session. So I would like to welcome the next speaker, who is a partner with Bharti Boy and Purohit, chartered accountant since past 15 years, managing a team of 100+ staff members, which has successfully carried out audit, internal management, information system, forensic audits of large public sector companies, banks, insurance, public and private limited companies. Being a member of ITI group, he has been contributing in preparing the guidance notes on audit of banks since past several years. Also, he is a member of expert committee of ICAI of banking committee formed to answer the questions and bank branch audits. Regarding his education, along with CA, he is also a certified internal auditor for internal auditors, along with diploma in IFRS and visa from ICAI. Also, he has completed a course on forensic audit and concurrent audit. Also, moreover, he has passed the limited insolvency examination. He is also peer reviewer of ICAI. Also completed a course of ICAI SVBI on data analytics and database management. Being a personality with such a great experience, let us now welcome him, Mr. CA Parag Hangekar, who will guide us on verification of other areas other than advances in concurrent.
Thank you, Parag. And now I request Dhananjay to give a memento to our learned speaker as a token of our
Good afternoon, everyone. So I believe you had two great speakers in your first and second session. So I think primarily what exactly is concurrent audit, and how you need to plan and all those things. I think Abhijit must have covered in detail. And advances, no doubt, Dhananjay is a great speaker. So I think most of the points on advances. So because concurrent audit mainly, there are two main aspects in concurrent audit. First is the advances, that no NPA should be slipped back, and the other is on the revenue part. So mainly main objective of concurrent audit is always advances and on the income side. And other than miscellaneous, all the housekeeping and other returns, day-to-day verification. So nowadays, as you are aware that more and more type of reporting is expected from us. And verification, as you know, concurrent, you cannot do any sample testing. It's a 100% audit. So daily attendance, and nowadays, since most of the banks are on the online platform, so when you log in, the attendance gets marked. And again, partner visits. So all the more, the responsibility level, which was there maybe 10 years, 15 years back, if drastically changed, because now there are more and more expectations from the concurrent audit that he is supposed to detect each and every fraud. He is supposed to detect any kind of income leakages. There should be no NPA which should not be undetected by him. So and moreover, for article students, I believe that it gives you a very good platform to learn, because if you have done concurrent audit as well as a statutory branch audit, so you will understand that at the year end you hardly get five days, at the most a week, to complete the statutory audit of a branch. But here you have ample time where there is a lot of scope of learning. So maybe it seems boring for maybe article students, because a lot of times even my articles keep on telling me that we need a change. But I keep on telling them that whatever time is available to you, because the entire year you are at the branch. So each and every transaction, each and every activity, you have ample time to go deep into it, understand how exactly the transaction is taking place, what are the different documents underlying the transaction, what are the authorization levels, how the systems are working, all those things in concurrent audit, it's a very good learning platform. So maybe with that background, so today's topic for me is verification of other areas in concurrent audit. So actually banks expect that, everything under the sun, whatever is applicable to a bank, everything needs to be checked by the concurrent audit. So let us see, based on my experience, I have tried to gather different areas whereby, we can keep on interacting also. If you have any issues or any doubts, maybe we can have a very healthy interaction on that also. So first is on the income verification. So interest income on cash credits, ODs, demand loans, term loans, bills purchased and discounted, overdue and penal interest, interest subsidy. So most of you, are you involved in concurrent audits, or it's just for you first time, or how is it like overall? Can I get a show of hands that who are practically involved in concurrent audits? Okay, so you must be aware that how is the interest getting debited to the borrower's account at the month end. If you see the month end, there is an entry, and the interest run cycle is run by the IT department centrally, right? Branches are not involved in that. So if you have any query at any point of time regarding interest, suppose you do a verification, or if you ask them that, okay, you please show me how this interest is debited in this account, or on this deposit, or on the advance, or any kind of bills. So their standard answer will be it's run centrally, and we are not involved in it. So in that aspect, what do you feel that as concurrent auditor, what is your role? To detect any interest leakage, or as a concurrent auditor, our main role in this aspect is to check the parameters in the borrower master file. Suppose if the sanction letter says that a cash credit account to an account, suppose XYZ, is 8%, but while preparing the master, the branch officer by mistake, if he enters 7%, so then every year by year, month by month, 1% leakage is always. So always make it a point that in your period, suppose if you have started, your tenure is starting from maybe 1st of April. So at least in that month, whatever advances have been sanctioned by the branch, make it a point that the entire section terms, the repayment schedule, the DP limit, sanction limit, the rate of interest, whatever other terms are properly captured in the CBS or not. See, because during central audit, when we interact with the audit committee, most of the times when we come out with our observations to the audit committee, to the board members, the first point what they ask to the bank, what happened, why the concurrent auditor could not detect this. So when a central auditor, suppose we go on a quarterly basis to audit some top 20 branches, and then we have at least 8 to 10 MOCs only on income leakages. So that means definitely there is some lapse by the concurrent auditor. When our team goes there, sits there for a week or so, and if they are able to identify the rate of interest which is fed in the CBS is not matching with the sanction, this actually should have been identified by the concurrent. So that is why, the first step is always that whatever sanction terms are there, that properly have been entered by the branch in the CBS or not, that should be the first step. Second is there are different types of commissions and fees which the branches recover from the borrowers. So I have listed down quite a few. First is bills for collection, then remittances and transfers, LCs and bank guarantees, processing fees. So all this, like processing fees, also the sanction letter will be, it will be clearly specified that okay, some percentage of the sanction limit processing fees have to be recovered. Then lead bank fees. Suppose if there is a consortium account and your particular bank is the lead banker in that. So then for all the activities, managing all the consortium, holding the meetings and everything, they have a lead bank fees also. Then mobile banking fees, SMS on a quarterly charges, you all would be aware that our savings bank account also quarterly the banks are charging us certain fees for that. Credit debit card annual fees. Then locker rent. Locker rent also, it's a very big area now. A lot of banks are focusing on that because time and again RBI in their inspection, they have detected a lot of revenue leakage under the head of locker rent. Then government business, not all the branches would be dealing with government business. So government business, basically your PF or GST related payments or PF related payments or other any kind of government dues. So whatever government business is handled by the branch, they would be getting certain kind of commission on that also. Then finally, surcharge, CIBIL insurance and penal charges. So mainly these are the different kinds of income which usually flow to the branch. So on test check basis, interest debited by CBS. So usually, anytime we keep on asking the branch, okay, you show us the calculation, they will say that it is done by the CBS. So you have interest run reports as well as product rate sheets. They are generated from the system. So at least on a sample basis, maybe for a cash credit account or a term loan, demand loan, different like LCs, BGs, you should always at least on a test check sample basis, you should on a monthly basis pick up and see whether the system is working in a proper manner or not. So suppose if you plot all that data in an Excel file and you calculate the interest and then you compare it with what is actually getting debited in the CBS. Because many a times we also have found that there are variations in that. And maybe then you can, very well report that in your audit report so that the central office can take care of it. Booking of interest on credit card portfolio. So a lot of banks nowadays are issuing credit cards. So that also is a different module. Maybe it's not integrated with your main CBS module. So that you will have to identify, you will have to go through those internal bank circulars, that how basically what is the SOP on that, how those credit card bills are getting generated, whether that is being done centrally or not, or it is at the branch level, how the follow-up is done, what is the role played by the branch in that. Then booking of interest on pool accounts. So anybody has handled pool accounts anytime? Or do you have idea of what exactly is the pool account? See, what happens is that, all the NBFCs, now they want funding for their activity. So they will get into touch with the banks, and then suppose if they have a housing loan pool of some 10,000 accounts worth of 5,000 crores. So some particular bank will purchase that entire pool. So what will happen is that it's an irrevocable pool, and then they will have some kind of sharing, maybe 90%, 10%. So once if your particular branch purchases that pool, so that entire advance will flow from their books to your book. So that advance will get shown in your trial balance, in your balance sheet. And again, the interest will also get, whatever is the arrangement with that particular NBFC, based on that, the interest income also you will be booking in that. So many of the banks, because of the large volume of such parties, they have developed separate softwares, whereby because in the main CBS they are not able to fetch all that data. Now suppose 5,000 crore worth of advances and maybe 80,000 or 1 lakh crore of accounts, and each account 50,000, 10,000, because with NBFCs or microfinance companies, they will do lending even for this on mobile also you have that 5,000, 10,000 also you get that lending. So they are not able to capture the entire data in their CBS. So they have a parallel module whereby this entire data is controlled, and then that is linked with your main CBS. So in this cases, actually practically what we saw in that wherever in those pool accounts, wherever NPAs were flagged, so the reversal was done by the bank on a simple interest basis. So when you charge interest, that is on compounded basis, but when you reverse it, they were doing it on a simple basis. So if you come across such kind of pool accounts, so this point, it can be a ready-made observation for you, because this is not automated till date in any of the banks. This is done manually by them. Then checking the movement in the interest rate changes in the master. So this also a couple of instances what we had observed, that in few of the accounts, that particular branch used to change the interest rate maybe in the second week, and then again go back to the main interest rate in the last week, because that particular person was knowing that always the checking would be at the month end. So that is why suppose if the interest rate paid in the CBS as per the sanction was 9%. So when you go, you check the first week of the month, it is at 9%. Then in between, he will change it to 7%. Suppose if that is some related party or he knows it is his friend. And then again on 25th of the month, he will again change it to 9%. So when you check it at the month end, you will see, okay, it is as per the sanction. But in between 15 to 20 days, there was a revenue leakage, because the interest gets debited on a daily product basis. So if you have whenever you have access to the master of the borrower, there is again a report or a module whereby you can see that how the interest rates have been changed in that particular borrower's master during the period. So from there you can pick up whether if there are any such instances or not, because this again is a kind of a revenue leakage. Then checking of borrower's master in the CBS with sanction terms, that is what I had discussed. So the ROI entered in CBS should match with your sanction. Now, two instances which again are based on my practical experience, whereby the borrower's sanctioned interest at 6 months, 3 months, and 1 month MCLR or LRR. System does not update the interest rate automatically in such cases. So whenever the MCLR or the interest rate is changed by the bank overall for all the borrowers, the bank itself it changes the MCLR, maybe on a 6 monthly basis or on a yearly basis. So automatically the interest rate gets amended across India, across pan India, across all the branches. But if the sanction of those particular borrowers, if it is at 6 months or 3 months, then the branch has to manually change that. So in most of the cases where we have come across revenue leakages, are such kind of cases. These mostly are big borrowers, whereby the interest rates, the branch manager or the branch staff, they feel that automatically it will get changed. But when you check exactly the sanction terms, you find that again there is either there is a deficit or excess. So both ways we have found that excess interest income was also getting booked, and in few cases there was less interest income also getting booked. So the sanction terms are very important in all such cases. Then again, in the below paragraph, what I have highlighted. Now, whenever there is an alteration in the master. So suppose if there is a interchangeability between the non-fund based limits and the fund based limits. So the system will treat that as a fresh sanction. And fresh sanction means the MCLR on that particular date gets picked up by the system. So system works in whatever logic has been entered by the IT department. System will also always function in that manner. Unless the branch keeps a tab on it and keeps on monitoring, unless without that, there will always be a revenue leakage. So we have several MOCs throughout the year we have been coming across on a quarterly basis when we do the branches. We see that always there is something or the other lapses. And at branch level, because most of the PSU banks now they are running on a very less number of people. So there is always more pressure on them, and that is why all these lapses time and again we have been finding it out. So as a concurrent auditor, it's a very important role. It's a very important area whereby when you find out some income leakages, the branch will start giving you more respect. So that's what effect I keep on telling my people always, that when you go for a concurrent audit and when you go for a statutory audit, the way in which banks treat you is altogether different. So concurrent auditor, right from getting a login or getting a place to sit, from there, our 5 stats that my staff keeps on complaining, we don't have a place to sit, we don't have access to the computer. But believe me that once you start delivering something of this sort to the branch, to the bank, some kind of value addition whereby you are able to tell them this kind of mistakes are there, or this kind of processes there is a failure by your side, then altogether the point of view of the bank towards the concurrent auditor changes. Now restructuring at all the concurrent audits whichever people were handling, have you come across a lot of restructuring now in the past COVID era, GFT era? Because RBI has come out with so many circulars on restructuring. Maybe I think Dhananjay must have touched upon this area also. No? Restructuring was discussed in the previous session. Okay, so see, most of the restructuring cases, basically there were heavy restructuring by all the banks, because there was kind of a mandate given to the banks that under COVID, see to it that none of the MSME accounts, none of the MSE accounts flip to NPA. Whatever benefit, that extra COVID line of additional loan 20% that was given to them, then 6-month interest was not charged to them, extra facilities were given to them wherever, because of the strain on the working capital cycle. Now, most of the cases you see that the stock statement, what is submitted by the borrowers, actually, more or less, there is some kind of manipulation in that because of the strain on the working capital cycles. Stock is there, they are not able to liquidate, or if they are able to sell debtors, they are not able to recover the amount. So the limit what was actually sanctioned to them and the actual DP which is now based on their actual stock statement, there is always a huge gap. So most of the banks have done restructuring whereby the excess CCA, whatever limit was there, which was not getting justified by the stock statement, they carved it to a FITL or a WCTL. So in those cases also we found there were a lot of lapses because RBI had given them the due dates that so and so by so and so date you need to implement the package. By so and so date you need to do all the documentation and all those things. So before the due date, actually they had to restructure the account. So whatever in a very haphazard manner, these PSU banks have done the restructure. So mostly you feel when you see the actual restructured sanction letter and the CBS, the master file, how it is updated, there is always a difference in that also. If the repayment schedule was supposed to start from X, they must have entered Y. Then in most of the FITL cases, so you are aware about FITL, funded interest term loan. How exactly is that facility? So when you restructure the case, whatever is the excess unrealized interest from the borrower, that gets converted to FITL, that is funded interest term loan. And what they do is that banks will give a separate limit of FITL to the borrower. When they restructure the case, they will give a moratorium for the term loan. So term loan, wherever there is a moratorium, they will give the moratorium for principal as well as interest. So the interest system will keep on debiting to the term loan, and from that term loan, the interest will flow to FITL account. And then FITL, again, there will be a moratorium in terms of payment of the principal amount of the FITL. So any kind of restructuring which is done, you should go in deep and understand what exactly are the waivers or the benefits given to the party and whether that all is properly captured in the CBS or not. Now, in most of the cases, what I have found that wherever they restructure and they create an FITL, so usually, for all these MSMEs, small MSMEs, what they have done, they have given 24 months, 36 months of moratorium. So they have given moratorium for principal as well as interest. So branches, what they feel, okay, this account is restructured for 2-3 years now. We don't have to go to the borrower for any kind of money. But interest on FITL is always required to be serviced by the party. So this particular point, the branches have failed across all the banks. And because of that, the auditors come out with MOCs and the accounts are also getting classified as NP. So just keep a tap on that all the FITL accounts, whatever interest is debited on a monthly basis, that is serviced by the borrower or not. And if it is not serviced, whether the sanction terms have given that kind of exemption to those parties or not. So charging of penal interest on delayed submission of stock statements, quarterly information statements. So this all we are aware that most of the times when you confront to the bank, even in your draft audit report, if you come out with penal interest, then the first thing the branch will say is that no, we cannot debit it, so borrower bhag jayega. And he will not be in a position, or he will not accept this debit at all. But then suppose if you accept that stand of that particular bank, many a times their own internal inspection team comes and they find out revenue leakages. So at least even if the branch is not debiting to the party, but see to it that you mention that amount in your concurrent audit report. See, because as auditor, we cannot force the bank that you debit it. Our job is just to mention whatever our observations in the report. If they are not doing it, they will have to take the hit later on from the inspection team. Again, quarterly information system, same thing. Most of the times, on the stock statement, see, many a times, backdated also in CBS, we have found that entries were parked by the branch. So usually any kind of inward document which comes to the branch, they have a habit, whoever is the clerk, he will put that inward stamp. So on a test basis, at least you should check whether the date of inward on the stock statement matches with the date of stock statement entered in the CBS. Because there also we have found a lot of mismatches. So that rate changed in between the months and again amended, that we have already discussed this point. Bills purchased and discounted, everyone is aware, this has been discussed by Dhananjay, what exactly is bills. So wherever you have packing credit, you have a simultaneous limit of bills. So in that, on the income part, we have to check whether the interest booking is based on the tenure of the bills. And again, what is the accounting policy of the bank? That is also important. Now, rebate on bills discounted. Over here also, when we do consolidation of all the branch statutory audit reports at zonal levels or at HO level, we have been finding that there were a lot of MOCs by the statutory branch auditors in this particular aspect. So what will happen is that, these 2 points I have covered by example in the next slide. One is on the rebate on bills discounted, and the other is accrual of interest in case of overdue bills. So we will see that through this example. Now, in first you see bill was purchased on 1st February for 90 days, and maturity date is 1st May 22. So income is to be accounted till 31st March because that is your cutoff period for the financial year FY 21-22. So what the system does is that once you open the bill on 1st February, that entire interest income of 90 days gets booked as income in the module. So when as of 31st March, when there is a cutoff, the differential amount, which is the excess interest pertaining to the next year, which is booked, that needs to be reversed and it needs to be taken to rebate on bills discounted. Similarly, when bills, second case, bill purchased on 1st December 21 for 90 days, here we have the maturity date as 28th February 22. So the bill is matured on 28th February. So 90 days income already system has taken into account. But since the cutoff period is of 31st March, in that case, 1 month interest income needs to be booked. So in the above case, you have to reverse the income, and in the below case, you have to accrue the income. So most of the, lot of software, they are not able to do it. And manually, sometimes the branches are actually in the closing guidelines, it has been mentioned that the branches are supposed to do it, but they fail to do it. And then this comes through MOC. So at least during your cutoffs, maybe quarterly cutoffs, June, September, December, March, at least this particular point should be kept in mind in case of bills purchased and discounted. Coming to LCs and bank guarantees, again you have to confirm what is the accounting policy of the bank, whether upfront they are booking the income or it is spread across the tenure of those particular instruments. After then the period of the LCs, because the interest will get booked accordingly. Verify the interest rate from the sanction and the rates as per the circular. So whatever, see, you will also have to make a habit of going through their intranet. On the intranet, they have a lot of circulars from different departments, from inspection, from credit, from your treasury department, from forex department, from your IRM department, risk committee, ALM committee. Banks have so many different committees, and each department, each committee, on a time-to-time basis, they will keep on issuing the circulars to the branches. So at least try to understand from them. From intranet, maybe you are able to download all those whatever circulars are given, and you have your own folder created. For bank guarantees, confirm the booking of the commission income. Same way it is upfront or spread over the tenure, that we need to check. Then the reversal of the expired bank guarantees, because most of the cases, where the BG has already expired, but still it is live in the system. So they, since it is a off-balance sheet item, many a times there are lapses by the branches. There is no, any attention given to this area. But then, why this is important? Can anybody tell me why you need to reverse those expired BGs? In which particular area at the bank it is going to hamper them? Any idea? See, at capital adequacy, when you calculate, when CRAR is calculated at the bank, at the HO level, even these whatever bank guarantees are alive in the system, for that also risk weights are given. So if an expired bank guarantee is still alive in the system, your CRAR is going to be affected. So that is why this also we need to, whatever is the module, usually the banks have a different module for BG and LCs. Exim module, some banks call it as Exim module. So check that module, and wherever those expired BGs and LCs are there, make it a point to have a separate table in your concurrent audit report, so that even the statutory auditor, when they come, handily it is available to them also, and then they can communicate with the HO also why these bank guarantees are not reversed. Then income booked on LCs, again on the tenure you have to check that and confirm that the devolved LCs are debited to the CC account. So this point has been covered by Dhananjay, devolvement of LCs. See, this is a very important area, devolvement of LCs. So what, couple of years before, in RBI actually had observed that wherever LCs were getting devolved, the banks were not debiting that devolvement to the CC. They were parking it to some other account. So what used to happen is that once if you park that limit to certain different, you create a different account and you put a different CIR and you post that amount, then again 90 days benefit you are giving to the party. Now you have a borrower's account whereby the CC is already, it's on the whatever limit is there. He is exhausting the entire limit. And if the LC gets devolved, and instead of debiting to CC, he has parked it at some other account. So that account which was supposed to slip to NPA will not slip. System will not identify that account as NPA. So that is why there was a circular issued by RBI mandating all the branches, all the banks, that if whatever is the devolvement of LC, it should be debited to the cash credit account of the party. So if you have, now from where you will get this amount, suppose devolved LCs, if the branches are parking it somewhere else. When you take out the loan file from the branch, you will find their sanctioned limit is 0, but outstanding there is some amount. So from there you can pick up such amounts whereby there is no sanctioned limit, but amount is there. So most of this such amounts are the devolved LCs. And while calculating the overdue provision of 90 days, this particular amount needs to be added to your CC overdrawn account, CC outstanding, to determine whether the amount is continuously crossing that limit or not. Then check the controls over the issue of the LCs and BGs from the relevant module of the CBS. So, there were instances which were pointed out by us also in some of the banks whereby the staff were issuing BGs from Excel. On some particular days, there was some problem in the exim module of that particular branch. So, it's a very high risk area. Basically, it's kind of a fraud only. From the system, you are not issuing the BG, and the same format they have developed in an Excel file, and from that the branch manager is signing and issuing the bank guarantees. So it is just like that, some kind of Nirav Modi kind of a scam, where nothing is there in the CBS. The bank guarantee, once that gentleman comes, maybe that BG when it gets invoked, maybe 2 years, 3 years later, then the bank will come to know, okay, such kind of BG was actually issued. So just see to it that what exactly is the mechanism at the branch, whether mandatorily whatever BGs are being issued, it is being issued only through your CBS or not. Then confirm the sequencing and authentication of this document, that how exactly the BG is issued, who enters the data, who signs the document, whether you find any kind of such instance whereby some party has come, but then those details were not available in the CBS or not. So verify the supporting for the LCs and the BGs to confirm the genuineness. So LCs, lot of this forensic audits what we have done, we have found that maximum diversion of funds has gone through LCs. So through LCs, through accommodation entries, funds have moved from one party to another, through bogus bills, bogus sales, whereby banks were not able to identify whether those bills were genuine or not. Lot of times when you see the lorry receipt, which is the external third party, whereby we usually confirm whether actually the movement of the goods have happened or not. So when we tried to confirm the lorry number from that lorry receipt, we found that that number was pertaining to some two-wheeler, some three-wheeler. So such kind of points actually you should also have it in your mind on a sample basis. You should also check, because whenever there is a fraud in any branch, and if that case goes to some regulator, EOW, CBI, even the concurrent auditor is called, because first responsibility is of the concurrent auditor to identify that, okay, these documents were there, you were supposed to do 100% verification, why there was a failure from your part. So it becomes very difficult in such cases to justify that why there was a lapse from from the concurrent auditor. Then ascertain the margins on the back guarantees as per the bank circular and the sanction letters. So mainly BGs or any kind of non-fund based limits are given only to your regular parties who have the normal working capital fund based limits also. Very rarely you will find that a borrower who does not have a fund based limit, any non-fund based limit is given to him. And mostly if any such bank guarantee is given to any other party, it is on 100% margin. So bank will take FD of maybe suppose 1 lakh rupees and issue a bank guarantee of 1 lakh. So just see to it that in such cases also the proper security is obtained from the borrower by the branch manager, and it is in line with the internal circular of the bank. Suspense and sundry accounts. This also is a very fraud prone area. RBI time and again has been issuing circulars to the banks, and banks actually in turn they have been I think in lot of times, even in the concurrent auditor's appointment letter, they must have mentioned this, that sundry suspense, you have to always keep a proper track on that. See, so normally in bank what happens is that all the entries are automated. The borrower's account, the interest income, everything is more or less automated. Checks come, go, all those entries are there. But suspense sundry accounts, there is where there is a manual intervention. The branches have access to these accounts to post entries. And I have seen n number of cases whereby there has been window dressing by the banks, by the branches, by using such kind of accounts. So these are mainly temporary parking accounts, and mostly you will find that deposits to landlords or telephone deposits or advances to staff such as festival advances, traveling advance, they are shown under this. So fraud, if there is any fraud which is still investigation is going on, there is no conclusion in that matter, that is also posted under suspense. Cash shortage, so any kind of debit items go in suspense, credit items go in sundry. So, even in rural branches, we have found that there was a dacoity. That amount was also parked for years together. That was there under the suspense. So, as auditor, what you need to check is that there are no old and non-moving entries under these heads. And whatever, if there are such entries, like if there is a fraud and still investigation is going on. So, at least highlight that point, that particular, what is the movement happening in that, what is the status of that fraud, whether what is the, maybe you will have to get all the details from the branch manager, who in turn can get all the details from the internal vigilance team. So that you need to cover it in your audit report on a monthly basis. Appropriate provision has been done for such items. For more than 6 months, usually you have to do the provision for all such items. So if that is not done by the branch, then you need to take care for that. So fraud manipulation prone area, because at year end, suppose if any account is overdue and it is on the verge of slipping to NPA. So what the branch will do is that they will debit this suspense and they will credit to party. And then again, in the next month, they will reverse this entry. So that is why at the cutoff dates, at the month end, you should check that which are the new entries which are flowing in suspense account. Whether some system related entries are flowing or there is a manual intervention, any manually entries are getting posted. What are those entries which are getting posted? What is the other leg of that entry? Suppose if the debit is coming here, where is the credit going? To which account the credit is going? Then ensure that multiplicity of accounts and unnecessary accounts are not opened as suspense, because since there is a discretion given to the branch to operate these accounts. So most of the time it is seen that if there are NPAs or SMA, any amounts, any accounts getting slipped to SMA 2, these accounts are used to somehow manipulate those NPA accounts. Then verify the process of expeditious clearance of items debited to suspense and whether the same are actually cleared. So whether just on a prima facie they are getting cleared only for a day-to-day basis or permanently these items are getting cleared, that you have to check properly. Then verify whether any office account is used for allowing debits to accommodate temporary ODs. So this is the same, whatever intermediary, this inter-office accounts or suspense entry accounts, you should see that those accounts are not getting used by the branch to do any kind of manipulation. So suppose if the branch has a target of some advances, he has got a target of 500 crores, but he has reached somewhere at 450. So he might use these accounts just to meet his target at the year end. Similarly for deposits. So those kind of manipulations also we have seen, which are not pertaining to any particular borrower, but just to meet his target, they use such accounts. So constant monitoring is very much required. At least on a weekly basis, you will have to review these ledgers. Again, staff accounts, because once this inter-office accounts, when RBI came out with all these circulars, then branches started using their own accounts. Maybe the branch manager used his account or some other clerk's bank account. So high value transaction in the staff accounts may be on a tested basis, whatever the savings accounts are there, because you have access to the branch records. So you should get those details from them, do a summation of debit and credit. So that is how lot of fraudulent activities have come across. That if the salary of that particular person is 1 lakh rupees, 1 into 12 lakhs, at the most suppose 20-25 lakhs other income might be there. But if you see a debit and credit summation running into tens of crores, 25 crores, 50 crores, that will definitely, those particular accounts are used for some kind of routine activity. So debit and credit turnover has to be checked to confirm that is in alignment with the income of the staff member. Then again, it's a fraud manipulation area. RBI has observed several frauds through these accounts, and hence constant monitoring is required. So staff accounts, then suspense and sundry. This particular, on a time-to-time basis, we have to keep on reviewing these accounts, that there is no high value activity or any high value debits credits appearing in such accounts. Then inoperative accounts. usually we call them as dormant. So sudden operations to be checked. So mainly, this all dormant accounts is that some particular person, they have expired or they have shifted their place. Somebody else, they have left the country. So all those accounts, they are lying as dormant at the branch level. So this also is a very high prone area for fraud, because branch manager has very much access to this account. And if he knows that, okay, this person, he is dead, or he doesn't have any other relative who can come to claim that amount, or this particular family member, they have left India permanently, and if he has access to use those accounts, he can very well operate those accounts and transfer those balances to his account or to his relative accounts. So all the instances have been noticed by the auditors as well as RBI. So you have to be careful in all the dormant accounts. Take a list of all the dormant accounts at least once in a quarter. See what kind of movement you are able to see. If there is any movement, then try to see that who actually, whether there was a application from the party to operate that account, or suo motu those accounts were getting operated. If the amounts were moved from to which account they were moved, or they were issued by a DD or via RTGS, whether those accounts were closed, how those accounts were closed. All these are very much important. Again, it can be used for NPA manipulation also. If any account is getting, because he is very much, branch manager is aware that this particular person is not there. So if he has got, suppose 10 lakh rupees in his savings account, and that account is not getting operated, and there is one NPA account whereby he has got a deficit of 5 lakh, he can always tell the borrower that, okay, 5 lakh मैं अभी यहाँ से करके देता हूँ, but you see to it that you make good that money. So at cutoff date, at year end, there are a lot of such entries also moving from the dormant accounts to the regular overdrawn accounts to save those accounts from NPA. So non-operation accounts, there are charges which are automatically debited by the CBS. And as for RBI guidelines, in any inoperative account, which is more than 2-3 years, then non-maintenance charges are not getting, because then, you just cannot keep on booking your income, because a lot of times these accounts they go in debit balances. And then many a times we find that, okay, the debit balances, they are running in thousands of rupees. But since the CBS, it's not accustomed to identify these accounts as NPA, because the product code is savings account. But then once it goes into debit balance, then immediately your NPA guidelines will come into picture. So those kind of MOPs also, we have seen so many such kind of MOPs also, that savings account, current account, CASA balances going in debit, and they are running into lakhs, because what will happen, that system will keep on debiting for all maybe non-operative or overdrawn accounts. And system, when it runs the NPA cycle, it will not identify this account as NPA because the product codes are different. Then there is a concept of DEF, that is the Depositor Education and Awareness Fund. So I have cited that particular circular of RBI dated 21st March 2014, whereby all the credit balances lying older than 10 years, they need to be transferred to this fund by the bank. So in this regard, we have to check the aging of the credit balances lying in different accounts and confirm whether all the balances which are aging more than 10 years are transferred to this fund of government, and they don't lie at your branch level. So in these cases also, whenever you ask the branch that, okay, these are the old balances, इसका क्या करने वाले हैं? The first thing they will tell you, the system automatically करता है. We don't do anything. The cycle is run by IT department, and all these balances are picked up and automatically they get transferred, and branch does not have any role in that. So what we have observed, that CBS sometimes fails to identify several savings account FDRs. Like one particular instance, we found that loan against deposit was sanctioned to a party, and this savings account or the FDR was linked to that loan. So when the loan got matured, the loan became zero. But this particular account, they had the linking attached to them. And even though these balances, credit balances, they were aging more than 10 years, but still CBS could not identify these accounts because the linking on the back end, the linking was still activated in the system. So because system thought that, okay, there is one loan account which is linked to this credit balances, and that is why, it was not transferring to debt. And there are huge penalties levied by RBI, whereby they come to know that these amounts are not getting transferred to debt. So, if that penalty is there on the branch, then always there will be a question that, okay, why the concurrent auditor again could not detect it. So just see to it that all those balances, maybe I think, I have given a list of, these are the different types of balances which the RBI has given in the circular. So first is the savings bank, then fixed or term deposit, different type of cumulative or the recurring deposit schemes, current deposit, other deposit accounts in any form, whatever is there, CC accounts. So usually CC you have debit balances, but sometimes if the party is not using, many of the parties who are cash rich, they use the CC just as a current account. So those kind of balances, if they are lying more than 10 years, they also should be transferred to debt. Then margin money against issue of LCs or guarantee or any security deposit, loan accounts after due appropriation by the banks. So if you're from 10 lakhs outstanding, party has paid 12 lakhs, so 2 lakhs extra you are having with you. That is the credit balance which is lying in that particular account. So any kind of credit. So all, actually, if you see this particular circular, all kind of credit, even the inter-office account also, if there are credit balances appearing over there, that also RBI will ask the bank, you need to transfer it to DEF. So this slide is on the interest booking on the overdue term deposit. So here also we have RBI circular which I have cited, whereby it states that wherever there are overdue term deposit, and if the party doesn't come, to renew those deposits, automatically you have to renew those deposits in the system, and then give the savings interest rate. Or else many banks, they have a different type of, some banks, they treat that as overdue, some banks automatically they will renew it. So wherever this overdue term deposit or that savings interest rate needs to be booked. So check the aging of such deposits from the CBS to ascertain whether all these are overdue or not. And again, check the working of the interest being booked on such kind of deposits, because see, any kind of interest which is levied, everything is on the product code. So if the term deposit was having a different product code, now it is shifted to overdue. So the product code should change, then the savings interest rate will come into picture, because system will not know whether this is overdue or not. Then interest on overdue, examples of old schemes. So some of the banks, we found that there were very old schemes which were at a very higher rate of interest, 13-14% rate of interest, 40-50 years back those schemes were there. Those amounts were also, parties, because the particular parties, they had not withdrawn those amounts, because 12-13% they will never get. So those schemes were still alive in the system. So in those cases, CBS was not running the cycle. They were having this entire data separately in an Excel file, and branches, there were closing instructions given to the branches that on all these deposits you have to manually run the interest and pass through a voucher. So if you have such kind of instances at your branches, you should see, because most of the time we found that the branches were not calculating the interest through Excel and charging it to the PN. So KYC and AML, these are the main basic items. Know your customer and anti-money laundering. At the time of opening of CASA or term deposit, we all are aware the basic documents of PAN, Aadhaar, and all those things, whether they are being properly taken care or not. Then application of rate of interest. So here actually one more point which I would like to just add on, that any new account which is opened, like a savings account, you need to first understand what is the actually activity of that particular borrower. Now, one instance we found in one of the RBI AFI report, that in one current account there was a credit and debit formation of 400 crores. 400 crores debit at 400 crores credit in a current account. And then the branches or the offices at the bank, HO, GM, nobody was aware that why such huge kind of turnover was there. So mainly they were into that Paytm and all those things, mobile SIM cards, they were involved in that. And they had lot of franchises or branches in that particular area. So daily there was huge cash collection. So all that cash was getting deposited and it was getting routed through a different private bank. But they were using this cooperative bank. So mainly, cash handling charges are very high. Any private bank or PSU bank, cash handling charges are very high. But cooperative bank, usually all the parties, they know that cooperative banks, they have some kind of levy to this kind of parties. So that is why if you have any kind of concurrent audits of cooperative banks, you have to be all the more careful because controls usually are very weak over there. The level of knowledge of those people is also quite low in terms of the whatever circulars or RBI regulations. So if any new account is opened and if there are very high value transactions, so then you have to ascertain that whether the KYC was done properly or not, all AML guidelines are there or not, whether the transactions which are happening in that account, they pertain to that particular business activity of that particular party, whether what kind of activity that party deals into. All these things you should ask the bank and check from the supporting documents to confirm, to align whether those transactions seem to be in sync with the business activity of that party or not. Then application of rate of interest as per the interest table to every product of deposits by taking sample accounts, instances of premature withdrawals of deposit and retrospective renewal of deposits. Again, TDS flag is currently configured wherever Form 15G, 15H has been received by the bank. For 194A, we are all aware that 10% interest is there. So this wherever a lot of times senior citizens keep on complaining to the branches that we have already submitted the forms, but still TDS was getting deducted. So whether what kind of control mechanism is available at the branch whereby this kind of customer service is also properly adhered to or not, that we have to check. Then application of various charges on the CASA, minimum balance charges on tap check basis, that also is an area which needs to be checked properly because there is a revenue leakage in that aspect. And accounting effects of interest payable in the form of interest accrued but not due, as also the TDS compliances, and mainly on the internal circulars of the bank in terms of categorization of customer and the application of the paid terms in the master data of such deposit holders. Then in terms of customer services, there would be a complaint register which is mandatory at all the branches by RBI. So that actually on a monthly basis you should at least go through what kind of complaints are there, whether it is just pertaining to service or it is pertaining to some excess interest, excess charges which are getting levied. So based on that, at least we get an idea that maybe if there are some sister errors which are happening, or whether there is some person who is not able to understand the module from the bank side. So that complaint register, it will be very handful for us while doing the audit. Then major movements in interest expenses versus the movements in interest bearing deposits, and data integrity and modification, that is from time and again actually this one particular point at concurrent audit level is very important for us. Authorization and control processes to ensure that the customer account opened in the system are properly updated in the relevant module in CBS and verify the correctness of the KYC data. So whatever, everything gets scanned nowadays and gets uploaded. So just see that whatever documents originally have been submitted by the party have been properly updated in the CBS or not. Their signatures, cards are properly captured, then their photographs and all those KYC documents. So these exception reports are we checking right now on a daily basis wherever you are doing the concurrent audit. So there is a separate folder at each branch. On one particular computer there will be a folder created whereby on a daily basis this exception reports at the day end get generated and automatically these exception reports get posted in that folder. So whenever actually we also visit the branches, the first thing we see is the exception reports. From exception reports, you will get a fair idea of what are the lapses at the branches, which are the overdrawings and all those things. Because each and every bank, they have almost 50 to 100 exception reports, which are already configured in the system. And on a daily basis, centrally this process is run, and this report get generated and they get stored automatically in that system. So first thing, you should understand at the branch which is that computer, which is that folder, and you should have daily access to this folder. And the branch manager is also supposed, is expected to check this on a daily basis. Previously, what used to happen, all these exception reports were getting printed, and branch manager was required to sign on those reports physically, that he has gone through this and keep a track of that. So nowadays, everything is in soft copy. So you also check, and you should also, ascertain whether somebody from bank is also checking and compliance is happening or not. So review of such transactions on sample basis will help in ascertaining the nature of transactions and the risk involved. And any issues which have not been complied marked as pending compliance, status of the same should be obtained and reported. So, time and again, there are a lot of observations by the concurrent auditor, but the compliance is, maybe the branch is not complying, or certain points are there which the branch is not able to comply. But you should still keep on continuing, because all these concurrent audit reports, these main observations which are not compliant, they are compiled by the inspection team and they are put up at the ACB. So it goes up to ACB that all these non-compliances are persistently, pointed out by the concurrent auditor. And even the central auditors, they also go through the observations. So if there is any non-compliance happening at the branch, and if the branch manager says, कि ये आप क्यों आप बार-बार ये repeat कर रहे हैं, even the previous auditor was repeating, but you still, if they are not able to comply, make it a point that you don't drop the point and you continue it in your report. Obtain instructions issued by the bank for the process to be followed. Inquire about availability of audit trail logs related to such manual interventions and review the same. Then data integrity, we have already discussed about that, regarding the verification of the data being entered, whether that is done properly or not. There is proper maker checker principle. So mainly exception reports, I have just highlighted some of the exception reports which usually, you will get in that particular folder which I had talked about. So first being ad hoc loans granted to borrowers. So many times what happens, the account, when account is getting slipped, we find that there is no genuine reason of any ad hoc to be given to that party. So what exactly is ad hoc? Anybody can tell me what is the ad hoc amount? What is the ad hoc loan? Has anybody come across any ad hoc loan at any of the branch? What exactly is ad hoc? Anybody? Just whatever, let it be wrong, so what? So how the limit is sanctioned to a borrower? Based on the different documents what he has given, his working capital cycle he gives, the CMA data is calculated, and whatever is the difference shortfall in that working capital gap, bank will fund it. Now ad hoc, what exactly is the ad hoc? That suppose in between, now I am an exporter. In between I have got some particular, a very big order, which actually, at the start of the year, I was not knowing I would be getting that order. I need funds to execute that order. So I go to the branch and I make an application that this is a, very big order which has come to me. And for this order, I need an ad hoc amount from you. So that is the genuineness of the ad hoc. And there is a separate register also which is maintained at the branch level, a separate report of ad hoc maintained. But most of the time we found that if an account is slipping to NPA, what the branch will do, he will give ad hoc, and that ad hoc amount immediately will, he will adjust it against the overdue. So under the exception reports, check the ad hoc. If the ad hoc amount has been given, whether it has been given for genuine purpose or it is for some kind of manipulation. If check where that ad hoc amount has been utilized, whether it be utilized by the party to make payment to some vendors, or it has been just credited to some other different account. Then overdrawing allowed over the limits. Many a times, if the CC is actually fully utilized and there is a check which has come to the branch. So many times if you see, if the branch manager or some particular that party will keep on calling, "Arey, check pass kar do, kal deposit kar dunga, kal deposit kar dunga." So if you know wherever there is overdrawing, so that also you will get in the exception reports. Then changes in the interest rates not in line with the product defined in CBS. So if there is a home loan product which is defined in CBS and the slab of the interest rate has been specified between suppose 7 to 10, and if that product is having an interest rate fed by the branch at 5%, 4%, or maybe 12%, that also you can get it from this exception report. Then major operations transactions in the newly opened accounts. So many a times, you know, just to have a kind of fraudulent activity or very high turnover, such accounts are operated. If some particular borrower where that bank is not allowing him to operate, he will open an account in some different bank, and from there he will start routing the transactions. So that genuineness of those operations is very much essential. Then standalone non-fund based limits granted to the customers, backdated updation of stock and book debt statements, list of accounts wherein the facility is not reviewed, that also you can get it from here. So you know, if any facility, if it is not renewed on a timely basis, so either the party is not cooperating with you or there is some problem with the borrower. So you know, these are all pointers by which you can, you know, go and drill down exactly to ascertain, okay, what exactly is going on wrong in that particular account. Then list of accounts slipping to NPA during the current period. Then list of accounts wherein there is an amendment in date of NPA. Just in this, I found out whether MOCs, do you check the impact of MOCs at the branch? Whatever MOC has been passed by the branch statutory auditor, do you check how the MOC is given impact in the CBS during the course of your concurrent audit? So, do you have a fair idea of how the finalization happens at the branch or at the bank? From branch, how the MOC flows to zone, from zone, how it is captured at HO? Any idea on that? Should we discuss 5 minutes on it? See, so when a statutory audit is done at the branch and a MOC is passed by the branch auditor, so CBS is a live system. You cannot punch the entry on that date, because when you go and do the audit, that is maybe 8th of April for March cutoff date, you go and do an audit of 8th of April, 10th of April. If you pass a MOC and you classify an account as NPA as of 31st March, so that entry will not get punched in CBS immediately by the branch. That MOC will flow to zone and zone will punch that entry, but not in CBS. In CBS, that entry is not punched at that level. You have a parallel system whereby all this, you know, each and every bank, they have some different names for this software. Like in some particular public sector which I did, we used to call A1 to A4 statement. The last bank which I did, we used to call that blue statement. So this entries of NPA classification or reversal of income or booking of income, whatever MOCs are passed by the branch auditor, they get booked in this software. And this software gets compiled at zone level, at HO level, and based on that, the balance sheets are prepared. So in CBS, these entries never flow. As of 31st March, once the audit is finalized, the balance sheet is signed, then you know what the zone will advise to the branch that okay, this was your MOC which was accepted by us, passed by the branch auditor, and now you will have to punch it with a value date in your CBS. Now, suppose 31st March, I have passed the MOC for classifying the account as NPA, and I have classified that account as NPA from 30th June 21. 30th June 21 was the NPA date in my MOC, and I passed that MOC as of 31st March 2022 audit, right? So basically, the NPA date of that account should be 30th June 21. But usually when we go again for the audit of those branches, we find that while punching the NPA date in the CBS, the branch manager takes it at 31st March 22. Now, because of that, what happens? That the account which was supposed to flip to D1 is still lying in your substandard. So, you know, that particular, because of that date, the provisioning will have an impact. So whatever MOC, you can very well take that statutory audit file in which you will have that complete set of the balance sheet MOF is passed by the branch auditor, the entire set of LFAR. LFAR, do you have have you gone through any LFAR of any branch auditor? So there he will detail all his comments on the advances. From there also as a concurrent auditor, you can get lot of inputs that how, what all things which he could verify, which were maybe, missed out by the previous auditor, by the previous concurrent auditor or by us. Because humanly it is not possible that 100% verification can be done by anyone. So for us, what we should do is that we should, keep a tab on different like inspection audit reports, their own internal audit reports, RBI inspection if there that report, statutory audit report, so that you have a fair idea, okay, these were the observations and whether you are covering those things in your report or not properly. Because tomorrow if there is any lapse, you will be held liable for your report. So at least make it a point that, all these, whatever different audits are done or the different reports which are available at the branch, you should go through those reports. Because when we go and do the statutory audit, we go through all the concurrent audit reports and check that on a monthly basis what was pointed out by the concurrent auditor. That gives a lot of insights to us also. So similarly, when we do the concurrent audit, we should take help of the other concurrent audit, statutory audit reports. So this MOC, everybody is clear that now next time when you go, you just check whether the punching of that NPA data has been properly handled by the branch or not. Now loans below the benchmark rate, now CC, again the slab, if it is below 8, the branch is not allowed to give the CC, but still he has given at 7. Then again that exception report will highlight that. List of accounts wherein refacement, changes in EMI, tenor, moratorium period. So in lot of these restructuring cases, especially which I had discussed before also, whereby the repayment was supposed to start maybe, from 31st December 22, but maybe intentionally or unintentionally, maybe he might have, postponed it by 3 more months in the system and given some extra benefit to the party. So because of that, what will happen? System will not able to identify that account as NPA when actually the sanction says that from 31st December 22, the party was supposed to make the payment. But even though he is not making the payment, system will not be able to identify it because the renegotiated terms entered in the CBS were faulty by the branch. So CC accounts with primary security as nil, manual debit credit to interest income and other income account. So now most of the banks, they have a different ledger account itself. So if there is any excess, any processing charges which were debited more, and then subsequently you have to reverse or you have to refund to the party, any income account, first of all, at the branches, they are not allowed to debit income heads. And if they have to debit, then maybe I think concurrent auditor certificate is also taken from you, and that is given to the home to confirm that whatever reversal of income has been properly calculated, checked by the concurrent auditor also. So previously those debits are going to the main income heads and expense heads, but now they have a different ledger whereby the ledger itself is manual reversal. So just see to it on a monthly basis which all entries are flowing over there, and check from your end whatever was done by the branch is correct or not. And then cash payments, lift of outstanding BG and LC expired and not reversed. Resident customers having NRI status of inoperative. So unit inspections again. Most of the branches, at least wherever working capital limits have been given, on a quarterly basis, the branch is supposed to visit the borrower. Now, why visiting is important? Can anybody tell me? Why unit inspection is important? No idea? Correct. See, because at branch, what is happening? He will give you the stock statement. Now, whether that stock, that book debts, whether those balances are correct or not, whether the level of operations are there or not, that just on the basis of paper, you are not able to identify. He can keep on manipulating the stock all the time. And one fine day when it turns to NPA, you find that there is no stock. Debtors so easy nahi rahenge books par. All those would be bogus. So at least stock, if you have a fair idea, that is why unit inspection is very much required on a quarterly basis. If that is not happening, just see to it that you mention that all these units, all these borrower account unit inspections have not been carried out by the branch. Then manual debits to inter-office accounts, login in CPS by person on leave. Whether you find this point risky, last one, whether that can happen, it should not happen. But if I share the password, it can happen. What about biometric? Nowadays, everything is biometric. So still it should not happen. But still we have found cases whereby even after biometric also there were logins in that particular person's name. Inter-office accounts mostly used for internal business transactions of banks or transactions to facilitate movement of funds in a flow of transactions. So all this inter-office, sundry, whatever such accounts, just keep a eye on this account that there are no high value entries coming, staff accounts, so that the branch, they are not using this accounts to manipulate, because a lot of fraud which RBI has also detected, mainly at branch level, this accounts have been using. So reconciliation of transactions on a daily basis, unreconciled, you need to keep a track on that. Major transactions which occur through inter-office accounts, that I have tried, I have listed it. Maybe we can just run through. Cash and then payment of instruments, government receipts, operations by the authorized branches on banks nostro, then NEFT, UPI transactions, internet-based. So wherever that branch has to deal with corporate office or through other branches, those transactions get routed through this inter-office accounts. ATM transactions, credit card related, then GFT. Now mostly I think GFT is centralized everywhere. TDS is centralized. So that all entries will automatically keep on flowing through this inter-office accounts. That verify the balance in this head and should seek explanation. Okay, that all you need to do. I think maybe we can skip this slide. Lack of automation for identifying and reporting of the outstanding entries, opening of savings and current account, funds movement. So there also, this time and again we have found that these accounts are getting misused. Crediting a dummy entry by debiting the office account to the credit of borrowers and then debiting so as to prevent from becoming NPA. So for NPA, window dressing, manipulations, time and again, all these accounts are getting used. Then sensitivity office accounts, review the system on that, check all the material transaction outstanding. So even if there are old outstanding entries, because mostly more than 6 months, the branch will say, "Iska to provision ho gaya hai, why you want to go into it?" But at least make an attempt to understand what were those entries, why they happened in the first place. Okay, provision is secondary, but at least try to understand that what exactly that entry was there, whether there was into anything relating to fraud. Because any time any fraud get detected, they go back 6 years, 10 years, and they will check all the entries. Once any investigation will start, maybe by CBI or by a forensic auditor, by UW, so they will go right from the inception. So just make it a point to have a fair idea and try to cover as much as possible in your concurrent audit report. So if there is anything, at any point of time, you always have something on your hand to say, ki, okay, I have disclosed this point. I've already informed it to the bank. So early warning signals as per RBI. So there were some for all these NPA accounts getting slipped and getting a banks were getting a shock. Okay, this account suddenly how it has slipped to NPA. So that is why we have those SMA and all those categorizations. I think Dhananjay must have spoken on that. SMA 0, 1, 2. So any account which slips to NPA has to necessarily, that account has to go through these buckets. If any account slips to NPA without passing through these buckets, it's kind of a vigilance angle on that particular branch manager, that how this has happened. So because all these steps are necessary, because SMA 0 to 1, the branch, they keep on pressurizing the party, paisa bharo, paisa bharo, paisa bharo. Once it slips to SMA 2, it goes to zone and HO. They will keep on putting the pressure on the party for the recovery. So that all these steps are there, banks will keep on putting efforts on a timely basis for the recovery. So some of the early warning signals which RBI, there was a separate circular, and we have a publication by institute also. I think it is downloadable, even if you do a Google on that. It's a beautiful publication where a lot of writers have mentioned on each and every early warning signal that as an auditor, what needs to be checked. So first, default in undisputed payments to the statutory bodies, bouncing of high value checks, frequent change in the scope of the project to be undertaken by the borrower, delays observed while clearing the outstanding dues, frequent invocation of BGs and devolvement of LCs. So that is, this is a very good indicator that this account is going to flip to NPA. Invocation of BG and devolvement of LCs. Then invoices devoid of GFT and another details, dispute on the title of the collateral securities, funds coming from other banks to liquidate the outstanding loan amount unless in normal course. So many a times, in this forensic audit we have found, usually when there is a consortium of 8 to 10 banks and the account, it's getting slipped, maybe NPA in certain accounts, it is SMA in certain accounts. So immediately what the party will do is that they will start opening current accounts in some different private banks, and they will route major of their business transactions in those accounts, because they know that once they start routing it in this account, these banks will start apportioning the funds collected whatever from the debtors, and they will start clearing their overdue. So in majority of the forensic audit, we have found that this diversion or this opening of current accounts, whereby, if you must have read recently, RBI had come out with that circular that more than 5 crore, if any party has limits with some banks, then they are not allowed to open, or the bank should not open current accounts. Necessarily, they have to route all their business transactions only in those working capital banks only. So wherever, corporate clients opening current account at your branch, but they don't have funding limits with you, just see that what kind of entries are going into it, what kind of KYC the branch have done, whether the branch has taken a confirmation from that borrower that they don't have any funding limits, or else from CRILIC, maybe, if you have access to CRILIC reports, it's one of the best reports which any auditor can get. But mainly we don't have access, the branches have the access to that. So any particular borrower from a CRILIC report, you will get to know the entire history of that party. Total, what are the outstandings, from where he has taken, even a single small credit card outstanding also will get reflected in that CRILIC report, along with, because that I think on a weekly basis or a fortnightly basis, all banks are supposed to update. Even SMA 2, SMA 1 also has to be updated on CRILIC. So, any large branches, if you are doing the concurrent audits, try to lay your hands on the CRILIC report. It's very useful. Then funding of the interest by sanctioning additional facilities, critical issue highlighted in the stock audit report. So do we go through the stock audit reports? So you should always, if there is any stock audit which has taken place at the branch, you should go through the stock audit report and find out if there is anything pertaining as a concurrent auditor which you also wish to highlight. Because many times stock auditor, he will recalculate the drawing power. He will reduce the drawing power, but whether the branch updates that reduced drawing power in the system, no. Most of the cases we have seen that the stock audit report, as a formality, they just take whatever observations are there, they will copy paste it and send to the client. You give the replies, but basically the revised DP, which needs to be updated in CBS, that is not done. So just keep a check on that. Then liabilities appearing in ROC search report not reported by the borrower, frequent requests for general purpose ad hoc loans, frequent RTGS payment to unrelated parties. So this also, this is also a forensic audit. We find that mainly diversions are happening through related party transactions. So if you find a lot of such cases, from audit report, you will come to know that all the related party transactions, whatever has been mentioned, from that you will at least identify. You should highlight in your report. Maybe they might be pertaining to normal business transactions. We don't deny that. But at least if you cover those points and somehow, if that account slips into NPA in future, as a concurrent auditor, you have done your job and you have at least highlighted that this party is doing so much business transaction with the related party. So whether they are actually loan transactions or they are pertaining to normal business, that we don't know. Then heavy cash withdrawals in loan accounts, that also is an early warning signal. Non-routing of sales profits through consortium, that we already discussed. Significant movement in inventory and receivables, non-production of original bills for verification. So a lot of times, term loan, when the term loan is sanctioned. So mainly what RBI has also instructed banks that you should not disburse that term loan to the party's current account or the CC account. Wherever the vendors are submitting their bills to you, to the branch directly, payment should be made. But most of the time you see that particular term loan first disbursed to his current account or to his CC, and from then the party has the liberty to issue the checks. So finally, end you what you get, you get a CA certificate. That is the, usually in all the statutory audits also, when we try to find out what are the exact end use, and many a times the certificates don't seem to be that clean also. So if it's a big term loan, high value term loan, I think you should not just rely on the CA certificate, but at least the branch should have some kind of control whereby they should ask for, okay, if any machinery was imported or any machinery was bought, what exactly is the machinery? You submit the invoices of that machinery. You submit the technical certificate from the engineer that this machinery was installed. What was the freight involved in that? Give us the freight bills. So at least all this from the four corners you can have a check, because all this from a fraudulent angle when we do a forensic. But mostly I don't know now. If you face a regulator, there is a auditor is an auditor. He doesn't have any thin line between that whether you are a concurrent, you are a statutory, you are a forensic. For them, auditor means you are supposed to know everything and you are supposed to check everything. So that is what is in their mind. So at least somewhere where you feel that such high value tickets of term loans, you should have all the documents checked. Significant increase in working capital borrowing as percentage of turnover. Then increase in fixed assets without corresponding increase in the long-term sources, frequent change in accounting period or the accounting policies, that also to inflate the revenue. Many times the accounting policies are getting modified by the parties. Material discrepancies in the annual report, again substantial related party transactions. So, interconnected companies, large volume of transactions, resignation of the key personnel, and frequent changes in the management. So that also is a early warning signal which is highlighted by RBI. Significant reduction in the stake of promoter. So all this mainly you won't find everything on paper. So maybe like resignation of key personnel, maybe from social media or from newspapers. So as an auditor you are expected to keep track of everything nowadays. Raid by income tax, sales tax, central excise. So many times these authorities will issue a letter to the bank to freeze the debit in those accounts. So if such kind of instances are there, then you have to report it in your concurrent audit. Regarding cash verification, I think more or less every one of us would be doing this. Surprise cash verification, that there is no accumulation of large soiled notes. Then again, if the retention limit is more in LFR, anyway, the statutory auditor keeps on reporting that. So as a concurrent auditor, we have to see that the cash is promptly remitted to the currency chest or to RBI, because idle cash should not lie with the branch. And short or excess cash, that needs to be reported immediately. Whether if there is a, you should not even wait for the month end. If you come across any kind of shortage, substantial shortage, as a flash report, immediately it has to go to the zonal inspection team, GM zonal inspection, or to the ED, at least to the ED and zonal inspection, if any such cases found. Then daily cash transactions, particularly abnormal receipts and payments. Surprise verification by an officer other than maybe internally if they have such kind of verification or not. Then insurance cover, again it is at central office, nothing to be seen at the branch, but maybe at least you can take a confirmation from the branch and keep it on your record. Then accounting of currency theft transactions, reporting of counterfeit currency if there are any such cases. Then reporting of CTR, any cash involved more than 10 lakhs, any cash deposits or withdrawals, whether those are properly captured in the CTR and reported by the branch on a timely manner or not. Then more than 50,000 cash transaction, invariably Form 60 or PAN card, Xerox, PAN number, all those things are captured by the branch. Okay, this is on the penalties. Now coming to manual reversal, obtain the trial balance and PNL, check any negative balances appearing. So you have income head, you have some debit balances, or expense head, you have credit balances. You need to actually check those ledgers and find out whether there was any error by the branch or not. Then manual intervention, verify the computation, sanction. Mostly I think they take a certificate from the concurrent auditor in all the cases of instances of manual reversal. So mainly, manual reversals, what kind of instances we have, the central auditor or the branch auditor has suggested. So any NPA classification and then reversal of income, excess charging of processing fee, renewal charges. So many a times, we have instances whereby the branch reverses the income, but then he doesn't have the authority to do that. He will write a letter to zone or to his head office, but then there is no approval from them. So in this cases, what needs to be done? Because you are already reversing that income and the appropriate approval is not there on file. In such cases, make it a point that you bring this, in your report. Because so practically what happens is that if there are some good blue chip companies or good parties and they don't want to lose business, but the processing fees, they are saying that in the sanction it is 1%, but they are agreeing for 0.25%. So since the branch manager doesn't want to lose the customer, he will charge at 1, he will reverse 0.75. And then he will write a letter to HO, and those people will take their own sweet time because nobody wants to take that call on themselves. Locker rent, again, you have to check the accounting policies, whether rent is getting automatically credited in CBS. Now, many a times, at the branch level, we have found that there has been revenue leakages in that aspect. And now most of these banks are centralizing it. So whatever records on the locker rent they have at central level, and they run the cycle in the first quarter of the financial year itself. And accordingly, the current account or the savings account gets debited by the locker rent. But you should have a report extracted from the CBS and then ascertain whether each and every locker rent, whether the corresponding rent has been recovered from the party or not. Then there are a lot of disputed, or those parties are not there, but the locker is still with them, and they don't have any balances in the savings account or the current account also. So those accounts also you need to highlight it in your report. Then some of the housekeeping points which concurrent auditor is expected to report upon, mainly sharing of passwords. If you feel that such instances, maybe it would not be again on a paper, but at least during the course of your audit, you find that branch manager's password, he is at home, he is sharing his password with somebody else. So, these are all very high risk areas. Then storage of servers, switches, routers, whether when you enter the branch, immediately you have the server over there, or a router or switch is placed over there. Then again, whether you can, access pen drive. Because most of the cases, because all these banks, computer, desktop, they have sensitive data. So there should not be any pen drive access to that. So even if you have cases where you are able to, put your pen drive or take the data, then again, where the computers on which there is CBS, there should not be any internet connectivity on the computers. That also you should check, because if any server, any virus comes from net and it goes through CBS to the main server, it will be a problem. Scrutiny of day-to-day voucher, reporting of fraud, customer service, that all is on a regular basis. Government business, again, many times that liability and asset side has to match. So what you are acting as an agent for government, you are collecting the amount and you are paying back to the government. But then there are a lot of differences. You collect something, you pay something, because everything is automated, maybe at central level, but only your branch code is being used. So in one particular branch, which I remember, some 14 crore worth of difference was there. Finally, we made the bank to pay that amount under debt to government. So that difference was lying since several years between PPF receivable and PPF payable. Recovery of TDS, payment to contractors, I think these are all general points only. Security at the branch, whether you find any security guard. If not, then that also you are expected to report. If he has a gun, whether there is a valid license to it, that also you are expected to report. Then Ghosh Jilani, have you gone through the Ghosh Jilani report? I think that is a very good question. Actually, if you go through, you will get a lot of points for which a concurrent auditor can go through and highlight it. So coming to expenses, mainly on the main expenses are pertaining to rent, telephone, electricity, traveling, printing and stationery. So rent, lease rent, because most of the premises are on lease, and several of the properties are under litigation, because time and again the landlord will keep on asking for a higher rent, but the branch is not ready to pay. So whether that point is also getting captured. Just see to it that the lease agreement, you are able to go through that lease agreement when it expired. It is not being renewed, although at least that particular story you should capture in your audit report. Then telephone, electricity, traveling advance. If there is any old traveling advance which is still, that advance has been given to the branch manager, many times we find that the branch manager is using some 50,000 or 1 lakh rupees of kind of a petty cash account. That amount is always with him, but then he has to settle it on a timely basis. Why continuously that advance is with him? That also you need to check. Coming to the forex and remittances, verify the genuineness of foreign inward remittances and use and purpose from the view of anti-money laundering kind of thing. And foreign outward remittances, particularly for import transactions, to ascertain the genuineness, because the RBI is quite strict on that. So most of times, the payments are made, but the bills or the bill of entries, which the parties were supposed to submit to the branch. So, many a times branch keeps on following up with them that, okay, that payment was made, but that bill of entry you are not, because they have got certain returns to be submitted to RBI, that whatever payments to the foreign parties which have been made, whether the corresponding bills have been submitted, bill of entries have been submitted to the branch or not. Then check the related booking of income, charges and commission for the conversion, confirm that the rate is proper as given by the treasury team. Then verification of SWIFT. See the last point. Have you read that PNB fraud? What was the modus operandi? You all are aware. And why this particular area, time and again now it is, it's becoming very critical at branch, where there is a SWIFT server or a SWIFT mechanism in place. And why, as a concurrent auditor, you have to on a daily basis check whether whatever instructions or the entries or the transactions which are reported under SWIFT, they are parallelly getting entered in CBS or not. So this gained importance, this particular gained importance after that Nirav Modi PNB fraud scam. So you are aware of that modus operandi, how that happened? Because that SWIFT system was not linked with CBS. And that branch was issuing all the letter of undertakings to the counterparts, Indian Bank and Allahabad Bank, their foreign branches. And based on this LOU, they were usually using those funds. And all these entries were just in the SWIFT. They never entered in CBS. And this came to highlight when that particular gentleman retired. So this, for so many years, this scam was going on, and there was no linking, because, bank has so many different software, so many different systems. So always as a concurrent auditor, you need to check whether they are properly interlinked and see finally what are your books of accounts. CBS is your books of accounts. Everything has to finally flow to your CBS. Unless without that, nobody will come to know whether those transactions are there or not. So that is why at your branch, if there are any SWIFT, outward SWIFT messages or inward remittances, just see to it that properly parallelly all that data is captured in your CBS on a daily basis. It has to be on a daily basis. There cannot be any delay in that. Then stock statements, if there are delays in that, then whatever penal charges are getting automatically debited by the system or not. If it is not there, then as a revenue leakage, you need to highlight it in your report. Like I had previously mentioned that the date stamp needs to be cross-checked with the date which is mentioned in the CBS system. Then some of the other general points, reconciliation of the government business accounts, multiple CIF. So can anybody tell me why multiple CIF is a risky area? What is CIF? Customer identification number. So as an individual, what do you feel? How many customer identification numbers should a lot